referred by Michael. Raised in a hardworking blue-collar community, Michael embraced that same work ethic. Hardworking, resourceful, an entrepreneur at heart, he hustled from cutting grass when he was 12 to working all types of jobs, including golf caddying and waitering at restaurants, to starting businesses. Determined to transition into the white-collar working world and being at the right place at the right time, he was exposed to the financial markets. Michael's interest in trading commodities futures originated during his time as a student. During an unexpected work-study program, he was introduced to developing seasonal models for heating oil and natural gas for a major hedging firm using spreadsheets, and he was great at math. He subsequently worked on Wall Street, managing commodity accounts, and despite the significant commissions, he realized that he could potentially earn much more through an incentive fee. So after 3 years at a brokerage firm, he started his own CTA. I sense that he has a very intuitive style about him in trading, business, and in life. And I promise this is not just going to be another interview. It's engaging, and there are lots of golden nuggets to take away with. So you don't want to miss this. Also, we've added a bonus behind-the-scenes segment for this episode where I put Michael on the witness stand some more with some questions. So you're welcome to tune into that segment at the end of the interview. Also, guess what? As a gift to you, just because Michael's cool like that, we've included a link to Michael's audio version book, The Inner Voice of Trading, for free. And it's in the show notes of the episode of our website. Get it while it's available. Thanks, Michael. So to get it, just visit our website, chatwithtraders.com, then navigate to this episode, episode 299, and you'll find the link in the show notes. Enjoy. Ladies and gentlemen, we are so pleased to introduce Mr. Michael Martin, originally from New York.
Well, Michael, I'd like to welcome you to Chat with Traders.
Thank you very much for having me. It's a great show. Honored to be here, and I don't say that lightly. I know who you've had. I've referred a few people to the show, and it's good to finally connect.
Yeah, likewise. So where are you now, and where did you grow up?
Right now, I'm in the Los Angeles area. With my accent, you can tell I'm not from Kentucky. I was born and raised in New York. Grew up, about an hour north of Manhattan. Found my way to New York, went to college, went to work, kind of made my bones, cut my teeth back in the day before the internet, when stocks traded in eighths and commissions were, 1% to 2% every trade. It was very expensive to be an active trader back then. So that was a good environment for me to learn how to trade, cut my teeth, and only trade when I have an edge.
Just prior to getting into trading, what did you do, and kind of like how did you first get introduced to the markets? By friends, family?
Yeah, a little bit of both. I had, I was the baby in my neighborhood. Everyone was either 2 to 5 years older than me, which, when I'm 11 and your friends are 16, there's a monster difference there, in terms of human evolution and the things that are important to you. When you get older, those kind of numbers don't mean much. So those kids had either become cops or firemen, several of them, and, rented seats or bought seats on the exchanges, the Amex, New York Stock Exchange, or they became locals in the commodities markets. So that was my first introduction, because they were out working. I was still in college. And then just by being in the right place at the right time, where I went to school at the time, they were the third largest landlord in the city. And so they were big users of natural gas and heating oil for electricity and for environment control in the winter, respectively. And they didn't have a hedging plan. And just by luck, I was in the right place at the right time with a work-study job where I helped them look at seasonal tendencies in energy markets to design a hedging strategy.
So you were helping them design a hedging strategy. Was this before you got into actually trading, or I assume this is involving commodities? So how did you learn about that?
So I went to the exchange and I actually got the data. In those days, you had, combination 5 1/4 floppies and 3 1/2 floppies. Lotus 123 was the dominant spreadsheet of the day, and you had about 3,000 rows. So you could get 9 or 10 years worth of data. And what we would just look for is what are the seasonal tendencies when prices would appreciate and could cause problems because, of all the schools under the university umbrella, there's probably 25,000 faculty and students who were basically on rent control. And so worked into the price of the rents and the leases were energy costs. And in New York, you definitely have very, very cold winters that you need to have heated apartments and rooms and dorms and this and that. But also in the summer, it's hazy, hot, and humid. You can cut the humidity with a knife. So people, put their ACs on. And if someone else is paying the bill, they're not turning the AC off when they go out. They're going to come home to a nice, cool apartment. So if there was a spike in prices, it was going to cause a big problem for the school. And so I was really good with numbers and building models and stuff like that. My foray into actual trading actually started with stocks. I had built a landscaping business and sold it and put some money into the market. I really didn't know what I was doing, but I was kind of cutting my teeth and learning the process. The commodity thing was just, like I said, I was in the right place at the right time. And I understood it a lot better because I grew up, in New York, you actually have a crop year. So I understood seasonality just inherently, and I could see that in prices. And so it just clicked for me.
Were you ever tempted to open up a commodities account and trade commodities?
Well, shortly after that work study program, I actually went to Wall Street and I did. It was a little trickier back then because now it's like, man, anyone who could fog a mirror could basically open up a futures account and trade minis and micros. But the environment was very different back then. There weren't online brokerages. There were a couple of discount joints. Schwab was doing $30 for stocks as a flat ticket price. Kennedy Cabot was another one. Waterhouse might have been around before it became TD Waterhouse, before it evolved into TD Ameritrade. So I'm kind of dating myself. And you really had to prove financial wares. Like it was a hard process to get an account opened. You couldn't just walk in and say, hey, I want to trade. You had to show that you had, substantial net worth and liquid net worth. And most futures margin accounts were not funded for anything less than $100,000. And you had to be there in person. There wasn't any, there was no internet, so there were no online applications. You could scan your driver's license and send it in, and within 24 hours, you're up and running, wire the money in, and you're trading. This was a 2 to 3 week process, and you actually had to pass muster and go through compliance. And there were a lot of people who got rejected. Now, I had very quickly gotten my Series 3, so they gave me, they gave me the benefit of the doubt, to let me do that. So I would say probably within 6 months of landing in my Wall Street job, I had a futures margin account as well as a stock trading account. It was all together.
I see. And what year was that?
That was in the late 80s. So 88, 89. When I started, it was post-crash, but still pre-E-mini. The S&P was a $500 a point contract. Margin was 40K. There were just very, very few trading opportunities. There were, sleepy little contracts. So I kind of had to learn how to, as they say, make hay when the sun shines. There weren't, with commodities, most markets aren't trending most of the time. So you really have to learn how to pick your spots and see what was moving. Gold was $200, $300 an ounce, to give you context. It was, it was a very different time.
And so how did you go about finding the stocks to buy, and kind of what was your early strategies?
I'm embarrassed to tell you, like, I really didn't have one. I was in an office with 70 other, financial advisors, and, a lot of it's like, well, what are you doing? Well, what are they doing? Well, and this and that. So it was the modern day Discord, what's in the newspaper, what's going, what Peter Lynch style, like, what are the things that you see that you're using in your life? You're buying XYZ good or service, and then you kind of see, okay, where does it trade? You go to McDonald's, you go to Wendy's, you go, you're using Apple. It was called Apple Computer at the time. So all that technology was just coming online. Most people didn't have computers, never mind smartphones. So all that stuff was new. You couldn't really see it or touch it because it was also very my first cell phone, I think, was $1,000.
Wow.
And then it was $1 a minute for talk time. So it was, fantastically expensive, everything. So I just kind of tried to observe a lot, like what was going on in the world, what were other people doing, what were they watching? And then because commissions, like, I started with $5,000 grub stake in my trading account. for commissions on stock, it was $50. So that was 1% of my account
Wow.
balance. For commodity futures, you know, for some reason they had two different rates that would automatically apply. One was like if it was a day trade versus an overnight, take it home, which is more my style. And that ranged between $75 and $100. So I was paying 1.5% to 2% of my account balance in commissions. So again, I had to think like a sniper, not like a sniper like entry, but I had to sit and lay in wait for hours at a time, days upon time, waiting for trends to evolve and things to start to break out before I could put money to work. Because otherwise, I was just really churning my account. It was a very difficult time because I really was full of piss and vinegar and I wanted to learn. But, the market's really there to take your money more than anything else. So I had to really learn the importance, which applies to today's marketplace too. It's like if you can't express your edge, you have to learn the importance of sitting on your hands, and taking advantage of things that speculators really have a huge advantage of, and that is they have the right to not participate.
So with the commission rates so high, were you incentivized to hold the positions for a good length of time to try to maximize, squeeze out the extra profit out of it instead of, doing short-term trading?
Ian, that's 100% correct. Mm-hmm. My goal at the time was to grow my account to 50K. And I knew that sounded ridiculous, so much so that I couldn't even tell people because they're like, listen, buddy, you don't know the backside from a hole in the ground. You think you're going to do 10X in your first year, trading commodities of all things at a time when the place was really a stock and bond joint. So I was more like, look, I know because I could see the charting software was very, you almost had to do it by hand, but I could do the math in my head and say like, okay, in the 70s, soybeans moved $5. That's $25,000 a contract. So I kept thinking like, man, if I could just catch that and put the money to work and sit on it and live with the day-to-day fluctuations, then I could increase my wealth because I was clearly in the wealth. I didn't have any room for error with 5K. I mean, you don't have it now. Back then, you didn't either. And they were meant much more like think about AI and smartphones and technology and everything internet related and mobile technology. All of that didn't exist. So almost all of the names, except for like Apple and Microsoft, really weren't even trading, right? AOL was AOLN, it traded over the counter. And so you really had to pick your spots and be very judicious in your security selection, and when you would put things on. But I learned, and again, environment really shapes us. I was grateful to grow up in that environment because it was so expensive to trade. I almost had to think in buying and selling commodity futures. I had to think like an investor, and that has brought more gains and wealth than I probably deserved. Just learning to sit on my hands and not offset a winning trade because I was so excited to have the winning trade in the first place. Let the winners run. I said, like, I'm worth it. I had to convince myself in my head, like, okay, a lot of it comes from my background. Like I caddied golf bags at Wingfoot and Quaker Ridge. I worked, at mob-owned restaurants, and I made a lot of money. I would make 5,000 over the summer. I was making 5K a month back then, cash.
Wow.
And I'd always think like, okay, I made $1,000 in trading. That would be like a week of golf, trade, working at the restaurant and this and that. So I had to get out of that blue collar way of thinking and saying it's just the start. You're up $1,000. You're up 20%. I always wanted to think in terms of the big thing that helped there was converting things into percentages because the dollars were overwhelming for me. Because once I got to be 100% up, I was like, okay, that's the whole summer. And I kept thinking, because that was my reference point. But I thought, okay, well, if you're going to be up 200%, like the guys at Commodities Corporation, you have to have been up 100% first. So you can't panic. This is your big moment. You can't panic and do the small-minded thing and always live in like a make it and take it kind of mindset. You have to let your winners run. And that's what I learned to do. Thank God.
In your quest to 10x your account from 5,000 to 50,000, how tempted were you to use leverage? And did you?
Well, Your Honor, I'm guilty as charged. My whole point in putting the 5K in and going to commodities was for the leverage.
Mhm.
I knew because I was a math kid, like I could calculate numbers in my head. So I could see stuff. I could see, I'm a visual learner, and I could see patterns, not chart patterns, but I could see patterns in human behavior. I can just see patterns. It's something I was born with. And the math, my dad was a math whiz and he taught me how to calculate numbers in my head. So I was a year ahead in math in school. I had passed out of a lot of classes that I would have had to have taken in math. And when I got there, I was like, okay, commodities to me are even better than real estate. In those days, if you bought a house, you'd have to put down 3K or not 3K, but 10%, and then you could finance the rest. Well, commodities were even better because you'd put down somewhere between 2 and 5%, and you didn't even have to borrow anything because the leverage was implied, right? It was the margin deposit is considered a good faith deposit on the full notional value. So if you look at it with 5K under Regulation T, I could trade 10K of market value in equities for things that were marginable. For futures, if $5,000 is the number and that's 5% of what number, that's 100K. So I could control 100,000 in notional value of commodities. So there was almost like a 10x. When I thought about notional value, under Reg T, I can control 10K. With futures margin, I can control 100K. Okay, well, if those notional values went up 10%, what was the value or the impact on my $5,000 grub stake? So I immediately gravitated to futures, commodities trading, with a strong understanding that with futures, you have unlimited loss potential regardless of whether you're long and short. So if you smell smoke, you have to assume it's a 5 alarm fire. There is no like, well, I'm just going to wait and see how things go. And that complicated things because, like I said, it was $100 commission to get in and out of the trade. So I had to always fight my emotions. Like, I don't want to get knocked out of a trade that I could otherwise sit with through a small near-term pullback if the trend kind of still resumes. And that was really the hazing process where I had to thicken my skin.
How did you apply risk management back during that time, and kind of what did it consist of?
Geez, you have done a lot of preparation. These are great questions. So I developed what I later kind of come to understand as progressive exposure. Now, some people call that pyramiding. It was more like, how can I add to my winners and steal second base without taking my foot off first? So what I would do is I'd buy like a sleepy little corn contract, or sugar is a better example, because sugar's never in the newspaper. Like, you'll never see a headline on the Wall Street Journal or Barron's or on Yahoo Finance where someone's talking about sugar. And that was perfect for me because I didn't want to get buried in what we called the Fab Five. And the Fab Five is an expression I borrowed from Michigan basketball. And that would be like the yen, the S&P, 30-year bonds, gold, and crude oil. Because those were the commodities that would get written about in the newspaper and would cause a lot of volatility. Again, remember, there's no internet. There's the C section of the Wall Street Journal. There's a business section of the New York Times, which nowadays basically doesn't even exist. Then there was Barron's on the weekend. So those media plays could really impact the price of a commodity. And I didn't want to wake up to heartache. So I would trade these sleepy little contracts that no one ever talked about: cocoa, cotton, sugar, this and that. And so what I would do is, as the market would move in my favor, and I knew I was going to be able to risk, say, $250 to $500 of my account, because I really didn't have a choice. I was underfunded. When the contract got up a few $100s, I would immediately put my protective sell stop at break even. Now, I didn't want to get knocked out, but I also didn't want to lose money. And so I honored that system really from day one. I just put in protective stops, and I've been doing it ever since. So then what would happen is like, if I added a second contract, I could see the volatility and say, okay, if it goes here, this is where I have to adjust my stop. So that even if I have several more contracts in the account, I'm still not risking any more than the original 250 to say 500 that I was risking on the original trade. So I kind of built in like free call options. It wasn't exactly free, and sometimes the market would come back and knock me out, and that was frustrating. But it was a way that I could sleep at night and live with myself and build into larger positions, so that when they did take off, that's kind of how I made, several $1,000s on a trade. It was not because I had one or two contracts risk on, risk off. It's because I kind of unknowingly was pyramiding into things, but very strictly managing the risk, not taking on more risk. 30-40% of the time, the markets would continue to move in my favor. And then I was making really asymmetric returns for the risk that I was taking, which was the whole point. Because I knew the math. I knew enough about playing poker and blackjack that this was a game of expected value, not about accuracy per se or being right all the time. And I could emotionally live with that. I was good at, I didn't have a problem taking chances.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So how did you decide on when to get out? Like, what did you have a system or a target to tell you when time to exit the position that has moved in my favor all this way?
You know, the honest truth is, and I'm red-faced, even though people can't see it, like I didn't have a strategy on how to exit winners. It's probably the hardest trade, I think, even today for people alike. It's like, when do you know when the move is over? And you really get to operationally define that yourself. So what I did, because again, I'm self-taught, you know, so again, this is, you're going to laugh, but I didn't have anybody to show me. Like, the guys that I eventually met who mentored me when I became a pro, you know, were obviously already very, very successful, but there wasn't someone to kind of say, hey kid, when this happens, there was no 50 or 200 day moving average crossover kind of system like there is in stocks. There wasn't like a Dow theory like Victor Sperandio uses, you know, for equity risk management. So I had to do it by the seat of my pants. And the simple answer, Ian, was I thought by putting, every day I would put the open, high, low close in and then mark to the market where my equity was if I had, say, 3 or 4 contracts in the sugar or the corn, and say, okay, at the open, I was up 30 ticks, and this is what I would have been. Because I wanted to calibrate my system to not have this hair trigger response to knock myself out of winning trades just because I was up big at the open. Mm-hmm. So I went through these case studies of looking at other moves in commodities and saying, okay, if I had my proper risk management on risking, say, you know, depending on where my equity in my account was, you know, between $250 and $500, you know, per trade, could I live with these types of drawdowns, knowing that the trends would persist eventually because of forces that I might not have even fully understood? So, you know, I just tried to stay with the winners for as long as I could because I knew I wanted my money to work for me. Later in life, so I kind of did it by saying 250. I have a $250 trailing stop on my equity at any given time. That was how I did it in today's language. I didn't know it at the time, like that's what you called it. Like, who knows what the hell trailing stop is? But that's effectively what it was. And if I was really making money, you know, and I got to like 6, 7, 8,000, I can remember giving it a little bit more room because now I wasn't losing my corpus. I wasn't losing my original grub stake. It wasn't house money, but I was willing to go a little bit more aggressive because I was then risking money that I had already earned from my trading activities, right? So I always look at it at my money. It's always my money. It's not house money. But I still do that today. If like my equity is up, I tend to trade larger when I feel like not necessarily I'm in the zone, but if I have the P&L to prove it, then I can afford myself more risks. I go back and I do this case study and say, okay, how much of this am I willing to risk in order to stay in the trade? Because the odds change, Ian, like once you're in the trade. It's like that old Monty Hall thing. Like if they show you what's behind door number one, this and that, and there's a whole science around it. When you're in a trade, risk on, risk off, you might have like a 3-to-1 payoff with 40% accuracy. So your system has positive expected value. But what you learn over time, and this took me a couple of years to learn in studying the data, is that your odds might change. So now you have to use conditional probabilities or Bayes' theorem to say like, okay, I'm up X% in the trade, or it's moved this amount. What's the probability of event B, like the move continuing up X amount, given the known probability of event number A that I have a 40% accuracy and a 3-to-1 payoff? So you can really apply that math to make better decisions. It's not probably for beginners, but it was math that I could understand because, like I said, I was a math guy. And then the light bulb kind of went off and said, see, this proves my theory that I should stay with winners, even if there is going to be a pullback, because the math supports staying with the trade and then maybe even adding another contract or another 50 shares or something at that point, because the probability might be like, okay, you have a 5-to-1 payoff with a 30% accuracy. So the expected values change over time. It's not static.
So over time, as the technology develops and technical indicators are introduced and become easily accessible, did you zero in on a few technical indicators that could easily replace your mathematical thinking, so that you wouldn't have to crunch those numbers?
I did. And again, I'm red-faced about it because I failed at all of them. They never really were worth all the binary code that's used to write them. In the book, I call them emotional band-aids. And that's really what I looked at them for. Like, can I increase my sense of accuracy by using indicators? And they're not really indicators. I use that term with you, but I think of them more as validators or confirming indicators, because anything that you need to see about whether the trade's working out, you can see in the damn price of the instrument itself. So ADX, well, great. You're never going to see ADX like is one that I've studied. And yes, you can see trends emerging or the strength of a trend emerging once it starts to come out of the 20 to 25 range and kind of trade up above 25. But you're never going to find a strongly trending market that doesn't have a high ADX number already, right? You could look at MACD. There's a lot. So I just looked at all those things and I said, why am I doing this? Like, what is it intellectually that I want? And what do I want out of it from an emotional and psychological standpoint? And I realized after, 2 or 3 years looking at all these newer prefab indicators that I was really looking for some kind of emotional security. And it doesn't exist. There is no, external solution to the internal things that you're feeling. And I don't want to layer up my charts with these things because it just doesn't work. They can only kind of confirm things that you can already see on the chart or that you can see in the price. Very few of them. Like relative strength for stocks can matter. You can use ATR to normalize risk in the commodity markets. That came out in 1978. So that had already existed. I didn't know about it, again, because there wasn't an internet and I hadn't seen Wells Wilder's, book. So the answer is yes. I tried to uncover every stone, but I found that the efficacy or the value that any of them would bring wasn't going to help my profitability. It was more to calm my nerves. And that even still didn't really work.
During this time, did you say you were working on Wall Street? The trading obviously became a passion of yours, the way you're describing it. But did you ever envision that trading by itself would eventually replace your actual jobs, or were you trying to get it to replace your jobs?
Yeah, great stuff again. Without getting into the whole history, which, I'm more than happy to get into, I was a working class kid. I was a day player. I'd go to the golf course and I'd go home with a pocket full of cash. I'd go work at Glen Island Casino and I'd come home with a bunch of cash. And I was used to being a day player. And, my parents were Depression era. And so we had enormous amount of grit. We were hardworking people. Like that was the culture that we grew up in. A lot of Irish Catholic, Italian Catholic people who left the city, wanted their own piece of property, and, instilled in their kids, put your head down and make something of yourself. So when I first got to Wall Street, it was really, I wanted to be several months ahead. When I left, I had $1,000 a month rent. I had, $1,000 a month go to student loans. And that's before I had any food, dry cleaning for my suits and all that kind of stuff. So my goal at Wall Street was to learn intellectual property. I wanted white collar. I wanted to stop exchanging my time for money. I was very clear about that. And what did I do? I went to Wall Street and I was working 15-hour days. Putting in blue collar hours on a white collar job, which is what you do because you don't know. I didn't know anything else.
Did you like your job?
What's that?
Did you like your job?
I did not. I didn't like it. I wanted to get a trading job, but in those days, I actually hated the job. The people were okay. I met a couple of really good folks who I'm still in touch with, but they were financial advisors and they made the mistake of thinking of themselves as Peter Lynch. Like just because you have a Series 7 or any other type of license, that just allows you to do marketing. It doesn't really teach you anything about creating alpha. But people start to think like, hey, I got access to because in those days, again, there's no internet. So there was a club. And if you didn't go to one of the 5 or 6 big bulge bracket firms, the brokerage firms, you were out of the market because there was no other way to get entry. Now it's like you could do it on your phone. You could trade for free. That's a complete culture 180 from where I was raised. So I was like, I'm just as good as any of these people. They all think they're smarter than, everybody. But I'm just going to grow my capital so that I could replace, I figured, look, if money markets were paying 5% in around 1995. And I remember them saying like 5 and 5 and 95. And what they meant by that was the Dow was going to hit 5K. Interest rates were going to be 5K, money markets, right? And that was all in 95. And my thought was like, I don't know how the hell I'm going to do this, but I'm going to put myself in the energy of having $1 million at 5%. That's 50K or 4K a month. And I could pay my bills and have money to enjoy my life. Not a spendthrift. I didn't want a Ferrari. I didn't want any of these. I don't buy stuff. I didn't want to accumulate goods, especially things that are going to depreciate. So I just thought like, how could I grow my wealth so that my money can finally work for me, right? You either work for your money or your money works for your money. And I had no experience. I was a complete virgin in that area. So I had to teach myself because it wasn't in my family, in my nuclear family. There weren't really any investors. There were some well-educated people, but they weren't really investors. They were savers and workers. And they had pensions. And that's not what I wanted for myself. So I knew I had to grow my capital. My Clark Kent job, though, was being a financial advisor. So you can imagine I was really I was a double kid, like they said in the department. On the weekends, I would drop my R's and sound like I'm from Dorchester and Charleston. And then, during the day, I'd be like, yes, let's talk about the confluence of religion in the Middle East and its effect on your eleemosynary concerns. And I'd become a completely different guy. So I didn't like that part of it. I didn't like to have to fool anyone or do something that, try to be somebody that I wasn't. But, the branch managers were looking at, they didn't grade you on profitability. They graded you on how many new accounts did you open, households, new accounts, what were your net new assets that you brought in that either existing clients gave you or that you brought into the account, transferred in, and how much did you generate in commissions and fees? Nowhere in there was like, if you made money for the client. And I knew that I was going to be an alpha generator, and they were not concerned with alpha generation unless it added up to their commissions, because that's how they got paid. We had the whole floor, and I'm sure the rent was $100,000 a month back then. So, I didn't like that because I wanted more. But it was the only way I could get in. It was if they don't let you through the front door, you go through the bathroom window kind of a deal. Well, that was kind of how I did it, because I figured from that perch, I might be able to move horizontally. Like at least I could learn how the business is run. Before that, I was looking from the outside in. I said, let me get into the business and then I could move around. It was a lot harder than I thought it would be, because they kind of pigeonhole you. And in those days, they weren't, don't laugh. They were hiring traders on the desks if they had MBAs. And I was like, that's got to be the stupidest thing that they ever did on Wall Street. But that was how they cut the pile and culled the herd down to keep the interview process. So I had no interest in getting an MBA. I like knowledge for knowledge's sake, but there was never any proof that having an MBA was going to help you be a better sales trader, market maker, institutional salesperson, or prop trader at like a Bear Stearns.
Did you ever meet any of these MBAs and get a chance to learn what the traders are doing in the firm? Maybe get some ideas from them?
I did and I didn't. I got to know a few of them because I was trading enough size that I could call to the traders and the market makers and negotiate better prices. Because again, in those days, the spreads weren't decimalized. Decimalization had not come to pass, so everything was trading in eighths. So, if you could find, in those days, there was something called 19C3, where you could take a New York Stock Exchange listed stock and trade it like it was over the counter. So I remember, buying Wendy's quick service restaurant that was quoted 16 bid, offered at a quarter. But if I could buy like 3, 4, 5,000 shares for my own account and for my clients, I could call the market maker and negotiate them to get a better price. So I'd fill the trade at an eighth and to put an eighth commission. So I'd be in for 16 and a quarter net. My clients would love that kind of stuff. So I learned how the game was played because they had a P&L, which was based on the spread. I had a P&L, which was based on my commissions and fees, which was completely backwards on doing the right thing for the client. But that was the game that we had to play. And I did that for 3 years of finding things that had different, spreads that they were moving, and then using my institutional size to negotiate better prices. They didn't really teach me how to make money. They taught me about how to ungame the system to benefit the client. Because they were not really prop traders the way, say, like a Lehman Brothers or Bear Stearns were. Right. So I applied to all those places because after 3 years, I had the track record, but they were still in the mindset that they wanted to hire you coming out of business school or sponsor you to get an MBA. And I was too smart or too stupid to lie to them. Like I didn't want to get an MBA that had nothing to do with trading. To me, it was like, I have to put now 2 more years as a buffer between me and my goal. Like that's not going to happen. The interesting thing was that to a name, like most of those companies are out of business except for like David Shaw, Long-Term Capital. I'm sure I had caddied for John Merriweather at Wingfoot. Sent a cover letter resume with my track record, with documented track record, and I don't think I got a call back. Like I was just completely shut out. So I started my own company, and that's what I did.
Interesting. So you quit your job there on Wall Street and you started your own company doing what exactly?
I feel like Paul McCartney here. There's no short answer. Just again, I was in the right place at the right time. You have to remember, in July, I had a lot of clients in Chinatown because they really liked the action and they liked to see money being made. And I was getting really good at trading commodities. Long story short, I was in the right place at the right time with the right people, not mentioning any names, who had a big impact on delivering the Chinatown vote to Mayor Giuliani for his first term as mayor. Mm-hmm. And I helped those people because around July 1st of 1997, Hong Kong was going to go back to being China controlled from the UK, right? And so there's a lot of people from Kowloon and a lot of Hong Kong folks in Chinatown in New York City. And they were all scared. So they wanted to get their money out of Hong Kong because they thought that China would close the border. So we called it political flight capital. And because I had done a good job making relationships with these people, and perhaps because I wasn't involved in like organized crime or a tong, and I was at a big kind of not a gumshoe, but I was a white boy, right? I was a white boy, and they was at a reputable firm that they could trust. So all that capital came to me. Then I made those people money in commodities. So when I said, look, there's no vertical or horizontal movement for me here as a trader where I could do an even better job for you because we could cut commissions by 90% on the institutional side, I'm going to go start my own company and work under a 2 and 20 structure. And I realized like if I did that with the money that I had made my clients over the past few years, I would have done 6 times the gross commission that I did. And that all would have been mine. So I figured so I left and I took about 15 million worth of clients' assets in a 2 and 20 structure. And I really haven't worked for anyone since.
Oh, wow. So during this time, as start of the dot-com boom, were you tempted to get into stocks as well, or were you strictly commodities?
You know, I'd probably say 3 to 1 commodities to stocks. The reason being was you have to pick your poison. You know, look, Paul Tudor Jones could probably trade any asset class on any time frame, right? I was developing that skill, but I was still a super sophomore. You know, I knew sometimes what the right things to do were, but I'd find my way doing the wrong thing anyway. The saving grace was that I always kept my losses small. I knew I did not want to go into protracted drawdowns that would crush me emotionally. I didn't mind losing the money, but I didn't want to be in a 20% drawdown needing it, because then you put a lot of pressure on your money, right? 20% drawdown, you need 25% to come back. That could take you 2 years. Like, I don't need that crap in my life. And what I didn't want to do is I kind of understood the technology. I understood things were trading. You know, I was just getting my first email account on Sprynet and Mind Valley or whatever, MindSpring, excuse me. And I didn't want to tie up my cash in stocks because of Reg T, when I could do 10 times more notional value with futures margin. So it was more an allocation decision to run a CTA. You know, I was probably running concurrently an RIA as well for the stock side, but also the profitability. Like if you have $10 million and you make 20% and you're getting 20% of that, right? So now I'm getting 400K. It was harder to do that with stocks without taking super gigantic positions. And I didn't want to do that because I knew if I was onto something good and I was finally living, not the dream, but I was becoming the person that I had envisioned of becoming. I was a white collar person using my brain, managing risk, keeping losses small. And I knew that if I screwed that up, that I could be back at the golf course next week. And that was a big motivating factor to not necessarily to have to eat crow, because I never had that kind of ego, but it would be just such a complete personal failure to have this thing get so close to the promised land and then blow it up and then be relegated back to waiting tables, which, look, you work hard, you earn money. There's nothing wrong with it. I made a fortune waiting tables and caddying golf bags, but then I wanted to evolve.
Over the years, did you calculate kind of what was the minimum percentage annual return you would need to have when you were working for yourself to meet all your expenses?
I did. I know, because I still to this day, I have this gigantic Google spreadsheet that literally has every number mapped out. Like, what do I spend on Calendly every month? Like, what do I spend for premium Spotify? Like, I know my numbers. The good news is when I left the brokerage firm to set up my own CTA, I started with 12 and then another 3 came over time because the people wanted to think about it and all this and that. But eventually over the next 6 to 12 months, that money kind of came. So I had a full 15. And for some of them, I cut breaks, but I was earning between 1% and 2% as a management fee. So I really didn't have to sleep with one foot on the floor and worry about paying my bills, because I'd have a couple $100K come in, to handle my finances, which, I had earned the right, to do by doing a good job with those people. And also because I was, I cleared ED and F, man, they were charging me, it's a lot by today's standards, but I went from paying, say, $90 to $100 to $10 round turn. It was like a 90% discount. And everyone loved that because they definitely were aware of the commissions they were paying me when I was an upstairs, guy at the wirehouse. So I did think about it, but it wasn't a concern. My biggest concern was not getting into or having my big thing is I'll never be in a 10% drawdown. If I smell smoke, I'm going to puke it out. And I'll even call the people and say, look, I'm going to take a month off because the markets are not amenable to my trading style, but I won't charge you the management fee. Like, I was very good at communicating with people. If they had to hear bad news from before Kramer, is a guy named Dan Dorfman, who was kind of like the carnival barker for the markets. It's just one man's opinion, and I get it. He's an entertainer, but both basically kind of useless. And I figured, like, man, because Maria Bartiromo was just kind of coming online, and CNBC was evolving and this and that. And I didn't want my clients to have to hear the bad news from the TV. I had to be the person in control of the relationship. So I spent a lot of time communicating with people, saying, it looks like this could set up. If it does, here's what I'm going to do with gold. Here's what I'm going to do with crude. Here's what I'm going to do with the Deutschmark, blah, 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 blah. And if it doesn't pan out, or you don't see the confirmation come through, it's because it turned out to be a suboptimal, opportunity. And I don't want to throw good money after bad, because what we don't lose, we don't have to earn back. There'll always be another opportunity. But if you put yourself in a bad spot, drawdown wise, you lose your confidence, you lose your nerve. And that's the last place you want to be as a trader. I don't mind losing the money. I don't want to lose my mental edge. The mental edge is the whole thing.
I see. We'll go more into detail on that. What are some of the common mistakes or common mental edge issues that you faced early on, and how did you overcome them, or how did you minimize their impact later on?
You honestly are a great interviewer, because you're not giving me any room to breathe. Like every question, yes, Your Honor. Yes, Your Honor. No, Your Honor. Like, I am absolutely testifying here. So again, I was in so much fear about money. Like, even though I was starting to get financial abundance, I didn't trust it, because I had never had it before. All I knew was going to work, shave my face, put on a tuxedo, wait tables, and this and that. So when I started making money, I had trouble trusting it. I was afraid that it was going to go away. And I knew that it would have been my fault. Like, I had enough self-awareness to know, like, it's not going to be a market correction that puts me out of business, because I don't have that type of risk on, right? We're carrying, over the years, I got much more aggressive in the mid 2000s, but in the mid to late 90s, I would go home with maybe 10% margin to equity ratio, which is kind of like where the CTAs kind of live. When I got really, really good, and I had over 10, 15 years experience, when China was buying everything in the mid 2000s, I'd have 70% margin to equity. Like, I was levered up. I was taking gigantic, big 5-figure numbers out of gold and copper and sugar. I caught the sugar move from 9 to 18. So mental errors were, don't get haughty, don't get full of yourself. This has nothing to do with intelligence. When I went to Wall Street, I had teachers who had Nobel Prizes. So I thought I was going to go in and trade every asset class, every time frame. And all I did was lose money and prove that that doesn't work, not at least at the beginning. So I said, like, I just have to stay in my lane. I have one skill. I understand commodities. I never would have guessed that was, and I was an utter failure at foreign exchange. Plus, I hated the fact that it was 24/7, and you basically needed a Bloomberg. And I couldn't afford a Bloomberg. And still to this day, I wouldn't pay $2,000 a month for 2 years to have access to data. It's like, it's just not how I'm built. Options were very clever, but there were so many moving parts with Vega and Charm and Theta and implied volatility, historical volatility. It was too much for me, given that I had my Clark Kent day job where I had to look and smell and feel like a financial advisor and kind of be a closeted Superman trader, and so the hubris, pride is said, it's been written, pride's a big banana peel. I couldn't fall in love with my P&L. I would never sit and bask like I've got a gigantic position open where, you could have $250,000, $300,000 of unrealized gains. For a blue collar kid, when you started Wall Street, that could have been like 3, 4, 5 years of total compensation pre-tax, right? So I had to forget that thinking and just saying, okay, well, if you have $10 million, $12 million, $15 million, and you have a $300,000 unrealized, you have to think percentages to give yourself context. So that really helped, was to stop thinking in terms of dollars and cents and like, okay, I lost 10K on a trade, big deal. That would have been like a whole summer or 6 months of working in my blue collar jobs. Then coming to understand that intelligence is important, but it's not how you make money. Making money is about knowing good trading tactics, and can you pull them off? Do you have the will to do it? And I was afraid. I was absolutely petrified, because every time I put on a trade, I felt like kind of like I do now, like on the witness stand, and that, you have to pass muster every day, and you kind of do. But it's not because you're smart or stupid or you're lacking something intellectually. Trading is about adding risk with an appropriate dosage. What is your risk unit? Like, coming from a hedging, being physically trained in commodities, you know what your needs are. So you hedge for your needs. But when you're a speculator, you don't need anything. So how the hell do you figure what the right position size is? That I had to carve out of stone and figure out for myself. And when I lost money or more money than I had wanted, it was very, very hard on myself. And I said, okay, but trading is like sex in many ways, or other things in life that is largely experiential. You can read about it and study books, and God knows I've read every trading book that's out there. I still have them. I've got, first editions of Edwards and McGee for stocks. I have Chester Keltner's book on how to make money in commodities, which is the actual title. And those are all interesting. And obviously Market Wizards had an enormous impact on me, but not because of how they made money, just because they were regular people and I could identify with them based on the feelings that they had to feel when they were learning to develop their craft and cut their teeth at this.
So could you go into a little bit about your strategy? Kind of how did you trade? What did you specifically look for? Presumably just in the charts, assuming you're not, were you doing anything with fundamentals at all? Looking at reports or, commitment of traders reports or anything like that? Or are we just looking at the charts?
Inside the wirehouse, I had access to research reports. But what I learned was that the research reports, the way that they were written, were really just compliance approved data points that I could use to speak with clients to get them to do trades to generate commissions. It wasn't really about the accuracy of the report, because crop reports change like the wind. Sometimes there'll be a seasonal dislocation, or there'll be a blight, or in some of the grains, especially physically settled commodities are seasonal and can have those types of disruptions more than, say, currencies or cash settled, commodities, in my humble opinion. So I did read everything I could get my hands on to learn the vocabulary and the vernacular of the space. I did, like I say, have friends. And so this has kind of never been disclosed before. But when I set up my CTA in New York and registered as a commodity trading advisor and became a member of the NFA, 2 or 3 times a week, I would go to the floor of the various exchanges to meet with the people who were actually dealing with the physical commodities, because they're the ones who have all the information. Mm-hmm. They're actually involved on the physical side. Now, again, I was physically trained, but I would go to the floor and I would stand by Man's ED&F Man. They had seats on every exchange. And so I would stand by their post and learn, like, what was the crowd doing? When were they, where were my levels? What were the inflection points? Where were we at daily highs, weekly high, monthly highs, life of the contract highs? Where were we in the history of things? And see how did they behave at those inflection points? What kind of volume? What kind of how would it change open interest? Mm-hmm. And then calibrate that and kind of market to the market to see if I could incorporate that into my decision-making process. Because there is for example, if you see, this won't work for equity people, but if you see like a commodity going up in price and volumes steadily increasing, but open interest increasing, you can ascertain that it's probably new longs that are coming into the marketplace. And being a smaller speculator compared to the bigger people of the day, I always wanted to be buying when there were other buyers, because I knew that they had the money to punch out my lights, and they would also come back into the market perhaps and even support their existing positions. That would give me buoyancy for my smaller little positions, which, they seemed big for me. They were small in the context of the overall market. But on any given day, I'd be down at coffee, sugar, cocoa, and cotton. I'd be at Comex. I'd be at NYMEX. And I'd be trying to execute my orders kind of from the floor and just giving the orders to the clerk, right there, because they would bring me onto the floor as a guest, which you could do. You'd have to wear a suit and tie, leather shoes, and shave and look. You couldn't come in looking like in cargo pants and flip-flops. So you'd have to dress. You'd have to dress neatly. But my friends would bring me on as a guest, and I would stand, politely out of everybody's way and then watch and see like where was the action. And then if gold kind of closed down, I would go to COMEX, or trade copper or silver. I'd look and see, okay, is there anything going on in energies? But rarely a week went by from 97 to I moved to LA in April of 98 that a week went by when I wasn't at one of the floors, like learning that. Not just how they behaved, but also the culture. Like, it's really sad for me when I reminisce about that culture. Like, there were some great little things and traditions that they did. I remember being on the floor in natural gas, and one of the guys who was a longtime local died. And, when you're down there in the crowd, you're fist fighting with people, but there is a type of brotherhood. Like, they love each other. They really love each other. Like, they're in this together. And they are competing, but they still love each other. And one guy who was a local, he died.
Mm-hmm.
And I remember it was very emotional for me. Even as I think about it, they shut the exchange.
Really?
For a moment of silence. And they held
wow.
the guy's picture up. You're never going to see that anymore. It was very remarkable to see.
Huh. Did that feel like kind of like a second family to you, given that?
Absolutely.
Yeah.
Absolutely. Because yes, they wanted my clearing business. And I kind of had a reputation of becoming a younger Turk, but it was more like it's good for the business if the young guys make it and become the next wave, right? We don't need the stories of Gibson greeting cards and Mattel Gesellschaft and these other guys taking on these big positions and getting crushed. Like, it's not good it's why Lucky Luciano put together the Mafia Commission. It's when you kill people and they find dead bodies, the cops get involved and they start investigating. We might as well decide to have peace among us and determine things behind the scenes so that we can all make money, right? And not draw the attention of the cops or the FBI. And I'm not saying that you should go do this, but the clearing member community and the floor traders, they're not jealous. They are competitive, and they might take your success as an input to go out and succeed more. But it's good for the business when the young people come in and succeed. Right? Mm-hmm. Because it's hard for some of these larger places. They can't trade, for example, smaller markets because they're too big. They're beached whales. So if you look at like the softs, coffee, sugar, cocoa, cotton, there's certain points where these entities that run $50 to $100 billion, they can't really trade those markets, because even if they bought the exchange limit that you can buy, it wouldn't move the needle on their bottom line. Plus, it would still give them enormous amount of risks. So young guys like me would come in and say, look, I got 20, 25 million now, and I could very regularly trade, a methodology, short-term, intermediate-term trend following stuff where I could catch those moves and provide additional alpha to you.
So what would you say were the top lessons you've learned from your biggest trading mistakes, and how have they shaped your approach?
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
The biggest mistakes came from ignorance, and it wasn't not knowing like what type of soybeans are delivered against the contract at the Chicago Board of Trade. That's all kind of interesting, but you can Google it and see for yourself. It was more like conjugating my emotional intelligence and who I was as a person with the tactics that I knew how to pull off in the marketplace. Those were the biggest evolutions for me. And I knew that you can't really paper trade this stuff. You really have to learn how to calibrate, because again, I'm coming from blue collar despair. I grew up in a Raymond Carver short story. I loved it. It shaped who I was. Like, I don't regret any of it, but environment has an enormous impact on who we become as people. So I spend a lot of time, who do I spend my time with, and what kind of things are we doing? And I learned that, again, intelligence doesn't necessarily matter to the extent. I'll give you an example. There was a guy who I worked with at the Wirehouse who I really loved. He was not a bright guy. He was like, "Hey, how you doing?" He was from East New York, which is a very tough neighborhood in Brooklyn. At least it was in the day. And he had been a paper salesman. He would walk around the streets in New York in the middle of the summer with reams of paper on his shoulders and sell it to businesses. Because this is like, now we just go to Staples or you go to Amazon, you order to come to your house the next day. That didn't exist back then. And he did regularly $100,000 a month in commissions and fees, but he couldn't put a sentence together. Like he could barely put a sentence together. So I learned humbly that in Wall Street, we don't get paid to know stuff, we get paid to execute. And I had, because I had done well in school, I had let myself kind of get over my skis and be like, there's often times when I'm out with friends or family where I'm the smartest guy at the table. Well, guess what? No one cares. It's the most wasted amount of energy that you can spend on yourself is to sit about thinking about your designations and your degrees. Sure, you can be articulate and have a great vocabulary and explain complicated things, but it doesn't necessarily mean, again, if you're a PhD in finance and you're doing high frequency trading, yes, there's programming skills that you need to have, this and that. But for discretionary traders, you get paid to execute. And that means, can you keep your losses small? The second thing is I can't manage risk today, Ian, based on what I think or anticipate could happen next week. Because the reality is, ex ante, if my protective stop is hit, I'm getting knocked out. I'm dealing with conditional probabilities of what could happen, woulds and coulds, for next week. And that was, the experts are saying this is showing up in the newspaper, that, and there's supposed to be tightness in supply. So I'm just going to stay with the position and stay in a losing trade or something that's giving back too much longer because I think things are going to improve. We live in a paradigm of personal responsibility. That's number 3. If I make money, I get to take credit. If I lose money, it's no one's fault but mine. I cannot blame anybody. I can't blame, you've been around for a while, Abby Joseph Cohen or Elaine Garzarelli or Mary Friggin Meeker or, anybody from Jerome Powell or Dodge and Elon Musk. Or if I add and remove risk, that's my responsibility and nobody else's. And if I lose money, or if I'm like, well, I'm down a little bit, but it's not quite where I'd feel uncomfortable, I'm just going to see how things go. That's killed more traders than any other statement in the world. So responsibility, it's yours. If you don't have it or you don't want it, consider not trading, because you're going to lose more money than you could ever damn dream of with a lackadaisical attitude, or be like, I'm going to just take credit for the winners, but the losers are going to be somebody else's fault. That dog don't hunt. You're going to get killed. You're going to get absolutely killed. So I learned to be decisive. Your traders have to be decisive.
How often have you encountered traders, even including yourself, who are in a small losing position, but then they start to, look at the fundamentals or the news, and they say, "Oh, well, this new news information, it's actually bullish, and so I feel even more confident about holding on. It'll bounce back. My position will bounce back because the news now seems to be better than it was when I entered the position. So if I put in a stop loss, or if I get out now, cut my losses short, I'm going to be missing out on the big rebound."
So, another really, really good question. What we're looking for there is convergence and divergence. And I talked to Michael Marcus about this a lot, in that if really, really bullish news hits the tape and the price doesn't move, there's a couple of things to kind of reconcile. Was it the hype? Was it people selling newspapers? Was it something that because again, the physical people, the folks who actually have the commodities, they know everything because they're in the damn soybean or cotton business. And so for them, it might not be news. It might be a news story for the public and the small speculators. But what you're looking for there is like, you can't, I think, and I think he's been on the show. My good buddy, Brian Shannon would say only price pays. Separately from him, I kind of coined a phrase that I used with my clients from very early on, and that on Wall Street, only price will tell you the truth, because everyone is selling something. So there's kind of that part of it too. But if bullish news hits the tape and the price doesn't move, I'm absolutely going to probably adjust my stop higher, or at least be mentally prepared that I'm probably going to get knocked out of the trade. And the converse is also true. If really bearish stuff is supposed to hit the tape and the price is kind of still moving higher, I have to trust the price. But all the while, I'll have a protective stop. Like, I don't try to overthink things. Ultimately, if the data that you mention is so important, it's going to be reflected in the price. And if the price doesn't move, now we have a divergence. And that's the point where you focus on price. You can't fall in love with NVIDIA or AI. Trump got in office and Bitcoin went from 107 to 77. How's that feeling for you? We're going to have a sovereign fund, but we're not really going to put taxpayer money to work. We're just going to kind of confiscate the stuff from Silk Road and keep it. Well, that's a whole different demand equation now.
Doesn't this point to the idea that we should not be paying attention to news because we can easily get swept up in it and it affects our decision-making ability? And we say, oh, but this is the biggest bullish news I've ever seen, I'm going to hold on, rather than just simply let the charts and price action tell you what's going on.
I mean, God has spoken those words. I agree with you 1,000%. You can't get tied up in the story. You know, dude, she likes me. She was texting all her friends. Well, that's what she said, but you know, she might be doing that for 3 other guys. She's swiped right quite a few times. You know what I'm saying? So I can't fall in love with my P&L. I don't fall in love with charts. It's like, show me the money, because it's price action, and it either shows up or it doesn't. And you have to be object. Look, I'm the first guy to get very aggravated if I get knocked out of a winning trade and then have the thing revert, but I'll just always buy back in at higher prices. Like, that doesn't bother me. I don't look at like, well, I really want to fall in love with this trade, buy sugar at 17 and sell it at 75. Well, I might get knocked out and be in and out of the trade a slew of times to catch chunks of the move. I don't have to have it be, if you invested $10,000 in McDonald's in 1965, you have more money than Jesus. Well, that's great, but $10,000 in 1965 was an enormous fortune. Most people didn't have it. So you learn to also have a discerning ear. You can learn to hear money. If you missed the 10, best days of the stock market, here's what your returns would have looked like. But what they don't tell you is that things like that happen in clusters, and the 10 worst days were also close to the 10 best days. So you'd have to have the worst damn luck of any human being who ever put money to work in the market to only miss the up days and not miss the down days that kind of went with it. And if you look around September 11 or what happened when we all got 2020'd, when COVID hit the tape, you can see the best and worst days kind of happened in clusters, right? So there's a long-winded way of answering that question. You have to stay out of the news and learn that your job as a speculator is, in single sentences, to play superior defense. I don't believe the winners take care of themselves. You have to show up and win, and you have to know what your appetite for risk is. But if you're going to try to do this in any asset class, the goal is to keep your losses small. Focus on playing defense. You want to think about being Lawrence Taylor, not LaDainian Tomlinson, the other LT, or whoever the big running back is of the day.
Great. So to wrap things up, is there anything on the horizon lately that excites you?
Yeah, I mean, I think, certainly fundamentally the stories of the day with, not Fartcoin and that kind of gimmicky meme stuff, but I do think there is probably some promise in and around some of the crypto things like, Cardano, Ethereum, certainly Bitcoin, and having a codified body of law like we had in the 34 Act in the 1940, the 33 Act, the 34 Act, the Investment Company Act of 1940. You had, SIPC, and you also had, ERISA. All of those landmark types of laws that were codified, they give everybody a level playing field, right? So I'm not Joe Crypto, but I like the idea that for that space, the regulatory environment seems to be kind of coming of age, right? So that's a good thing for the market. It's good for people. It's good for investors. I like the idea of, we're still very early in AI, in that most people, if you talk to them on the street, and I know that doesn't sound scientific, they can't tell you where AI shows up in their life. They know if they are on a website and they're having trouble, they have an AI bot, and that's the extent of it. So I'm excited to kind of see what that brings to the table. But the stuff that I do with Victor Sperandio, our strategy has a negative 66 correlation to the S&P. And it just brings into sharp relief that diversification is absolutely important for everybody, whether you're a trader or an investor. And, those are all things that you can determine before you even put money to risk is what are you going to trade? How are you going to trade it? Know yourself, put some time into knowing yourself about how do you feel about making and losing money? How do you feel about being right or being wrong? Being right, making money, losing money, being wrong. Like, it's not a reflection of your intelligence. It's a function of being, having good luck and good timing versus bad luck and bad timing, so there's a lot that goes on there. I'm excited, for people to kind of focus on that and learn about themselves, because if you don't know who you are, I don't think it really matters too much what the hell you know, because you're never going to be able to turn that into money. And as trading is experiential, the best trader coach is you're actually doing the trading. And that's coming from a guy who's done some consulting and coaching on the side, right? The best way to do it is to just say, do it. I'm going to risk $100. And that's how I'm going to learn my craft, because that'll calibrate who you are with what you know how to do for that period of time in your life and get you going towards the results that you think that you want.
Well, these are great wisdoms you've shared with us, Michael, and I would like to thank you for coming on Chat with Traders.
Yeah, I feel very grateful. I know you've had some really great people over the years. It's a legendary show. Everyone should really make it, if you're looking to trade and learn your craft, spend a lot of time going through these interviews, because it's really a who's who of trader excellence on this channel.
Fantastic. How can our listeners reach you?
So at Trader Mindset, there's a I can give you a link if you want. I wrote a book in 2011 called The Inner Voice of Trading, and I give away the audiobook version for free just to kind of help people. I can give you the link. You can put it on it's basically tradermindset.com/CWT for Chat with Traders. It's free. You can just go get it and download it.
Fantastic. Yeah, thanks for coming on the show.
Ian, great interview, man. Thank you very much for asking really interesting and very challenging questions. Really good.
All right, great.
Hey, Michael, that was awesome. Lots of great golden nuggets. As you were talking, I had a few questions that I wanted to ask you. Actually, I had 3, but maybe we only have time for 2.
I have all the time in the world for you, so just...
Okay. All right. If you had to start over in your trading career, and if you can choose only one thing, what's that one thing you would have done differently right away?
I think I would have started my own company a lot sooner, knowing what I know now, and even borrowed money or got backers to grub stake either a trading account or to capitalize my firm, to just go out on my own. I'm pretty much a lifelong entrepreneur, and I had to learn somewhere, so I don't regret it, but I could have had more efficiency if I had gone out on my own sooner. But it all happened for a reason, and everything was a learning experience. So I'm not a person who has regrets. Everything played a part in my evolution as a human being. There were certain people I didn't like at the firm, but you have to take the thick with the thin and just focus on what of it can you actually use and keep moving forward.
And what drives what you do now?
Philanthropy. I've already gone through the wealth accumulation stage. Obviously, I'm still making money, but now it's like you want to have a full karma bank. So on the low end, I give away the audiobook version of my book. It's well over $1 million worth of audiobooks value. If you charge, say, $30 for a book, that's what they tend to go for. It's not about trading commodities or whatever for all these fat cats who already have an enormous amount of money. It's more like, how can you help nonprofits, foundations, endowments be around for like the next 50 to 100 years, right? So that they can go execute their plan, right? So that's kind of the role that we play there. And then with my own money, what can I do to give money away in philanthropic causes to help people put a little wind in their sails.
You're truly inspiring. I'm so glad that I checked out your YouTube channel. As I told you last time, I'm an active trader, and I was going through some mindset issues, and so I was searching for some content that would help me. And so I found you, and I found that you have this really real way of speaking and speaking from the heart that just really like clicked with me, resonated with me. I'm sure that many traders would feel the same way. So I just want to say thank you for your philanthropy and for your contributions to the trading community.
You're welcome.
Yeah.
I'm glad it helps. I'm glad you found it and that it has meaning for you. It's all, an evolution. So as long as you're clear about where you want to go, I'm pretty sure you're going to get there. It's just like, do you have the clarity? That's really what it comes down to. I always say, like, in the masterminds that I run, or from time to time when I do one-on-ones, the first thing we talk about, they're like, what about sugar and should I be piled into cotton? I'm like, we're not even going to talk about that. We're going to talk about the clarity of what vision do you have for yourself, because you have to see the point B. If you're at point A, you have to know what your point B is. Even if you don't know how to get there, you have to have that vision. So I think if you have that vision for yourself and you can see yourself being a certain type of a trader, that'll likely, your behavior is going to kind of converge to where it needs to be so that you can get where you need to go. That's how I've manifested almost everything in my life, is to envision being somebody like a completely different person.
Yes.
Like almost having an identity crisis about it too. Like just being a completely different, like, doing things out of character. Like I had, when I was, first going to Wall Street and starting to do well for myself, I had people from my hometown who, I don't know that they had envy, but they were kind of like, look, you're a hometown kid from New York and your dad was in a labor union. What are you going to an Ivy League school for? They used to say something like, it's a very New York way of saying things. They could go, check out Martin. He thinks who the hell he is, which is a way of saying Martin's full of himself. They'd be, check out Martin. He thinks who the hell he is. And I'd be like, I don't think who the hell I am at all. I'm just pushing myself to achieve, higher levels of achievement based on my abilities. There's no sense in slacking off or not using any of the gifts that God has given me. And if I fail, I know I could come back and be you easy. No, I didn't say that. That would be arrogant. But that's where my mindset was, is like, why would these people just want to coast through life and not push themselves? Like every day, I'm not saying push it in the market or push risk, but a person has to have goals every day and take steps. Even if you don't know what step 2 is, take a step, hold one mini or one micro contract overnight just to see what it feels like. Or, buy an option contract and hold it overnight and just kind of see what it feels like, so that you could learn to manage your emotional intelligence around managing risk, right? Or investigate, why do you take your winners too soon? Like, what would it mean if you had
fear?
Right, but a fear of what though? Like, say you had a trade, it was up $200, and then it came back and it was flat. Like, what would that actually say about you?
Yeah.
To me, nothing, because markets move. They go up and they go down. And it's not necessarily a missed opportunity, because a lot of times that's what happens with trades. They go up, they go down, then they continue their move higher.
Yeah.
But that's your journey.
Another thing that I really got out of the chat you had with Ian is that I think is actionable is don't overthink things. Like you said, don't overthink things, and basically to trust my process and be good at executing.
Well, this is true for life too. Like there's so many overlapping tenets for trading that really apply to life, and that's focus on your process and kind of stay out of the results, even, like, because a lot of people do what's called resulting. The thing with resulting is we have, you could go on and put on a real reckless trade, make a ton of cash, and then look at that and be like, man, this is easy. Like, that's how you do it, because the result was favorable, right? So you go back and validate the process, which was really reckless behavior. There's even other things that are a little more subtler, like you put a trade on, but you don't have enough risk. So it does make money, but you made money and you're like, okay, so now you're coaching yourself to kind of get used to being a small winner. And that becomes a mindset. So because you're validated about the accuracy, like this is a thing that really smart people, if they went to good colleges or, they were just very good students, they're really tied up in the accuracy thing because it validates who they are. It's what they're used to.
Right.
So it's very difficult to get out of the accuracy game and start to think in terms of expected values. Like what would happen if you had utter academic failure at, say, 40% accuracy, but your winners were 5 times the size of your losers? Like that's someone who's going to make millions of dollars. So that's why I think like begin with the end in mind. Who do you want to become? What do you want your money to do for you? Is trading just a vehicle to validate your intelligence, or is it a vehicle to make ungodly sums of cash? Because that's what I wanted it to do. I didn't want to be broke. I was tired of being like living, I was 2 or 3 months ahead of my bills, but that was it. Like I had enormous fear. And I was in New York City where everything is $20, I mean, it's like so.
Yeah, you brought up the accuracy thing. That's exactly kind of what I'm going through right now. I'm probably 83% win rate, but my reward to risk is very low. It's probably because I'm taking small wins. Yeah. And so that's a good point.
Are you taking risk home overnight at all?
No, I'm scalping.
Okay. And so you asked, okay, Tessa, so I don't give unsolicited advice. I've always thought unsolicited advice is a form of criticism. But I was in a spot in my life like this as well because I wanted the validation, right? I wanted to be able to call myself a trader, because trader presumes that you're profitable, right? You can't say after 5 years, like I'm a trader and you've done nothing but create tax loss carry forwards for people. Like you actually have to make money. So there was the time where that validation really meant something to me as a human being, as a guy, because like every guy, I have a fragile male ego, right? So I wanted to have that badge, if you will, that social proof that I was a profitable trader. But profitability too has to be operationally defined. So one of the things that I did was I looked at my P&L and I said, okay, I've made X amount of money on this trade, or I made X amount of money this week. Divide that by minimum wage. And that's how many hours I would have had to have worked to earn that money. And so that's like a little trick that I used to use to coach people so that they didn't get excited. If you could work at Chick-fil-A for $20 an hour and you make $200 trading, like that's a 10-hour work week. That's something that you could do in the physical world. So the trading part isn't really exciting. Now, if you're pulling down 5K or 2,000 a week, then you divide that and you're like, okay, that's a 100-hour work week. That's really not something that I could do and sustain. So now I know I'm leveraging my time because I'm bringing out of the market more money that I would have to work at a salaried job somewhere, for example. And I'm my own boss. I could work from home. I could talk with Michael Martin on the camera and not go on camera. Does my hair look okay?
Yes.
I just went to Dry Bar.
Yeah, good point there. Lots of things to think about, but overall, I feel like I'm progressing. So yeah, it's just,
and that's huge. Like you really have to love yourself in all of this because there's nobody to really do it for you. I don't mean to cut you off. Like feel good about where you are. You're doing a great job, and it's all, as they say, progress, not perfection. Love yourself. You're doing very well.
Thank you.
If they didn't carry you out of the game yet in a body bag, you're doing better than most. 95% of the people lose money. That's 19 out of 20.
I don't want to be in that 95%. I work every day to not be in that. Like seriously, I work every single day to not be in that 95%.
You just want to be aware of your behavior because the behavior is going to carry you or not to where you think you want to go. And usually you'll come to a crossroads and say, man, I'm putting in a lot of work, but I'm not getting the results. So something has to change. And it's like when managers would go to see an employee that wasn't producing whatever they had to produce. There's a kind of play on words. They say, you either have to change the man or you got to change the man, right? Meaning like, okay, here's what's not happening. Here's all the resources we can give you to help you. Here's when it has to change by, and here's what's going to happen if it doesn't change. Like we're going to reallocate you to another department or, you're going to be out of your job.
Right.
And so I would have those conversations because I already by the time I got to Wall Street, I was in my early 20s. I had worked since I'm 12. So physically I was exhausted from working.
Mm.
And that's not a complaint. It's just the reality. I had started working and cutting grass in my neighborhood and trimming hedges when I was 12. And I had, not in the middle of the school year, but there was really no time for me to not work. I would do things and pick up a $10 job on a weekend by raking somebody's lawn, or I'd help somebody move furniture. Like, I was that kind of guy Friday who would help people in the neighborhood. And then, when I started to drive, I did that. And then, I kind of said, okay, for all the work that I'm going to do, I want to make sure that I could make the most amount of money. So I did things like I delivered flowers, and they were like, okay, you're going to get a lot of tips. And I didn't. And so I was making minimum wage, but I wasn't making any tips. So I was like, okay, I have to up my hourly rate. Where can I make a lot of money? So then I thought, like, okay, waiters can make like $100 a night. So I said, oh, that's pretty cool. So I just started applying to restaurants and working as a waiter. And I got in remarkably with no experience. And then same thing with golf caddying. And then, so then after that, when I made a lot of money, doing those jobs, I was like, okay, now I have to figure out how the other half live. I need to figure out a way to use my brain. And I remember exactly where I was on the exact day of the week. I working at a restaurant in New York in Westchester County. The name will come to me in a second. The place was called Traveler's Rest, and it was a German cuisine place. So they had Wiener Schnitzel and all that kind of really good German food, if you like it, dumplings and this and that. And Millwood, it was in Millwood, New York, on Route 100, which is kind of right in the very Tony part of town, Westchester County. And we were also open on Monday nights. Most restaurants, in the fancy ones, were dark. That was like their day off. And I remember it was a Sunday, and I was setting up tables at, because we would open at 1:00 for like an early lunch. And I was there probably 11:30 setting up. And on the music system, they had Yesterday, a song by the Beatles that Paul McCartney wrote. And it was like the Dentist Muzak elevator music version. It wasn't Paul and the Beatles, but it was a stylized version with, violins and
Instrumental.
yeah, exactly. And I remember thinking, like, man, Paul McCartney's getting paid for this now. He wrote the song once in the 60s. It's 20 years later, and he's still getting paid. Like, I got to figure out how do I get paid for not working? Which sounds ridiculous to a working class person. But when you think like a business owner, it makes perfect sense. So I had to approach trading in a way that, how can I trade while not being there? How could I treat trading like a business that I own, that I don't have to manage? So I can put in my stops and walk away, because the clearing members have every incentive to want to, execute my trades for me. You know what I'm saying?
You know what I noticed, that you, like, all along your journey, it sounds like you ask yourself all the right questions all along. Like, I think most people don't ask and think about.
I always had an inner voice. Like, I always was very reflective and meditative and spiritual. So I always kind of thought things and say, what's not right in the world? What's not right with this situation? I'm feeling energy from people. And I always listened, not just for what they were saying, but how they were saying it. Like, what did they want? What were they trying to convey? And then ask myself really good open-ended questions, not these endless loop, like, why does this stuff keep happening to me? Like, that doesn't go anywhere,
I have to stop doing that sometimes.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
a new pool, time and effort.
Risk analysis podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
So how often do you encounter traders who, say, learn a lesson in a particular market regime, like a particular type of market, and then time goes by and then they forget that, or they ignore the lessons that they learned in the past? Like, for example, during the COVID time when we had that huge drop and the VIX goes up and they learn all about volatility, and then some years later things calm down. And how frequent have you found where traders forget the lessons they learned in the past or discount them and think, well, maybe this time it's different?
Really good question. I think everyone is guilty. Me also. We can
Really? How so?
Because we can take lessons every single day from the market, and we find something where we exactly know, oh, stupid, why I'm doing this. So I give you some example from my trading.
Markets, speculation, and risk. This is the Chat with Traders podcast.
And we meet again on Chat with Traders, episode 300, nice big round number. We should not die as traders. Hey, what's that all about? Well, guess what? You'll find out. This is Tessa, your co-host, and I'm really thrilled about introducing today's episode because this guest is special to us. We first discovered him in our own online Chat with Traders community about 2 years ago when it was open. 2 years after first appearing on episode 260. If you missed it, you can listen to it. This intuitive, price action, news-based scalper trader who breathes in and out. The market is back. Yep, it's Patrick Peterson with that unmistakable voice, and he's back to chat with my co-host Ian. In a refreshingly blunt conversation, we get to catch up with Patrick and see what he's up to these days. Patrick shares, in a very real way, practical, real-life trading topics and issues that traders are facing today, including the psychological and practical challenges of trading, the role community and engagement plays into one's trading development, and, coming out from isolation into collaboration in his own trading evolution. He shares a lot about the importance of community and also his thoughts on current issues like the sharp divide between traders risking their own capital and those cycling through prop firm challenges. And he talks about also how there's no shortage of tools, but there are real shortages of real, honest guidance for traders and so much more. Also, don't miss my little catch up with Patrick towards the end. All right, let's get straight to it. Ladies and gentlemen, we're so thrilled to welcome back Patrick Peterson, originally from Germany.
Hello, everyone. This is your host, Ian Cox, here at Chat with Traders. And about 2 years ago, in episode 260, I had the pleasure of interviewing Patrick Peterson, an intuitive, news-based market action trader who took money given to him by his parents with the purpose of buying a car, but instead took that money and started secretly trading after opening his first trading account on his 18th birthday. Patrick, welcome back to Chat with Traders.
Yeah, welcome, Ian. It's an honor for me to be here, and thank you for having me here.
Fantastic. Yeah. So when I last interviewed you in 2023, if we could go back to that time and if you could give us kind of a historical update on what you've been doing and learning since then.
Wow. So it may be 2 years, but it feels like 20 years. So there's so much going on. And everything is starting with the Chat with Traders community. Everyone knows it. So we was making the decision after 1 year that we closed this. There was some good reasons for this. Then the life after. So I found a new community It's the Mentor Q community. Now I'm being a business partner from Mentor Q. And I'd be honored to be in the community, to be the mentor, to develop also products for traders, to give all my experience there. So that's basically what was happened the last 2 years. But behind the scenes, there's so much more going on.
Yeah. And so prior to being involved with the Chat with Traders community, did you have much experience interacting with other traders in other communities in the past, or had you been kind of more go it alone and just trade by yourself and not have
no,
that many
I'm
people?
only an lonely wolf. So I'm lonely one. But since I was joining the Chat with Traders community, everything was changed. As I told to Tessa, I think everyone knows the story. I can tell this again. So
Yes,
I was never speaking to some Asia people. This was not normal for me, or to have friendship with let's say Black people. So Black people are now my best friends. So
wow.
this was something what was happened in the Chat with Traders community. So to be open for the worldwide. So we're having friends in Australia, we're having friends in Africa, we're having friends in Brazil, we're having friends in Canada. I was meet Steve, by the way, in the Chat with Traders community. He was also on your podcast. Big shout out to him. And also, this is something what was life-changing for me. And I can tell everyone who's listened to the podcast, go in some community, find something where you can find your second home. Having good friends around you who support you as trader, who challenge you as trader, who becomes accountability to you, who are helping you to grow. So be strong as a team. And this was something what I was learning in the Chat with Traders community. I was never be a team player, but since Chat with Traders, I am.
What was it like being in a community and transitioning to a team player? Tell us, what did you experience with either what you heard or read from the other team members, and then what you suggested as well to them?
It's about the problems what traders have, I think. Every trader has some problem. There's no trader outside who's perfect. Everyone has something who he struggled with. And basically
even you?
And everyone, Ian, I can tell you struggling with the same stuff what I'm struggling, but on a different way. And the cool stuff in the community is I become the experience from you and you become the experience from me. I see your view of this problem and you get my view on this problem. And that's the opportunity where we can grow together as a trader. And this was something what was so helpful. And in the moment where I was understanding this, sharing my experience with the people, I get feedback from the people. They say, hey, that's amazing what you're doing. I'm struggling with this. I'm struggling with this. And then I was thinking like, hey, I'm struggling with the same, but on a different way. And again, that's something what is so powerful in the community. But to be really honest, I'd be a little bit pissed off. So I'd be a straight shooter, as everyone knows in the episode 260. I'm really pissed off. If you're looking into the community world, there's so many bullshit going on. So many people posting only his porn P&L. They're saying, hey, I was making 4,000 US dollars. I'm making 5,000 US dollars. They putting on some charts and all this stuff. But this is not really what helping the people. So I can tell you, I have now a 5-year son and I teach him to trading. And he asking me every time, hey, daddy, why? Why are you going long? Why are you doing this? Why? And for him, I must explain this to him that he understands this with his 5-year mind. And this is something what I'm missing in the community world and also from all experienced traders, because there's so much bullshit going on. I give you one example, what was really triggering me the last few weeks. When we're getting the terrorist news, the VIX goes really crazy to the upside. As everyone knows, everyone was speaking about, hey, the VIX is going crazy. There's so much volatility around, but no one, but maybe there was some people, Also, I'm guilty also. No one was there and teach the people, maybe the new ones or people who are not so experienced with this. Hey, what is this meaning? What is this meaning for your trading? What is this meaning for your risk management? What is this meaning for your position size? What is this meaning for your take profits? What is this meaning basically for your trading approach? No one is talking about this. Everyone is talking about the mathematical, the trading perspective, but no one is helping the traders outside. I can tell you there are not so much people outside who are understanding the VIX, how everything works. And they don't need the mathematical. The only thing what they need is, hey, if the VIX goes to this, be careful, then you can do like this, you can do like this. Give them some really handoff, like as I teach this my 5-year son, hey, I told my son, the VIX is now basically on 50. We will not trading. Our only setup is we're waiting that the VIX comes down, because if the VIX comes down, we can make so much profit and we will not be involved in the volatility, and we're waiting carefully, be patient. And then I teach them how to be risk management, what we should do. We're going only little tiny small size, because this little tiny small size making us so much big profits. And this is something what I was missing outside, that people teaching other people what they should do, and in a really simple approach. I don't know, in the marketing world, there's something what people saying always. There's some approach, and they saying, hey, basically, if you cannot sell this product in simple words to your grandma, then that's bullshit. And it's the same in trading. If we cannot teach a 5-year son or our grandma about the VIX, what they should do, then it's bullshit. And this is something where we should be all people thinking about to make trading a little bit easier to understand outside for the people. And basically, now you trigger me, and basically for our kids outside and for the young people, there are so many young people who are getting distracted in the social world. They have no really fun anymore. They playing I don't know, computer games, or they're doing bullshit basically. But we have now the opportunity to go to the young people and teach them trading, teach them how they can become maybe in 10, 20, 30 years financial free in a really simple approach, and teach them this like this, that they really like this, that they enjoy this, that they're feeling fun to trade, that they're thinking like, hey man, that's exactly what I want. This is what I can do, and bring them from the streets, bring them from the hood. Don't teach them how to sell any bullshit on the streets. Teach them how they can make money on legal way in the market. Teach them this really simple. And then we can save so many lives. We can make so many people in the future financially independent. And this is something what I was learning also through the community, because people liking the simple approach.
So what is it about the VIX? I mean, a high VIX means there's high volatility, and don't traders thrive on high volatility opportunities? I mean, isn't having a high VIX actually good for opportunities?
Okay, I will make this as simple as possible, because I don't want to explain the VIX. I'm not good in this. I know the terminology, but I'm not good in this, to be really honest. But the really good example is if you was trading on the high VIX for a few weeks when we get the tariffs, Donald Trump, everything was going on, everyone know it. If you was trading the ES, basically you have the feeling you're trading the NQ. So because your P&L was running very crazy to the upside and to the downside. That's basically high volatility. If you trading normally, like, for example, 2 ES contracts, and the P&L is not rising so fast to the upside or to the downside, but with high volatility, you can have huge moves to the upside and to the downside. Looking to the downside, risk always first, so you can lose so much money. And if you don't know it, what you should do in doing high volatility, that's badass, and you lose so much money and time. And basically, if I was trading the NQ, I'm trading mostly the NQ. I was feeling like I'm trading the Bitcoin, like the numbers going crazy to the upside and to the downside. So what I should be doing, I should be now reducing my exposure, thinking about no more trading the futures, maybe trading now the ETFs, because I save capital, I save exposure. I'm not going so much in the drawdown, or take back from the market and come back when the volatility comes down. So basically, this is something what happens in high volatility in simple terms. Because on my side, where I know so many people taking so many losses, so many blow-ups during the last few weeks, because there was not experience with this. And this is something what I mean, basically. This is why I'm also guilty, not teaching them, hey, if you see something like this, be very careful. This is meaning you can make good money, but you can lose very fast. And this is no more fun. This is really like trading now, not your size, what you're doing normally. Take it a little bit step back. So this is what I mean. Teach them this basically. What does this really meaning? We can now going into mathematically stuff. What is the rigs and why everything is changing? But this is not what the people helping.
Wouldn't many traders just come back and say, oh, well, whether it's low volatility or high volatility, as long as you have your stop losses in, it should be the same, right? I mean, why does it matter? I'm protected with my stop loss order, right?
Stupid. Oh, stupid. For example, okay, so on high volatility, you have your normal stop loss. Let's say normally if your stop loss will be hit if you be wrong in 10 minutes, 15 minutes, depend on your trading style. But on high volatility, it can be hit in 1 minute. And there's the question, do you trading your normal style with your risk approach and you get hit in 1 minute very fast? And if you was hitting first time, then you will go again. You will hit again. You will go in again. And then the mind comes into play. What is the mind telling you? You say, no, that's impossible. What's going on? And you're taking bigger size because you want taking your losers back. And then, boom, it's happened. You blow up.
I see. So are you saying that during periods of high volatility, when a trader gets stopped out easily and quickly, that there can easily be the tendency for them to maybe want a revenge trade to get back to recoup their losses?
Yes. So I was observing on the NQ during the high volatility that one candle have an average on 1 minute or 2 minute time frame from 100 points. That's crazy. So basically, you're putting the trigger and you can immediately in very good profits or you're losing. So that's something what is really bad. So if you're trading your normal size, so that's why it would be better to teach the new ones, hey, if you see the VIXs on level like this, take care of your risk management. Don't trade your normal position size. If you're trading normally the ES, let's say 2 contracts, go into MES or go into the ETFs or take a step back and wait maybe 1 week before everything becomes calmer. Because the risk is too big. You can battle on this, but there's a high chance that you're taking stupid losses.
Wouldn't some technicians, people who just follow the charts, argue, well, that's not a problem. I mean, whether it's high volatility or low volatility, you can read everything in the chart, and I'll get close to the bottom and I'll buy there and go long. What's there to worry about? We could just follow your indicators, right?
Yeah. So the only thing where you should be worried about is the average candle. So let's say, so the normal average true range, if we're speaking about the ATR, let's talk about the ES on the 5 minute would be between 5 and 10. So Nothing is big. Nothing is crazy. Everything is fine. But now we have an average true range of 50 points or 60 points. That's crazy. That means your risk level is now 10x. It's possible that you can make 10x more profits, but it's also possible that you can make 10x faster losing. And if you not be aware of this, if you don't know it, because you was not experienced something like this, think about what was happening on Corona or when we're getting the financial crisis, how fast everything was going. It was really fast. If you was not acting fast enough, you was in trouble. And that's something what we were seeing in the last few days. Everything becomes now normal, but the few days it was really crazy, and so many people losing money, and so many people having now going back to work, who was before maybe full-time traders. They have now to go into work because they're losing so much money. Yes.
Have you met any people like that?
I was talking to some people. They was really surprised about this.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Because what the people are not doing is maybe they're not looking to the VIX. So if you're trading the ES, you have not side by side your ES chart and the VIX chart and see what's going on the VIX. So you're not possible not be aware, or you listen to something on X or on YouTube or on CNBC, whatever, and they're speaking about the VIX. But they're speaking this in so complicated stuff that people not follow this. They say, let's talk. They're talking about VIX. Who cares about? Whoa. It's really important for you to know it. Because if CNBC would say to the people, take care of, there must be a better risk management for you, you can lose faster money, they will not do this. Why? There's some reason why they don't do it. And that's something where we all be guilty to not teach the people in simple stuff, what is the meaning behind? What is the meaning when the VIX goes crazy to 50 or 60 or 70? What's the meaning? And also, if you see people talking about trading strategies, they're making this so hard complicated that you cannot follow this. So basically, when we're talking about some trading strategy and what people want to see, hey, when I should be go short, when I should be go long, when I should be getting out of the market. And they want this in a really simple approach, like a 5-year-old son or an 80 year-old grandma. They want only know, hey, when I should be pulling my trigger short, long, and when I should be getting out of the market. That's what the people want. Like telling them, hey, if you see A, then you can go long. If you see B, then you can go short. If you see C, be neutral. And then have backtest data where you can say, okay, this is based on backtest data. Most of the time, if A is coming up, it's a good opportunity to go long, and I explain you why. And this is something what I'm doing also. So that's something what I miss. And this is also what I'm teaching when I be live on YouTube for Mentor Q about options data and all this stuff. I simplify everything that everyone can follow this. It's for me, the options world. I'm not understanding the options world, but I know how I can leverage based on the options data. This doesn't mean that I must understand options, but I know exactly how you can use this as futures trade or as a stock trader, not as an options trader. Options trading is completely different. So that's something what I mean. Give them really simple approach, help the people outside. And that's the big goal I think everyone should do.
Why do you think it is that the financial media, when they talk about the high VIX, why don't they teach traders and their listeners on, oh, we make sure you do this and don't do that. Here's what the high VIX means and position sizing and all that. I mean, you would think it would be simple enough for them to explain this, right? Why do you think they don't share that?
Okay, the other question. So because I don't want to bring Sheffield traders in trouble. So we can also speak about the casino when we go to Las Vegas. Why the casino owners don't tell us if he was making some good profits, go away and not play again. Why they don't teaching us this? Because at the end they will win. They were making his money no matter what. And now come back to CNBC. Why they should do this? So who supports CNBC? Look into who is the owner from CNBC, who supports CNBC. Did they have some interest in the teaching you what you should do when they make their money? So basically, there's no interest.
So the traders who say got hurt recently, just within the last number of weeks with the high volatility, in your experience, are the vast majority of these traders pretty new traders that weren't around during the COVID crash that also had high volatility?
It's mixed. So they are new traders, they are experienced traders, people who forget. And most of the time, I think it's also lack of education. So did the people doing really his homework, did they invest something into become educated? So did they read something? We can make it really simple. So every trader outside can make it so simple as possible. If I'm not understand something what other people saying, you can use ChatGPT. You can say, you put in what they're talking about, give them only some topic, and then say to ChatGPT, hey, ChatGPT, please explain this to me in a simple and easy language. And then, hey, give me some example who's maybe not trading so that I can understand this better. And then they give you some storytelling information. And then you say, oh, now I'm understanding this. Why no one was teaching me like this? So simple. Why there must be everything coded and no one is understanding this? And that's something what I'm thinking, like education, it's the part of but for us who have maybe communities or who I say a little bit influencers or who have some product owners or prop firms, think about why you're making your product not a little bit easier, why you not explain a little bit more, why you not simplify your trading approach that everyone can follow this. And if I can say something, I can shut out something, and this is SMB Capital. SMB Capital and Bella, you know Bella, he was many times here. They make this also really simple for the people to understand trading strategies, what they're using on the trading desk. And this is something when I talk to people, hey, where you was learning trading? Yeah, I was watching YouTube. And if they talking about SMB Capital, everyone knows SMB Capital. And why? Because they explain it so easy that everyone can understand this. And that's something what we all have to follow, I see. And that's so crazy. Why we don't do this? Because people want to sell online courses. People want selling overpriced products. People want selling mentorships. And then you're buying the online course and you're thinking bullshit. They're talking bullshit because they don't know something. So basically,
so go into that more. I mean, to give them potential benefit of the doubt, couldn't we say, well, heck, I mean, how do we really know that what they're peddling is bullshit? Like, what is it that they communicate is nonsense, and how would a viewer know the difference between a channel that is communicating true facts and those who are total exaggerations?
Really simple. So before you buying some online course, buying some mentorship, ask the people for a verified track record where they trade his own money, not prop firm money where they have certificates or other accounts. No, I want to see that they're trading his own capital. So, and then that they're doing this for minimum 5 years. So, because why I'm asking for 5 years? Because then I see how they're reacting on bad times. Everyone can post, hey, I have a Ferrari, I have I don't know, whatever car, I have this. But this is something what I don't want to see. I want to see how you was reacting on bad times when you was drawdown from 10%, 20%, what you was doing, what was your approach. And also I want to see that what you're teaching me, that you're doing this on your own end. Not like, hey, I'm teaching you this, but I give a shit about this. I don't do this.
So tell us, what's wrong with having a verified track record from a prop firm? What is the difference, say, trading with a prop firm versus trading on your own?
So basically, I will never bullshit any prop firm. Never. But what I really not like, if people are asking about mentorship, if people are asking about online courses. So you know it also, Ian. So you can buy a challenge for, I don't know, $50. You get an account from 100K for futures, and maybe you will lose the first challenge, correct? So that's maybe possible the first step. You lose. And then you take again the challenge, you lose. So basically now you're having losing side. And then you're getting the funded account. You lose your funded account. And then maybe you have to start the challenge again and again and again. And it takes you maybe, I don't know, 2 months, 3 months, 4 months, 5 months to the first payout. And then they're showing you, hey, I have now the certificate. I'd be a good trader. No, Shem. If you would do this, what you're doing on the prop firms, on your real account, you will be broke because you get maybe 10,000 US dollars payout, but you was losing before 30,000 US dollars because on all the accounts, what you're blowing up. So basically, you're not a break-even trader, you're a losing trader. And that's why I want to see that they're trading his own capital. Because you will never doing some bullshit like this with your own capital.
So are you saying that by trading your own capital, you will be more careful, or you'll do something, your habits will be different than you will be with a prop firm? Oh, yeah, please explain.
Yeah, 100%. I can give you an example.
Yes.
There's some really good friend of me, and Tessa knows him also. I will not name him. It would be unfair. But let's talk about some person. So this person was invest for, I don't know, 1 year or the last year or for the last 2 years, over 50,000 US dollars in challenges for prop firms, activation fees, challenges.
Wow.
And he was blowing up I don't care. It's like, let's say minimum 50 times or 60 times. He was losing an immense of money. So on the prop firm, so on the trading simulation, he was losing big amount, but he gained experience. I know he gained experience. And now he after 2 years, he's profitable and he have regular payouts like 3,000, 5,000, 10,000. Now he got it. Nothing is wrong with this. But if you want doing this on your own private account, and I want to see your track record from the last 5 years, and I would see that you're losing before maybe 1 million, and don't get me wrong, and now you're getting a payout from, I don't know, 20,000, 30,000 US dollars, I will not take you seriously. Because you debt like for, I don't know, it's a big debt. So you're not break even. And this is something what I don't like. But this doesn't mean that they're not experienced. But for me, they don't qualify for mentorship or buy or selling courses. So that's why I like, for example, Bella from SMB Capital or the other crews, so from SMB Capital. So they dealing with real investor capital, with real money. They're doing this every single day. And they have strong rules. They cannot do this. So, and if they having a verified track record, yes, they have a verified track record. And this is a big difference. If you trading with real money on real market condition, and that's really real money, or you're trading for a prop account, where 90% of the time where you're trading with, it's simulation. It's not real money. You're trading a trade simulator. And you will tell me you was making money on a trading simulator? But you have to go into the real market, put on real money, put on your money, and tell me that you're making no money. Or maybe if you have not money, maybe some family, like look into my story. I was using family money. I go all in. So basically, I was not battling on some trading simulator. I was directly going in the market, no matter what. And that's putting real money in the market. And that's something what is completely different.
Well, you know, why does it matter? I mean, as long as you're earning money, whether it's on your own account or in the prop firm account, isn't it just, I mean, it's just another different way of making money, right? I mean, if you have a chance to say trade with a prop firm money and you get to use their money, so hey, at least I'm not really risking much of my own money, and I get this extra kind of leverage, so to speak. Isn't that kind of a positive thing? And wouldn't the prop firms actually want you to do well? And so if you fail, say the first challenge or something, they'd have all this education and help you out so that you can improve. Don't they want you to be successful?
Oh, that's a good question. I think we have to make a really difference between a real prop desk. A real prop desk for me is like SMB Capital, for example. There are also other ones, or educational firms. So basically, they are not real prop desk. They are only education companies. And if you will be asked them, hey, you are real prop desk, they will say, no, we are educational. So we helping you to grow experience without risking your money. Go into the fine prints. You will see it. And the question, what you're asking me is, let me rephrase the question. So if we have some problem on our heart, yeah. So there's some doctor, he was never making any operation. He was only simulators on robots and everything like this for 10 years. And he's very successful with this. And then you have the other doctor who's maybe 10 years operation on real human. Who will trust more? The guy who was making this on robots or on the humans? I think the answer is the guy who making the operation on the humans, correct? So, and it's the same with this. It's exactly the same.
Is that because there's the quality of putting your own money on the line does it make you learn faster, or is there, because psychology, I imagine psychology is a huge part of this, right?
Mm. So we have also to think about this. So people on the prop firms, if they get funded, if they're getting the payouts, like say they're getting the payout from 10,000 US dollars, how often they get the 10,000 consistently? Did they get consistency, the 10,000 month by month by month? No, mostly not. With the same account number. Don't get me wrong.
Mm-hmm.
So basically they get one payout. If they're lucky, they get the next. If they're really super good, they're getting the next payout. Mm-hmm. And then boom, they will blow up. And they will lose the account. And they will be starting the challenge, going through the same process and again. So you will not do this on your real account. You will not doing so risky approach. You can do risky approach if you be really experienced, if you have enough capital, if you have enough profits. So losing the profits what you make and invest this. So, but this is something I cannot take it seriously. They are really experienced, don't get me wrong, and they are really good traders. But it makes a huge difference to be a real trader or a prop firm trader or an educational trader who came from the trading simulation. And there was also some interview. What I was learning from someone else, he was saying, okay, if you're working on a real prop desk, so you become maybe an really professional trader in 2 years, if you're working full-time with us, because we teaching you all what you need. We helping you. We have the education. We have the mentors around you, and you sitting right and left. There sits some experienced trader around you. You're sitting on a real trading floor. That's completely different. But if you're sitting home, you're getting maybe no education. You're getting a little community. And maybe there's some live stream where other traders talking about something. How you can grow like some real prop trader in 2 years as professional, there's impossible. You need 4 or 5 years. But what the most guys doing, they have 2 payouts, 3 payouts, then they're using the certificate and selling courses. And new traders falling into the trap, buying the courses, and they develop bad habits. That's stupid. We should protect the people for this. Don't get me wrong. Really, don't get me wrong. Sometimes I'm also guilty on my end. Sometimes I'm not teaching really good. I can teach this much better. I know it. But I'm thinking I make a really good job to simplify everything. And that's something what I think is the key. Simplify trading for everyone. If you be a prop trader, all right. If you be coming from some educational firm and you're trading on sim accounts, why not going into the communities and teach them how you become successful, what you're observing, and looking for other people feedback and grow as a trader and enjoy it. And then maybe if you're having enough profits from the prop firms, why you're not using your money and put this in a real money account and trade with the real money account for, I don't know, 6 months, 1 year, and then you can say, hey, I'm the best. I don't need any more of this. And people saying why I should get back from the prop firms. Why not? Because you have a profit split. You give back 10% or 20% from your profits. Why you should do this? If you be a so good trader with so good payouts, man, you can fund your own account and you can trade without rules from other one. You can withdraw anytime and you have no profit share anymore. If you're making every month 100K, there's no reason anymore for this. That's my opinion.
Yeah. In our first interview a couple of years ago, you described yourself as an intuitive style of trader. And I'm just curious, how have you been able to teach the people that traders that you've interacted with? How do you teach them to trade? Is your style of trading difficult to teach? And has your style been modified over the years as you've interacted with others? Because some people are scalpers, some are day traders, some are, swing traders. How do you teach them?
Okay, that's a really good question. So most of the time, my teaching is more like sharing my experience. So if people coming to me, and by the way, I never taking any money from them. If I'm doing mentorship, I'm doing this for free. That's something what I'm doing. The only thing what I'm asking for is for a donation. So basically, if you say, okay, you want mentorship, I will say, okay, I give you my time, but that I know that you take it seriously. I want that you donate, I don't know, $400 to some social project. Boom. And if you donate this, then we can make a deal. So I don't want it. I don't need it. But I'm not doing this mentorship anymore. But this was something what I was doing in the past. But when I'm teaching them, and my trading approach is not teachable for other people, 100%. But people coming to
Why is that? Why is it not teachable?
because well, I'm really instinctable. So if I see something, boom, I take it.
Uh-huh.
And if people coming to me and they have struggled, then we're talking about this. I let the people explain, okay, why you was going into the trade, what was going on, what you were seeing on your chart, and what trading setup you like, and all the stuff. I ask them many, many questions. And then I get a feeling about this, like the same what feeling about the market. I get first a feeling about the person who trade, because there's a big difference if someone is an engineer or someone is a sales guy, because they have different mindset. They're thinking on a different way. So that's something what I want figuring out first. So who's the person? Where they coming from? What is their business? Because they have different mindsets. They're thinking completely in a different way. And then teaching them what I've seen based on my experience. If I would do what I was doing, and why this makes maybe sense based on my point of view with my experience. And then let's connect the dots together, because I'm not a teacher. I'm not a coach. I'm not teaching you how to make the goals. I guide you. That's the difference. I will guide you. I will make maybe visible what you're not seeing. And that's the big difference. I will not teach you how to trade. I want that you let me know what you're doing at the moment, what is good, what is bad. And then with my experience, I will guide you. I will show you maybe something what you was not seeing, or what could be possible, the missing puzzle for you, that you can making the next step as a trader. That's basically what I'm doing. This is what I'm understanding about mentorship. Don't teach them something. Help them, guide them with your experience. And that's it.
Uh-huh. Can you share with us some examples of the challenges that the traders, different types of traders, have shared with you, and how you guided them?
Okay. Let's talk about really simple, about two different people. So one people is, they say, hey, I'm losing always in the morning, and it's so hard to bring back my losers over the day. Okay. So what was happened? Why are you losing all the morning? Let's talk about this. So then maybe you have a 9-to-5 job. You'll be stressed. So, and I don't know, something was happened on your side. What was happened with you? Why are you taking the losses? What was trigger you? What was trigger you to go into the market? So that's something what we have to find out first. What was trigger you to go into the market? Do you was seeing something on the chart? Do you have a trading plan? By the way, do you have a trading plan? Was this your A+ setup? Was there something that was reasonable for you to go into the market? Or was this, hey, I have to trade. Now I'm coming back from my job. I sit there after 5 minutes, boom, and I will pull the trigger because I want financial free. Stupid. So that's now how it works. So then I can guide them and can say, hey, so first we have to work on your time frame. Is the morning the right time frame for you? So let's talk about it. He's a European person. He has 9-to-5 job. After the job, he came to the market. It's American time. It's not European morning, different time zone. So, and he comes back is this the right time frame for you to trade? Because you're telling me every morning you're taking losses. So why we not should change maybe the time frame for you? Why not after you coming back from the job, going first into the gym, reading some book, taking some meditation, doing some other stuff to calm down, and then with a clear mind, taking maybe 15 minutes, read the news, see what's going on the chart, wait a little bit, define some really good trading strategy, risk management, what you will follow, and define what you want to see on the chart before you're triggering something, and then execute based on this. So that's sometimes a really big mind shift for the people, because they're never thinking about this. Hey, it's the wrong time frame. Or I was triggered because of my job. My boss was stressed me out. My wife stressed me out. My kids stressed me out. I'm stressed because I have to make some money. That's something where people very often dealing with. Find out first the triggers. Find out, is this the real time frame? Third, do you trading really your A+ setups? You follow your trading rules. For people, it's so hard to be disciplined and follow the rules. And then, why?
Why is that?
It's really hard. Why is this? So I think it's because they have a lack of discipline in his real life. And how you can be having discipline in the market if you have no discipline in your daily life. So, and then now, why some people taking drugs? Why some people taking alcohol? Why some people not wake up when at 6 a.m. and they already, why some people not taking cold showers? Because it's healthy. Why people not eating healthy foods? Why they're drinking Coke, Cola? Why they're drinking, I don't know, whatever. Why are people eating sugar? People know everything why you should do this, why you should not do this. They don't care about this. They give a shit about this. And now you came with the mindset in the market. And now ask me, why the people are not disciplined? I don't know.
Well, so how often do you encounter traders who say learn a lesson in a particular market regime, like a particular type of market, and then time goes by, and then they forget that, or they ignore the lessons that they learned in the past? Like, for example, during the COVID time when we had that huge drop and the VIX goes up, and they learn all about volatility, and then some years later things calm down. And how frequent have you found where traders forget the lessons that learned in the past, or discount them and think, well, maybe this time it's different?
Really good question. I think everyone is guilty, me also. We can
Really? How so?
Because we can take lessons every single day from the market, and we find something where we exactly know, oh, stupid, why I'm doing this. So I give you some example from my trading. So I was talking to my people, hey, I'm not taking any more and take profit. I have only the hard stop loss, but no more and take profit. Because why? When I haven't take profit and I get a really good news candle based on Donald Trump, based on tariffs news, the market can go crazy and we can go in crazy to the upside. And I will not be the stupid one who haven't take profit there and I'm getting out of the market and I miss the whole candle to the upside. That's completely stupid. And this is something where I have no more take profits there. Because there's always the opportunity every single day in the market that this could be happened. And why I'm be guilty? So yesterday, stupid enough, I was making a take profit. I don't know why I was making a take profit. And then we get in a news candle and boom, I I missed the take profit because my take profit was hitting that. So it was completely stupid.
Well, it sounded like then you made money on the trade, but not nearly as much as you could have because
I give a
of
shit
your
about the money.
conservative nature.
The only thing was why I was not following
Okay.
my own rule. So I know it exactly. So what
Mhm.
you were saying, hey, people maybe was learning the lessons through COVID and they know it, but they're not following this anymore. And this is why I think people never request or they should do it and asking every trading session what I was learning today. What was my biggest lesson for today? How I can become 1% better next day. Atomic habits. Building habits that you can become a much better trader. And we should asking us this any single day. What was my biggest lesson? How I can improve for next day? What is my goal for tomorrow? What I want to see for myself tomorrow? How I should be performed? And if I was make money, I don't care about this anymore. But for me, it's pissed me really off that I'm not following my rule because I know it exactly, but I wasn't following this.
Uh-huh. So is it then a good idea then to have daily reminders and daily review of our strategy or our discipline because it is so easy to forget or let it slide? Yeah.
Personally, I think review every single day, take out the big lesson, write this down, and for everything, rule what you was not following, take extreme ownership. Ask yourself, hey, why I was not following this? So without bullshitting you, like be objective. Okay, because something like this was happened, something like this was happened, something like this was happened. Okay. And then how you can improve the next time that this will be not happen again. All right. So my kids are noisy in the background. Okay. What I have to do the next time, make sure that my kids having some fun and I can trade and they will not interrupt me. So, and then I make sure that this will be not happened again. So taking extreme ownership for everything what you're doing in trading. And there's the book, Extreme Ownership. I can give this as really advice, friendly advice. Reading the book, Extreme Ownership, reading the book, Atomic Habits, and do this every single day. And then you will grow automatically as a trader. If you follow this, what is in the book, you will grow as a trader automatically. And it saved you, I don't know, 5,000, 10,000 for mentorship sessions.
Well, what about for the traders who say that, well, I was following my rule, but I discovered through the trading process during the day that my rule is actually not very good, and I can learn on the fly and adjust it because I'm always looking to improve my rules, and that's why I didn't follow my old rules because they didn't look good at the time, and I'm creating a new rule that's even better, right?
Perfect. You can now ask yourself, okay, why is this better? So not talking about always about the bad things, talking about the good stuff. Hey, why I was doing this, what I was seeing, because this is sharpening your focus for the next time if you be good to know exactly why you was seeing something. And then if this happened again the next time, yeah, I know this was the last time. Now I can maybe possible doing the same and I can change my strategy or something like this. Also ask yourself, okay, what I was seeing, what was triggering me, that I was changing now my trading strategy. And it was good, by the way. And how I can use this experience, what I was growing now, for the next time. And then you can develop also some risk management strategy. Okay, if I see something like this in the future, and I know exactly that this, what I was learned today, should be now taking place, I will do it. So you have a new rule, basically. So you can develop something completely new for you. You can grow as a trader. That's what I mean. Become every day 1% better as a trader. But do you follow this? You really doing this? Become 1% better? People talking to me how I can become 1% better as a trader on my P&L, on my money? No, on your experience, because there's every day some lessons in the market or the lessons on your trades. Find the lessons, looking and searching for the golden nuggets, write this down, improve about this. That's your experience where you grow. And if you don't build experience, how you can grow as a trader? I will share this with you. There was one story what someone was telling to me. He was going into, now let's give the cashiers some little bullshit. Okay. So a woman, he was 20 years and she's a cashier for a big supermarket. And the guy was going into the supermarket, is going now in the supermarket every single day to buy something there for 20 years. And the woman is working also there, and she's now 40. And she's not doing something else as doing the cashier job. Boom, tick, tick, tick. $20, tick, tick, tick. $30, tick, tick, tick. She is dying because she's never improved on his business career. She makes the same job all the day. She's dying. And this is something what we as traders should not doing. We should not die. We should be improved. We should not making the mistake like what the cashier is doing. It's not about, sorry, I'm not bullshitting cashiers, but it's only an example. But they dying. And this is something what we as traders should not do. We should not die. So if we're doing every single day all this same stuff, we're dying. We need some new stuff to grow. We need some new lessons to grow. And we don't want to be the lesson. What is the biggest lesson for traders? And they wake up and they say, oh, what the fuck is going on? Ian, tell me. When they're taking the big loss, they say, oh, what's going on? Why I'm taking the huge loss? And then they wake up and they grow as a trader. Because now they're looking into the trades. What was happened? Why I'm taking the losses? But why not? Why you're not doing this every single day? Asking you what was happened today? Mm-hmm. How I can take some lessons about this? How I can become tomorrow better? That's the single stuff. We should not die as traders. We should be becoming light for other traders to be teaching us our experience. Mm-hmm. Hey, that you can say to other traders, hey, I was going through this volatility and I was learning something like this. And here are my notes. And then you can ask the other people, hey, do you have the same experience? You was getting the same experience like me? And if yes, what you was learning, what you was observing. And then you talk together and you think crazy. You have the same experience. You have a different view on this. I have a different view on this. And now we can change our mind and we can grow again. That's when we're not dying, when we grow as a trader. And that's the part what people are missing. Then we come back to the communities. Mm-hmm. But in the communities, there's sometimes so big shit that people posting only the P&L, the charts, the trade, what they take. But there's nothing interactive that they say, hey, I was taking this experience today. I will share this with you. That's my lessons for today. If have someone else the same experience, and if yes, what I was learning, and maybe you will share this with me.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
Would you be able to share a story, an example of someone that you've mentored who became successful?
Yeah.
Please do.
From the Chat with Traders community. We have really good traders in the Chat with Traders community, but also Tessa knows, and you also, Ian, many traders giving up. Mm-hmm. Why are they giving up? Because it's a time frame because it's the wrong time at the moment. They don't give so much time. And then there are other traders. It's only a handful of traders And I have 3 traders who was going through all the stupid up and downs in the market, and they are now really be successful. The one guy who I tell you, who was investing the 30, 50K in the prop firm board and taking now every single day some payouts from the prop firms. He was someone who I was making accountability sessions with him. We starting and meeting us together in the Chat with Traders community. We was meeting us every single Monday. We was speaking, okay, what you was learning. We was always talking about what you was learning this week, how you can become better, and how we can improve, and how I can become accountability for next week. What's your goals? We was talking about this every single week. And after the Chat with Traders community, we was always in contact. I was mentor him. I was giving him everything what I'm seeing. He was talking to me what he's seeing. And this is one of the best examples. He goes through so hard times. I love him. It's crazy. And now he's taking every single day some payouts. And there's also some other guy. He was giving me feedback today in the live trading room. He says, hey, I have the last few weeks really bad days. And he was showing his bank account statement. And then he say, hey, now I having few good weeks because of you guys. Because first we teach them patience. Don't get triggered from the market. Trade only when you see something. Is this your A+ setup? So we request them. So in the live trading session, of course, you can look over our shoulders, how we trade, but I'm not the guy who is the clown, who teaching you how I'm trading. No, this is something what I don't want. You can go to YouTube. There are so many live trading sessions. I want more giving you guidance and say, hey, I see this, and let's talk about what you see. You get open mic and you can talk to me. And you say, hey, I've seen this. What do you think about that? Oh, nice. Okay, I see this. And then, hey, remind the people, hey, be patient. You have not to go into the market if you don't see it. It's good. And if you're taking losses, take a walk to remind the people, because people need this. They need a reminder, they need sugar, and they need the pressure. That's what I like.
A couple of years ago, when I asked you about your future goals, what would you like to do? And you mentioned back then that you would love to become a big hedge fund manager and move to the US. And as the time has evolved, tell us, how have your desires and plans changed over the last number of years?
That's really good. So, by the way, I get my green card for America. That's
fantastic.
really great. I'm really honored about this. I was working so many years to get this. Now I get this. Yeah, so that's basically my open door for investor capital. Why I want the green card? Because to have access to much more capital, to get the next step into becoming a really good hedge fund, I need capital. But you don't get this if you're not getting the US citizenship or you don't live in the US. So there's no trust in people from Europe or otherwise. So they don't like it. And also there are some rules in America. So you have to follow the rules. And also you get more access to some licenses, basically from the SEC or something like this. What you don't get if you're not an American citizen or you don't have the green card. So that's the next step. But where I'm most proud of it, and this is something what I was telling you when it was meeting us together, it's like how the money is working for you. So the cash flow, that's something where I'm really proud of. So I have not to work anymore because I have my cash flow. Money is working for me. And that's something what I think trader missing. Because let's talk about this a little bit, maybe for 2 minutes or something like this. So if you be an experienced trader, or maybe you be beginner trader and you have a really good payout, let's say from the prop firms that we was talking about, you get 10,000, 20,000. Don't invest this in lifestyle. Don't do this. Don't do this. Don't buy new cars. Don't buy this in commerce. Let the money work for you. What I mean, maybe think about buying some flats We have so many refugees all over the world. They need apartments. And if you're an owner from an apartment, and for example, you're supporting some refugee, you don't get paid from the refugee, but you get paid from the government. That's secure money. So basically, you get every single month money from the government because there's living some refugee. So cash flow, you let the money work for you. Buying an apartment, you rent this to the government or you rent this to some other one. And maybe you're starting with one apartment, but at the end, you get 100 apartments. And then you get every single month, $1,000 for each apartment. Boom, boom, boom. And it's guaranteed for maybe 10 years.
Are you doing this yourself? Oh, okay. And where are you in? Where is this located? These flats that with the refugees.
I have some flats
getting
in
money.
Germany. I have flats in Spain.
Uh-huh.
So, and also there's some other businesses. So if you have apartments, some other businesses like also apartments, maybe the rent is only for a few hours. I will not go in deeper in this, but you can make good money. So you're not involved in this business, but you can make good money. So you're giving them something. Or you're using this money to invest in some startup companies. So maybe there's some tech company where you really like, they have a good trading idea. Invest the money there, give them, and then let the money work for you and you get paid back. Of course, there's sometimes risk. Everything is have some risk. Nothing is risk-free in life. But this is something where you have also no more pressure to get in the market because you get paid every single month like 10,000, 20,000, 30,000, 40,000, 50,000, 60,000, only from the cash flow what you get. And then you get this every single month without trading. And then you can say, okay, now I'm using the cash flow, what I was earned, and fund a next trading account. I'm trading now with the 60,000 what I earned today because I don't need it anymore. And then let's have fun.
So to wrap things up, what are you? Anything that you're kind of looking forward to? Are you still mentoring currently?
I have in the MentorQ community. We have the pro community where we live trade every single day together with the people. I'm hosting this. That's at the moment what I'm doing. Mentorship, I will not doing this anymore because one reason, as you know, I have 2 kids. So they become now more active. My son is now 5 years, will be coming in summer 6 years. He needs more time from me. So, and I will not missing the time to see my kids growing. Because I mentor some people. This is something I don't want. Because my family first and then the other people. And also the big mentorship, what I can give is my son. So other people like professional soccer players, basketball players, like Kobe Bryant. So the daddy from Kobe Bryant, what he was doing with his son, he was teaching him basketball because he was a former NBA player. And Kobe Bryant becomes also an NBA player. And this is what I'm doing. I'm teaching now my son how to make money in the market. That's basically the mentorship, one-to-one mentorship what I give at the moment. It's to my son. And this is why I was talking before. I get so pissed off because people don't make it so simple and explain it in a simple and easy way that other people understand this. And we have a big chance to making the world better. If we making the trading and lessons, what we learned, and simplify this really, really on an easy way, that's amazing. Then so many people can learn from this. And I'm 100% sure, as I said before, we have the opportunity, every single trader, to take out some people, young kids from the street, from all the shit what's going on the hoods, and bring them into the market.
Fantastic, Patrick. Thank you very much for coming on Chat with Traders.
Every time. Thank you.
How can our listeners reach you?
Okay. So I'm, as I said, you can find me on the MentorQ. Go to mentorq.com, and there you will find me. And check it out.
Fantastic. Thanks for coming on the show.
Hey, thanks for still sticking around. Here's my little chat with Patrick. Honestly, Ian and I, but especially me, I really miss you. I miss you and Steve when you were in the live trading room and you were a driving force in the Chat with Traders community. And I hope someday that we can, reopen that and have that back. But it was so great because I learned, even though like I trade so differently from you, I was rewatching some of the videos that you produced in the live trading room, and I was like, oh my, I learned so much from the mindset point of view. And it really made a difference in my trading in the past year. The performance may not show it yet, but the things that go behind it, the discipline and all that, it takes time. It just really takes time. I really think that trading is a game of discipline more than anything else. And that's where I'm at. And I would say that you're my first like unofficial mentor just by, being in the community. So thank you.
Yeah, thank you also. Yeah. So it was my world. Yeah. So the Chat with Traders community.
And now you're in another community making another great impact.
So now that's actually, my world. So
I followed you. And so I followed you to where you are with Mentor Q now. So I'm part of that community too. And I see the impact that you have there. So that's so awesome. And I also want to make a comment about you teaching your son to trade. And he's only 5 years old. That's just so amazing. What a gift. And I want you to promise me that we will be the first ones to interview your son. No one else.
It needs more than 10 years, I think. Yeah. So, but I teach him also the mindset. Yeah. So it's so important. So because now he came to school, I teach him, hey, don't listen to your teachers. That's bullshit. Because if you listen to me and you will become a really great trader, you can earn the school. You can pay the teachers. And with this mindset, he should go to the school. Hey, my daddy tells me I can buy the school. I can pay you. So that's something also, the mindset from the young kids. So it's so different. And if we look into all the professional athletes, how they're teaching his kids, they're teaching the same. They know exactly, hey, and on one point, I will be like my dad. I will become the next Lionel Messi. I will become the next Michael Jordan. And I know it. And that's something what I'm doing.
You always give examples of like the sports analogy with the pro athletes. And it's like, wow, it is so true,
And remember, we have some Olympic weightlifter woman. We was interview her in the Chat with Traders community, and she was laughing because she said, "What the hell? Why are you interviewing me?" And then she was saying, "Yeah, that's completely right because at the end, it's the same mindset." And she goes also through something where all traders going through. And I think you should not learn from traders about the mindset. You should learn from the athletes, because they're teaching you a complete different view. And that's something what I'm doing.
I do remember you talking about golfing as an example.
Golf, yeah.
A great sport. Wow. And yes, so we will really love to interview your son. He doesn't have to be all grown up. It can be just, in a few years, just for him to share a little bit from a little kid's point of view. It's just so awesome. And then you and Steve also inspired me to start trading futures. So that's what I'm getting into. I'm still doing options. Don't get me wrong. That's my main bread and butter, but I feel it's important to kind of like also find other markets to trade in. And so I'm dabbling into futures and I am using a prop firm for that.
It's good. So don't get me wrong. What I was talking in the interview, it has nothing wrong. So the only thing what I mean is completely wrong is if you be getting your first payout or the second payout and you're trying to teach people how to trade. That's stupid. You should not do this. Because at the end, you're not a break-even trader.
Yeah, I totally get what you were saying with Ian about because you were talking more from an educator point of view. Those that are that you see a lot that have been educating, they use that that the payouts they got a few payouts and they're like, okay, now I'm a certified, I can teach now, and that's what you're saying is the problem. Like,
yeah, go the next step. You use your payouts, funded your own capital, and go in the market with your real account, get experience then, and then you will be able to to teach something. And if you would listen to Lance Breinstein, you would 100% agree with this. He's talking the same what I'm talking about.
Right. And plus, you can't rely on the prop firms forever because who knows, they could be gone. I mean, how long is that going to last? We don't know, right? You can't rely on that as your forever business. Yeah, and so I just want to say thank you. I'm so happy to see you, miss the members in our community at the time, miss you and Steve. Yeah, so it's great to have you back on the show.
Yeah, and I hope everyone could take out some golden nuggets from what I was talking about, and maybe reflect on this.
Yeah.
Maybe you would not be agree with most of the part, but maybe it gives you something where you can think about.
You always have a different way of saying things, and that's why I think it's going to be so interesting. You always have a different way of expressing your views, and it's always so interesting, Patrick. So
yeah, because I want, the only thing what I want is people can hate me, people can love me. I give a shit about this, but if I be the person that you get so hard pissed off, then I know exactly something in your mind will be changed.
Yeah.
And then I know I got you. I know maybe I save you for some bullshit in the future, or you rethink because you get so pissed, you rethink on the way to the work, or if you're going to sleep, you think about, man, this stupidity, why he is talking about this? That's pissed me off. But you think about what I'm talking to you. And then I'll be in your mind. And that's something what I want.
Yeah.
I give a shit about if you like this or not. But if I be on your mind and maybe I can change maybe some little tiny milli% on your thinking about trading, then I'm taking a really nice job.
Agreed. Oh, by the way, the title. Are you okay with us titling it something? If you don't like it, that's okay. Because I heard you say it. Quote, you said, "We should not die as traders."
Perfect. Brief the market in and out, and we should not die as a trader.
Yeah, because when you said that, I was like, oh my God, bingo, that's our title.
Yeah, and Ian was shocked. His face was crazy. What he's talking about.
I know. I was like, I love it.
But it's really like this. So go into the cashiers, go into the room, and you will see the same cashier in 5 years. They will not grow as people, they're dying.
Yeah.
So it's simple like this.
We could have another topic on this, but some people are okay with that.
But that's nature. If you're not growing, you're dying.
You're dying.
Yeah. So maybe the woman on the cashier desk is now 60 in years, but I would tell she's maybe only 21, because after 21 she was not growing, she's dying. I may be only 30 and not 42 because 10 years I was dying. So
Patrick, help me not to die as a trader.
Oh man, that's crazy.
Okay,
so yeah, I think people will listen to this and
I love that title. Well, thank you for approving that. Well, have a great night, and we'll be in touch. Thank you for doing this.
See you soon. Bye.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
The reason why trading is really difficult in the beginning is because you have to learn so much. A lot of the things that you think you know and understand, you're going to see instances where that's violated and you don't know why, and it confuses you and it makes you start to question what you thought you knew. But then you start to get an understanding of how options as a security or derivatives in general behave. And you start to develop an appreciation for your process over the outcome of individual trades. And that really starts to simplify everything, because one of the most frustrating things is you put on a trade, you have this really well-developed thesis, and then it just goes against you. And you're like, well, why? Why did that go against me? You know, they had good earnings. They just had a big beat. They had institutional sponsors, right? A million different things. It should have gone up and it went down. And as soon as you start to appreciate the fact that like that analysis, it's all Bayesian level analysis. We come up with the best thing that we can figure out right now with the information we have. But if you understand how markets work, you understand that short-term positioning is going to overwhelm just about everything else. Those kinds of frustrations start to shed off, and it really isn't that difficult. Like it's so funny. Reminds me of Leonardo da Vinci. He had the quote, "Simplicity is the ultimate form of sophistication." That's exactly what happens in trading. Is you stop worrying about the 32-legged iron dragon breathing fire condor options trade. It's a joke. I'm just making fun of something with too many legs. And you just start trading super simple things that are based on observable, measurable market effects. And then all of a sudden you're like, yeah, okay, this actually isn't that terrible.
Markets, speculation, and risk. This is the Chat with Traders podcast.
Hey, thank you for tuning into Chat with Traders, episode 301. I'm Tessa, co-host on this show, and Ian's taking a well-deserved break. So guess what? You got me today. This episode focuses on options for you options traders. And for those who don't trade options or don't like options, please don't run away. I believe there will be something to take away for everyone. So stay with me. In this episode, I have the great privilege of interviewing our returning guest, Eric Smolinski, a U.S. Marine veteran. And if you missed episode 272 when Ian first interviewed Eric, I highly encourage you to go back and listen, because you'll get to learn more about Eric's very amazing story and humble background and his trading and investing evolution that turned him into a financially independent multimillionaire. Very inspiring. But in today's special episode, it's more of a conversation between traders, except Eric is way more experienced and way more accomplished as a trader than I am, whereas I'm still developing. And the cool thing, though, about being in the developing stage is I get to ask whatever I want, because like they say, there's no such thing as a dumb question, right? That the only dumb question is the one you don't ask or are afraid to ask. Maybe. Anyway, it's so awesome to be able to pick Eric's wonderful brain today. So yeah, come along with me and enjoy the episode. See you there. Ladies and gentlemen, I'm so pleased to welcome back Eric Smolinski from San Diego, California. Well, welcome back to Chat with Traders, Eric.
It is awesome to talk to you again. Like we were talking just a few moments ago, you've been telling me a little bit about your foray with options. So we have a fun conversation ahead of us, I think.
Yeah, I'm excited. And just for the audience, Ian actually interviewed Eric back in December 2023. I can't believe it's been 2 years now. I remember from that episode, you said that there were two things that you were really obsessed about to talk about. One is working out, and the other is trading. And since I can't talk about working out because I've been slacking off on that, and that's not my area. So I guess we'll talk about trading and options trading, to be specific.
Beautiful. It's such a fun topic because I think options are one of those kinds of securities that exist. It's an asset class that's so different in the way that it allows the most precise positioning based on a thesis that you can literally conceive of. So I'm stoked to talk about options.
Yeah. And so before we get into kind of the details a little bit, I just want to ask you, how's 2025 going for you so far? And since we did the last episode in 2023, how did 2024 and 2025 go for you?
Yeah. So 2024 was my second best year ever. And 2025 so far is on pace for not first or second best, but a really solid year. So markets like this that we're experiencing right now that exhibit high general vol, and I mean, you can see that reflected. People will say things like, oh, why is the VIX down? And it's like, well, the VIX is down relative to the 60 print it had, but it's still above 20. And the historic average is 14 to 16. It's still high. Like there's still so much vol. So for the options traders out there, whether you trade short premium, long premium, a mix, whatever your book is in general, you need volatility either way. Even if you're buying premium, you need volatility. You need the thing to move. Otherwise, you don't make any money. So for options traders, these kinds of years is what you salivate over. And it's because you can really achieve, in my opinion, a really good return on the risk. Because from our previous conversation, I really have never geared out for like top line performance. My entire trading career from when I started in 2007 has been built around consistency. And it's because of a multi-factor of reasons. It was more important to me than to have massive years and then maybe some slight down years to be really consistent. So years like this allow for that kind of consistency with way less risk out, which is awesome.
Yeah. And 2025 is not done yet. So there's more to go, more opportunities. Right?
And the entire market is hinged on what truth comes out or what tweet comes out next. So the fun part about that is it adds so much volatility that it levels the playing field, right? If you think about a really quiet, calm bull market, institutions in those kinds of markets, and I mean, they still have an advantage now, let's be honest. But that advantage definitely gets flattened out a little bit because literally nobody knows what's coming next. The tariffs are a great example of that. Trump was saying like, oh, the tariffs are going to be, we're being nice. We could have been so much meaner. And then the first thing that he drops on everybody is 10% tariff on everybody. And the market's like, whoa, did not expect that. So the fact that there's those kind of moments, it leads to so much opportunity from a trading lens. So yeah, 2025, if it's anything like it's been for the first few months, I expect continued firework throughout the rest of this thing.
Yeah. And just to remind folks, because back in 2023, you had already done, if I remember correctly, a 64% performance in 2023. Is that correct?
2023 was actually quite a bit better than that. It was 118.
Wow. Okay. Because okay. Yeah. And then your compound annual growth rate, from listening to the episode again, it was like 22% year over year from 2007 to 2023, right? Yeah. And then versus what the S&P was doing at the time, the same time frame, 8.5%. That's phenomenal. And you're saying that it's even better now through 2025.
The last two trading years, like the end of 2023 and then into 2024, they're like statistical outliers for my performance. They blew my CAGR to the right. So when people ask, like, what's your general trading performance, it used to be in the low 20s, but it hit as high as the low 30s, and now it's drifted back down into the high 20s. But I still don't really think that that's what the true performance probably is. Like, if we were to normalize it out, I would still expect somewhere around that number we talked about before, probably 22 to 24 if we got rid of the outliers.
And you're just doing the same thing. Have you done anything different with your strategies?
No. What I do is the strategies that I trade are relatively static. They're built on known market forces. I call them profit mechanisms. They're things that I can directly look at, see that they're there. I know why they're there, and there's reasons why they're there. So I can capitalize on those. There's always refinement, though, because regimes change. So a great example of that is coming into 2020, I used to use a lot of small caps. And it's because they typically exhibit higher vol. And people don't remember this because of how dominant 8.5. But growth stocks used to outperform large cap broadly. And that's changed. So it's changes like that. So the overall approach itself generally remains the same with the toolbox that I use, but the way that I deploy it has to shift a little bit. Another great example is the introduction of daily expirations in SPX on 16 May 22. So that becomes another big part of the book. So it's like there's adaptations more than anything, but it's not like big changes.
Would you say that trading options is getting even more easy for you, or is it's just changing? I mean, it's just more challenging. I mean, do you ever get bored now?
No. How could you get bored? With how things go, I like the concept of being bored in the stock market is just so foreign to me. I couldn't even, I was looking at stuff yesterday in GameStop, and there was 2 prints for the past 2 days of like $18 million positions being sold in deep in the money puts like 2 days in a row. And the total net premium for everything below that was within a couple $100,000. How could that be boring? Because it's like, why? And then you got to go investigate. You got to see what the price action is. So there's definitely no element of it that's really boring to me. But I think a big part of that is because I'm naturally curious, and the market is one of the best vectors I could possibly think of for that curiosity. Because if I'm sitting here trying to learn more about tariffs, like everybody should be right now, guess what? Perfect vector. You go to the markets, you start reading the earnings releases that are coming out by different industries to understand the impact of tariffs, how that's actually panning out. You now know more about tariffs. So it's like, as a vector to learn about the world around us, there really is nothing better. So boredom is not part of the equation. In terms of difficulty, I really think the difficulty sheds off once you really define and develop your process. The reason why trading is really difficult in the beginning is because you have to learn so much. A lot of the things that you think you know and understand, you're going to see instances where that's violated and you don't know why, and it confuses you and it makes you start to question what you thought you knew. But then you start to get an understanding of how options as a security or derivatives in general behave. And you start to develop an appreciation for your process over the outcome of individual trades. And that really starts to simplify everything, because one of the most frustrating things is you put on a trade, you have this really well-developed thesis, and then it just goes against you. And you're like, well, why? Why did that go against me? They had good earnings. They just had a big beat. They had institutional sponsors, right? A million different things that should have gone up and it went down. And as soon as you start to appreciate the fact that like that analysis, it's all Bayesian level analysis. We come up with the best thing that we can figure out right now with the information we have. But if you understand how markets work, you understand that short-term positioning is going to overwhelm just about everything else. Those kinds of frustrations start to shed off. And it really isn't that difficult. Like it's so funny. Reminds me of Leonardo da Vinci. He had the quote, simplicity is the ultimate form of sophistication. That's exactly what happens in trading. is you stop worrying about the 32-legged Iron Dragon breathing fire condor options trade. It's a joke. I'm just making fun of something with too many legs. And you just start trading super simple things that are based on observable, measurable market effects. And then all of a sudden you're like, yeah, okay, this actually isn't that terrible.
Do you think there's a certain type of personality would be more suited for options trading?
Yeah, definitely.
What type is that?
I think you have to be process driven. I think, well, and I guess I should take a step back because it depends on what kind of options trading we're talking about. Because there are traders that use options purely for leverage. Mm-hmm. And who's to say if that's right or wrong? We know in the majority of instances that, typically doesn't bear out that well. So if you're trying to trade options from the lens of like, I intend to do this for some time, that won't lend well. But I think it comes down to people that have a natural curiosity of things, the ability to put the ego in the back seat. That's a big thing for all traders, but especially options traders, because you're not just dealing with delta anymore, right? The price direction impact to your trade. You're now dealing with things even like interest rate changes. You're dealing with things like volatility changes, and volatility changes can be real weird, right? It's based on an implied expectation. So you're literally trading based on people's forward expectation of how something might move. That's as fickle as you imagine it might be. So you have to be willing to accept things sometimes at face value. That's one of the funny things I find is like, I'm the perfect balance of dumb enough to try it, but smart enough to kind of find my way through it. I feel like if you're too smart, you'll look at this stuff and be like, no, that shouldn't have happened. And then you'll just get wrapped up in that cycle and you just won't be able to escape it. So it's like a really big balance between observing how things behave, updating a process-based model, whatever that is that you choose to use, and being consistent enough and able to manage the ego it really is so important, I think. So I think if you're generally in, most of those buckets, you're pretty good. Now, one thing I will say that lends terribly to options are people that are impatient, which most of us start super impatient. I know I did. And that's just the ability to persist in spite of that, not because of that. That is in no way a good quality to have with options. And then I think outcome-based is also terrible, because if you're so wrapped up about the outcome of individual trades, this is not going to be for you. And it's because, again, with options trading in general, regardless of your approach, it's probably going to be manifested over tens of thousands of trades, hopefully, if you have a nice long trading career. So that means any one outcome really doesn't matter. It really doesn't, provided that it's within general good taste, meaning you're not losing 90% of your account on one of those trades. If everything is generally within fair risk parameters, no one of those trades matter at all. It is all about the outcome of the aggregate process over time, which escapes all of us in the beginning. In the beginning, when you first start with options trading, you think it's going to be fast, easy money. And you think you're going to be able to turn your $2,000 account, $5,000 account into millions of dollars, or even, maybe more conservatively, hundreds of thousands. Both are equally improbable. And that entire expectation is what sets you up for failure, I think, from the jump.
I'd love to pick your brain. And just to give you a little background, I've been trading options. I was first introduced to options in 2014. But that doesn't mean, now it's 2025, doesn't mean that I've been trading options straight for 10 years, right? It's more on and off. But it's only last year when I put 110% all into relearning options, reassessing my old strategies and refining it. And I have this love-hate relationship with options. I love it because of some of the things you mentioned, like the leverage, but the thing that I think I've been trying to get better at and struggle at times is the volatility and the time decay. With the time decay, that's a big one too, because you have to be right by a certain time. That's what's completely different with straight up equities trading or futures trading or Forex. I mean, you have to be right by a certain time. Otherwise,
Even if you end up, your direction is right, but it's not by a certain time, then you lose. And then the volatility, you need the movement. Like you said earlier, volatility is actually your friend in options trading, especially if you know how to use it right. But then there's just so many layers in options that if you're not careful, you can bleed slowly over time. Even if you're super careful, but you don't really know how to navigate around that and have the right strategies, which was my case, is in the past, I wouldn't bleed a lot, but I would bleed a little over time, and then it ends up being a lot. That's how options. Whereas like equities trading, it's like instant, like you can be out like really quickly, for me at least. But with options, when I was starting out, I was bleeding slowly, everyday bleeding. But I've gotten better over the past year, but there are times when I feel stuck.
I think the first thing that would help me understand a little bit better is, what's your relationship with the Greeks? And to be clear, I don't mean just the first order Greeks. There's a few different orders. There's first order, second order, third order. It sounds something out of Star Wars, but it literally just tells you what that group of Greeks measures with respect to. So first order Greeks, they measure everything with respect to a change in the options premium. So delta, change to premium based on movement. Vega, change to premium based on vol changes. Theta, change based on time. That's why a lot of people falsely would bucket gamma as a first order Greek, but it's not. Gamma tells you the rate of change of delta, second order Greek. So it's just complex terminology, but once you understand like what the order, quote unquote, means, it actually makes it a lot easier, at least for me, because it tells me what we're measuring with respect to.
Yeah. Well, with second order Greeks, like with gamma, I just recently started learning more about that, introduced more about like the gamma levels and things like that, and areas where market makers are trying to hedge. And so I have these indicators, on my, these levels that get plotted on my charts to show where the likely kind of areas of interest where there's a lot of gamma, and there's a lot of hedging right there. So I do have that, but I don't know. Sometimes it's just too much information that I get analysis paralysis.
So the way to think about that, what you're referring to is called gamma exposure, and we would refer to it as GEX, which is actually not really the primary purpose of what gamma is. It's a secondary purpose where we're trying to measure dealer positioning and then potential dealer behavior based on what their positioning is, net positioning, I should say. One of the reasons and the frustrations you will find with your relationship with stuff like volatility and time, it stems from not understanding well enough how options behave. And we all do this. And it's similar to if I knew better what the weather was going to be, right? I'm in San Diego, so it's going to be sunny. Well, if I wanted to go out and let's say go on a really long hike and I knew it was going to be sunny, I would put sunscreen on, put a hat on, that kind of thing. Well, it literally is the same thing with options. If you know how they behave, you can build things so that you can gain that specific exposure that you want. So for example, with theta decay, if you're long an option, there are three things you could do to decrease your total exposure to theta. You can go really far out of the money. You can go really deep in the money. You can go further out in time. You can do a combination of two of those. So you always have that available to you if you know how theta behaves. So it's the same thing with the rest of the Greeks. Now, to be clear, you don't have to be like a giant nerd and go into all of the second order Greeks, third order Greeks. Like that starts to become a little bit more based on like broader portfolio management. I think if a trader has a really good grasp on what I refer to as the primary Greeks, so what most people are used to, right? Delta, gamma, theta, vega, rho is kind of there. It's pertinent now because we're in a rate shifting environment, but typically rates don't move that much. So if you have a good understanding of the way that those behave it grossly simplifies literally the entire remaining decision making around what kind of structure you might choose based on the idea that you have, which is a beautiful segue into understanding what you've been doing. And we can see what kind of structures you've been picking, and then we can talk about it.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Okay, so lately, well, I shouldn't say lately, for the past year, I have been trading instead of trading earnings like head on, like when it reports. I trade earnings pre-earnings. So I trade before they actually report. So, for example, back in early April, so JPM was supposed to report out April 11th in the morning. So about 2 or 3 weeks before that, so this was my earnings play, I put on a calendar spread. I believe that was a put calendar. So I checked the IV on that JPM like 3 weeks before earnings, and I noticed that at the time it was lower than the historical IV. So it was, let's just say 25%, whereas the historical was 28% IV. So to me, that's like safe. I'm like, okay, because I expect so I put on the calendar spread on March 24th, about 2 or 3 weeks before April 11th, while the IV was relatively low. And I expect that between then and the earnings announcement that the IV is going to grow, just based on historical for JPM and many other stocks that report, they tend to, supposed to kind of grow the IV. So that's what I did. And so then the tariff news happened on, I believe that was April 3rd. Did I get that right? Somewhere around there.
Like 3rd, 4th, 5th, it like started coming out. I forgot the exact date myself, but
yeah, it was very early April. Yeah. So what happened was the IV just exploded on April 3rd, and then afterwards too. And that was actually good news for me for that position, because if that didn't happen, I would still expect the IV to still grow, but not crazy like that fast, right? And that was like, I guess, that just no one saw that coming.
Right.
And so I was able to close out of that trade way before the earnings. I closed out the next day, April 4th, for a nice profit. But that was, to me, that's in a way, it's accidental because I mean, I probably wouldn't have profited as much. I mean, still, I think I expected to still profit, but not that much and not that fast. But there were other earnings trades that I did that did not profit like that because of that tariff with the IV crush that came a few days later when it wasn't really a crush. The IV was still high, but it went down. So it impacted some of my long spreads, right? Because with a long spread, you want the IV to continue higher. So I closed out some of my other earnings trades for a little loss because of that. So I just want to share that's to give you an idea that is like one of my strategies for earnings, pre-earnings play.
So the cool part about that is, and I don't know if you did this on purpose or not, but you stumbled into a really well-known market effect. And it's that implied volatility starts to ramp up leading into an earnings release starting about 2 weeks out. And you can research this widely. You could do it with your own data set. You can go onto a website like SSRN, Social Science Research Network, and you can literally look up different kinds of just options stuff to see what's been researched and what exists. So you've stumbled into one of them by your observation, which is fantastic. You're a little early, I think, going out 3 weeks. The idea behind trading that vol expansion is you really have to put yourself in front of the meat of the vol expansion when it really starts to accelerate. Otherwise, theta will hurt you.
Yes.
One thing you said that if I was working with you directly, that I would correct you and say that this was a red flag is when you said that it was good news for the trade. And in my opinion, it's not good news. It's not bad news. It's no news. So this still, it shows me a mental attachment to the outcome of the individual trade. Whereas you told me you're trading an earnings-based strategy. That effect got completely blown out by a non-earnings-based effect, which resulted in a positive trade, which is great for that. But we really gained no knowledge on how does this strategy, again, that we're expecting to use long-term perform. So one of the things that I would recommend to somebody like that is it's completely okay to look at a trade and be like, yeah, okay, I'm glad that worked out, right? You don't have to be like mad about it. But I would always take it back to what are you trying to accomplish? And you're trying to refine this earnings-based strategy. This trade happened to work out. Cool, take the money. Always take the money, run. But it's not good, bad, indifferent. It's literally, it is indifferent. It's just nothing. It doesn't mean anything. Made some money on this one from this thing that came off the top rope. Cool. But otherwise, it really gets no mental capacity from there. Now, what is the specific structure you use for your calendar? What expirations and what strikes relative to spot price?
Yeah. So, for example, in that same example for JPM, it's at the money calendar put, and the expiration, the front expiration would be expiring the week of the actual earnings announcement, because I want to take advantage of the IV expansion, but then close it out before the earnings announcement. And then the back month is just 1 week after the following week.
That's a completely viable approach. Now, another thing you could do that I typically recommend to people with something like this is I would paper trade other structures on the same trade. You've already done the research. You already found the ticker that you want to trade. You already built the hypothesis based on the relationship between implied vol and historic vol. So if I were in your shoes, what I would do is say, okay, I think the calendar is right for this, and it's nothing that's going to hurt you too bad. So, okay, put the calendar on. But I would also put on other structures so that you can directly observe the behavior without necessarily risking the money. So I would put on maybe a long straddle, a long strangle, and see how those perform relative. And again, the JP Morgan trade obviously wouldn't bear out because of the Trump stuff, but that's what I would do with the general earnings trading approach so that you can test some other things. Because what you'll find is that the calendar is probably good, but depending on if you're okay with your timing on the vol expansion component of the trade, you can do better if you're doing something like a long straddle or strangle and then gamma hedging around it.
That's what I want to ask you. Okay, so sometimes I do the long straddles and long strangles instead of the calendars a couple of weeks before earnings. But there are times when it doesn't move enough. It doesn't move fast enough for that, and that's why sometimes I like the calendar. If I know that stock historically doesn't move as much, I mean, not like like maybe under 10%, but it's still within the calendar, the borders of the calendar. But yeah, so if I do the long strangles and straddles, what do you do? How do you adjust it when you see that it's not going to move in time before expiration?
Take the trade down for a loss.
You just take a loss.
Yeah. So one of the things that is really important as an options trader is to again, it goes back to desensitizing yourself from the outcome. So if my hypothesis when I put on the straddle, strangle, calendar, whatever it is that vol should start to steadily expand coming into earnings, and it's not steadily expanding coming into earnings, what does that tell me? My thesis is wrong. It didn't work. And guess what? It's going to happen. It's okay. But if you limit the loss at a logical point, it keeps you alive so that you can expose yourself to the events when it does. So this goes into a really important process that I think has to be done at the strategy level. I call it the outlier strategy process. It's just a framework. It's a way to think of things. But the first two steps of that process in my mind is to think of the profit mechanism, in your case, vol expansion leading into earnings, but then it's to quantify and qualify. So what that means is I want to look at what's the average vol expansion leading into earnings? What's the max, min, median? What's the overall vol expansion on a day-over-day basis on average? And what I can do then is say, like, okay, I've been in this long strangle for 3 days. On average, this should have been upticking by 0.02 vol, and it's flat. It's not doing what it should be doing. Maybe I'll take half the trade down because it's not doing what it should be doing. Maybe I take the whole trade down because it's not doing what it should be doing. So by deeply understanding the profit mechanism, it literally takes the guesswork out of what to do next, because you'll know what normal looks like. And then if this doesn't look like that, then you know that this instance isn't a good one.
When you said earlier that you would, like in that case, if the stock is not moving as much, for the straddle or strangle, and that, at times you would just take a loss. Not that I wouldn't take a loss. I can take losses, but I just feel like maybe that I have this way of like, I feel like with options, because you can do so many things with it. So I tend to try to like turn it into something else, turn the leg into a spread or something like that, or roll it out and, revive it somehow and just keep it going. And at times it just gets worse, when you have too many legs, Yeah. So
it's a really common mistake. And the reason why it's a mistake unequivocally is, again, just remove the entire option component of the thought process. I thought this was going to do blank. It did not do blank. I am wrong. That's what that means. So if I'm wrong, it doesn't mean morph the position into something else and hope I can be right on something else. It means this instance was wrong. Completely okay. Literally going to happen all the time. Take it down and then go find a better opportunity. Because this instinct, which is really common for all of us, is to start trying to adjust things into, something that might work out. But I'll always remind people to zoom out and think of what you're building as far as a strategy, not with respect to the outcome of this individual trade, but with respect to putting yourself in front of as many good opportunities as you can over your entire trading career. That's what matters. It's not if we could take the straddle, add some legs to it, roll it out, and to trade a completely new idea. That's not something that's going to be highly replicable over a long period of time. So resisting that urge takes a little time, but it's super important. And you highlight a really common thing. We all go through that.
So for earnings trading, like, would you recommend to trade it like a basket of earnings or concentrate on one at a time?
That's a great question. It really depends on the size of the book and how earnings fits into your broader portfolio. For me, for example, my portfolio is split into two buckets, a core allocation and a speculative allocation. They each get a certain percentage of the portfolio based on what the market is doing at the time and like my analysis of how do I think things are going. And within the speculative allocation, different strategies get different amounts of money. I actually measure it more so by risk than this one gets $5,000, this one gets $10,000. I care way more based on the earnings play. If I'm averaging 25 to 30 trades per week, average P&L is blank, max drawdown potential is blank, that's how I size it. But I think with something like options, especially around earnings, if you do not get yourself in front of enough looks, you are going to be so path dependent, and that's outside of your control. So I think you strip away the broad market effect that you're trying to expose yourself to, which is IV expansion leading into earnings. And now you become way too exposed to idiosyncratic risk. Whether or not this company comes out with some sort of news that the market doesn't like before earnings or does like whatever, right? You now have a decent amount of idiosyncratic risk. So if I had my pick, what I would do is size down the individual trades, but try to put on as many that make sense for your allocation of earnings. Because if you don't get on enough over the course of a week or over the course of an earnings cycle, you're really just seeing path dependency. And what I mean by that is it just, what were the sequence of returns by luck, by chance over that path? Whereas if you get a larger number of occurrences, the law of large numbers starts to come into play. And even if the path tends to have tails, it's going to be more normally distributed. So then it's going to approximate towards the actual performance of the strategy.
And because earnings only occur, they occur every 3 months, so quarterly, there's only, really the first month or first month and a half of each quarter that really has, earnings, enough for you to trade. And because of that, I have been supplementing the non-earning strategies. For example, I've been experimenting with zero DTE trading.
Into zero DTE, sorry to interrupt you, but I just wanted to understand the earnings package in total. So when you're trading earnings, you're trading the pre-run up and then that's it.
Yeah, that's my earnings strategy. Pre-run up, and there's only so many earnings you can play because it's reoccurring every quarter. So that's a good thing.
Definitely. And there's two things I would ask you to take a note on to explore. The second thing that you can play earnings, that same effect. The reason why I'm saying this is because your comment of, there's only so many that you can do over the course of a quarter, which is completely correct. But you literally can trade one earnings release 3 times. So you can play the pre-run up leading into it, starting about 2 weeks out.
Yeah.
Then the IV contraction after the release. That's the second way you can trade it. The way I normally do that is right before the close, 5 minutes before the close, depending on how liquid the underlying is, maybe 10 minutes before the close. I either trade short straddles, strangles, typically short strangles, and I'll play the earnings contraction. Then the third way you can play earnings is following the earnings release. There's a market effect called post-earnings announcement drift. Now you can play a directional breakout, upside or downside, depending on the qualities of the beat or miss. And then you can trade that same thing directionally with the directional play for the following quarter. So a few more ways to trade the very same effect.
Yeah. Yes, I tried doing that, but I'm not good at. Maybe I'm just not used to it. When you mentioned the earnings the IV contraction play, and so you use short strangles or short straddles. I want to explore it a little bit more, but I feel like isn't that more risky because the risk side is not capped, right?
Don't let the unlimited profit, or in this case, unlimited risk component, scare you. You still control it via size. So one of the things that retail traders get in a terrible habit of is fearing risk. And it's literally how we make money. If we get too concerned with risk, then it's very difficult to be profitable. Now, again, you have to balance it. You can't be deaf-toned to risk. But that's where something like sizing comes into play. Now, if you're looking at something like a short straddle and you're like, if this moves too far, even if I traded at a one lot, this would potentially be a 5% drawdown on the portfolio. Like, that's a terrible risk profile. Do not do that. The way that I would look at sizing those kinds of plays, like short premium plays, is I would look at the prior 12 earnings moves, find the biggest that it had up or down, plot that range for reference and say, what could I size my position at that if it moved like it did, and this is a base level, what would the P&L be on the portfolio? And I would look to keep that under 1% of the total portfolio. And again, that's like a base case, because what I always remind traders is the worst day is always ahead of you. So the worst post-earnings move hasn't happened yet. It'll be in the future. So then if you size that out, let's say something is expected to have a 5% move for this coming earnings release, but historically it had one that was a 15% move. Let's just call it to the upside. And I'm trading a short strangle. I would model what's my P&L based on the size that I think I want, based on the trade that I think I want to put on if we get that 15% move. What about if we get a 20% move and it's a little bit bigger? And if I look at that and I say, that's just too much, it's going to put me at 3-4% loss in the portfolio, add legs, buy the wings. So you can turn it into a wide iron condor, cap it. It's not as efficient in terms of the number of legs you're trading, and you're adding a little bit different of a market effect because you're really neutralizing some of your Greeks, but add the legs. And one note on that is a lot of times when I'm trading tech releases, I almost always add a wing to the upside, even if I size it appropriately. And it's because some of these tech names can literally have 4 times the expected move to the upside. Not interested in that. Don't want to play that game. So I will absolutely eat the cost to the upside. I rarely do it to the downside. And funny enough, it's because I'm less fearful to the downside on those kind of tech names. They can have big down moves and it can hurt, but most of them are generally good businesses, right? If you're talking NVIDIA, the probability of that having a 40% drop to the downside would be low, not impossible. So the short answer to all that stuff to help abate that fear is to paper trade it so that you can get a sense of what the numbers look like, and to size it down so that if you get the worst move you've ever seen, it still isn't that big of a contribution to the portfolio from a loss perspective. But then you obviously have to balance that out, and you have to get enough of them on so that you can make money. Because if you're sizing them super small, then you're not going to make a bunch of money.
Can I tell you a secret? I hate paper trading. I hate paper trading. I rather for me to be able to do all this, I have an Excel spreadsheet that I am able to do what if scenarios. So I like doing what if scenarios on my Excel, and because I do have the Black-Scholes and all that in there, so I can do what if. So if the price does this and the IB does this, then this is what I'm expecting. So I might do that more than I do paper trade once in a while when I'm trying something totally different. But I know it's prudent and I should do that, but I rather use my forecast modeling to kind of do a what if scenarios on these different complex option strategies.
What I would tell somebody, and that's common, by the way, none of us necessarily are super jazzed about it, but what I can guarantee you is your performance will reflect that. There's no outperforming that. And it's like if a basketball player like Kobe Bryant is like, I don't want to go to practice. I don't feel like it. He's probably not going to be Kobe Bryant. He's not going to do what he was able to do. So this is genuinely the work required of a trader. And if it's not interesting, or if it's not something that's satisfactory, then my biggest recommendation would be genuinely do something else. Because the thing is you cannot make good decisions without data to look at. So the forecasting model that you share is like, that's awesome. You should absolutely do that and give yourself an idea of like what this thing might do. That's a great step to take. But by going one step further with these different kind of names, and I'm not even going to the deep level that I would do, where I would track every single company that had weekly options, whether I was trading it or not. And I would track all of them through the entire earnings cycle. And I wouldn't trade a lot of them, but I would track every single one of them. Wow. I'm not even recommending that because I know most people will be like, yo, chill, which I get. But the way that I think about it is like, if you're already trading JP Morgan, right? You're already looking at it. You already have your spreadsheet up that you're going to track what you're doing. It's literally one step more to just input some other numbers. And a great way to shame you into doing this is when you're going in to close out your trade, right? Because you close out the long option right before it reports. Well, guess what? You're already in the sheet. You're already looking at the options chain. It's right before it closes or the day of. Why not just drop a little strangle in there? Just type it in to see what it is. You're already there. The way that I encourage people to think about paper trading is like, it's not simulating your real account in this context. You can do it to do that. And a lot of people struggle with that, which I understand. It's more to collect data. And it's so that you can make data-driven decisions because, again, to the point that we made earlier, for the trader that isn't sure what normal looks like in terms of the day-over-day change in implied volatility leading into the earnings release, if you don't know what that is, when you look at the stock 4 days in and it hasn't moved, then we're thinking like, oh, well, maybe it will move in the next couple of days. But if you have the data and you say, well, based on the data set that I have, if it doesn't move within the first 4 days, there's a 79% chance that this thing isn't going to move enough and I'm going to lose money. Guess what? That's an easy cut. And that's how you get to the point where when you're taking losses, you feel nothing because you're like, I'm taking this bad risk down because it's not doing what it should be doing. I'd rather go find good risk to put myself in front of. That's the exact way I would think about it.
I love your analogy with, the professional athletes with Kobe Bryant. And that is something that I think most of us aren't willing to do. And that's why we're not successful. So thank you for that reminder. And I definitely know that I should be, doing a lot of testing and things like that, especially with options, because it's just so much more, so many moving parts that you have to test it at the minimum. Like that's what I did with my Excel spreadsheet, but I know I can do better if I just one step further is to, test it out in the demo.
Yeah. Well, and again, when I refer to paper trading, I don't even use a platform. I just use my trade log in Excel and I just plot it. Because the thing that I would remind everybody, again, you can't conduct data analysis on a snapshot in time, right? If you plug it into your Black-Scholes model and you get a sense of how this thing might move, well, unless you have the best memory on planet Earth, when you're trying to aggregate all of the times you looked at that and you're trying to say, well, how much might this move? It's not going to be that rock solid. So that's why I believe so heavily in having a really efficient process, because it makes these seemingly arduous tasks bite-sized. So like, for example, I have a earnings tab in my, and it's literally built exactly with what I need in there. And I have two versions of it. The first version is live trades. The second version is tested trades. So it lets me tinker with different settings and again, make it bite-sized. You don't have to sit there and say, well, if I sell the strangle at 30 delta, I should also test it at 25, 24, 23, 22, right? Don't do that. You can get the gist. If you sell a strangle at 30 delta and it seems to perform okay, then maybe double click into it, right? Now, again, for somebody like me, I literally would go in 5 delta increments and test them all. But that is like an obsessive, freakish thing to do compared to like what most people are interested, which I recognize. So to that end, I think you can get the Pareto principle in full effect. If you test again the 30 delta short triangle, similar structure over and over again, you'll get an idea, right? And that can be enough to help you feel also more confident. Because again, the reason why I'm confident in it is because I've seen tens of thousands of them. And I know that even if you get a bad move, if you size it well enough, it's not fun, but it's not going to hurt you. You'll be okay in the long run. But if you don't have that information, because if you don't have the data to look back at, there's no real confidence in it. And it's like, well, damn, it's like, it looks like it's starting to get really spicy. Maybe I should take this trade down sooner. I'm getting antsy. And it's like the worst thing you could do, which leads into your zero DTEs, because zero DTEs are all gamma. And unless you have a good data set on how you're trading zeros, the propensity to just go off the rails and start going off script and doing other things because stuff is moving a lot is very high.
So how would you trade? I don't trade zero DTEs with earnings, but I use them on the Qs and SPY. And I do vertical spreads. And I remember hearing you saying you hate vertical spreads. And I kind of do hate it too, but I feel like it's like instant feedback.
There's nothing inherently wrong with a vertical. The reason why I say that I hate them is because a lot of people that use them, it's muting too much of the effect that you're trying to trade, and it's because of risk aversion. There's a time and place for vertical spreads for sure, so don't feel any type of way about using them. I use them too sometimes.
Yeah. How are we on time? I'll try to wrap. I have a few more things I want to ask you. You're okay?
I'm literally after the market. It's the best for me. That's why I always try to do this stuff after the market, because there's no pressing anything.
Yeah. Okay. So what I have is the topic of stops, because when I trade just straight up equities, when I trade straight up equities, of course I use stop losses. Well, not in the beginning, but I learned to always now use stop losses. But when it comes to options trading, I've never used stop. I'm not used to using stops, and I just let it either expire or just get out. But do you use stops on options? On option legs?
It is a really tricky concept with options. So there are periods I absolutely would use stops, but they are never optimal. This is mostly when I was on active duty in the Marine Corps, knew I wasn't going to be able to look at the phone on the day because we were going out to a range or something. So I'm putting on a trade and I'm just accepting the fact that I have a stop market order, that if it gets hit, I'm going to be really upset with the fill. I already know that. But it is what it is, right? It's just accepting the circumstances what it is. Stops on options is suboptimal across the board in a million different ways. So I echo your general preference for avoiding them. I think it's a better way to do it. I think depending on the profit mechanism that you're trading, like let's say, for example, it's the earnings plays, the expansion leading into earnings. Well, really, you're monitoring the changes in vol. It's not based on the P&L. It's not if the trade is up 5 cents or down 5 cents. Like, that's not the decision. It's based on vol. So I wouldn't place a stop based on price if the effect I'm trying to trade is based on vol. And it's like the same thing with directional plays. If I'm trading like a breakout or a breakdown, all I'm doing is setting a stop based on where I would get out, even if this was a stock. And I can price the option at that point, and I can see what the option is going to be worth. So all I'm going to do is set alerts so that I can go in and physically exit. But sometimes you can't get away from it, but it's always going to be suboptimal.
Yeah. You know what? Another thing I hate about options, I mean, I overall love it, but I hate is it's like options, what you see is not what you get. You know, unlike with equities, like for example, a stock, and I'm just talking for those who aren't as familiar with options, not trying to scare them away, but like say the underlying is gonna, you see that it moves up, but it doesn't mean, like if you're trading options on it, it doesn't necessarily mean that you're gonna profit on that. With equities, it's very clear. You buy this price. If it goes up, then you made a profit. But with options, you buy the underlying at this price, and it goes up, and you still lose money. That is like a concept that I think a lot of beginner traders. I mean, I understand it now, but I'm just, kind of sharing on That's another complication. So why would anyone want to go into options then?
It's so simple. It's because going back to the example I gave you with the San Diego weather, if I know it's going to be sunny and I go out for my walk and I decide to wear no shirt and I go no sunscreen, no hat, am I going to be surprised if I'm sunburnt? No, I am going to get freaking fried. So it's the same thing with options. That trader that put on a position thinking that the underlying was going to go up and it went up and they didn't make money, it means that they didn't have the right position for the idea that they had. That's exactly what that means. So that goes back to having a deep understanding of how options behave. That's the funniest part about this is like if somebody spent more time understanding how options behave than what delta to pick for their vertical spread, they would make so much more money because the answers literally start to present themselves based on your idea. Great example for this. If I think an underlying is going to go up a little bit, for whatever reason, I think it's going to go up a little bit over the next 2 weeks, and I buy a 30 delta call that's 14 days to expiration, and it goes up a little bit less than I would have thought, but it still went up, would I expect to make money? Of course not. And it's because I know based on the Greeks, delta and theta, if it doesn't move enough, the delta move doesn't overwhelm the accumulated theta. It literally presents itself to you. So then if I'm thinking it's going to be a little move, maybe instead I should just sell a put. That might be better suited for this idea. So that frustration is one that we literally all experience as well. It's so funny, right? Because you hear me say that a million times, but it is we all go through these same things. It is like a universal thing where you buy something and you think it's going to go up and it goes up and you're like, wait a minute, why am I losing money right now? And then you realize like, oh, maybe you weren't, you're too close in time and vol changed too much based on what you were expecting, right? Like there's a million things that can happen. But once you understand how options behave, it actually becomes really simplistic. For example, if I want to decrease the impact of vol on the option, I know I need to go further out in time. And I either need to go further out in money if I'm expecting a massive move, which maybe not, or I need to go a little deeper in the money and get a higher delta. So that regardless of what vol does, if I have a 80 delta, if vol changes that much, there's not that much of that option that is extrinsic value, so the impact there is minimized. And if the option goes up by $1, I'm still going to see 80 cents of that because it's an 80 delta. That is what it is. So if you understand how they behave, that will go away.
I'd like to transition quickly to the trading mindset for options. Do you think there's a difference, with psychological issues between trading options and trading other things, non-options like equities and other markets?
I would think so. I think you actually just hit one because one of the things that options add is complexity. You now have other things that impact price. That's different than if you're trading an equity outright. And that is difficult to overcome because, again, like we were talking about before, it really does require taking a lot of time to understand how options move. Whereas to your point previously, stock moves up or down, right? Like that's it. Like those are your choices. But options are very different in that way. So I do think it takes a different mindset in terms of how you analyze the movement of things. You have to become multivariate versus really unilateral in terms of your expectation of price. But with that, it opens up the thing you mentioned right in the beginning of our conversation that I think is so pertinent, is that very same thing is what creates the beauty of options. If I think something is going to go up moderately, let's say I think it might have a 5-10% up move, or its average move might be 3%, right? So a bigger up move for whatever reason. I can build such a better position for that hypothesis with options than I ever could with stock. Yeah. So I think that is the beauty of them, but I think it does require a different mindset with respect to understanding the different forces that play on options, because it can be challenging in that way. I also think the other thing that is very different is you kind of have to be comfortable with ambiguity, because it's that same thing. With a stock, I can buy the stock, I can sell the stock.
Yeah.
Those are your choices. But if I think something is going to go up, I can literally think of a dozen structures that might make sense. So then you have to get more specific on your idea. I think it might go up, but what do I think vol might do? Do I think vol is high here? Do I think it's low here? Do I think it's likely to expand here? Right? Like, you have to start playing these other factors into your idea, which again, it requires a little more comfort working with less linear environments, I think.
Mm-hmm.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
Now, are you trading anything else, or are you just purely just options?
Options and futures. Yeah, I typically trade options. Futures, they give you access to after hours. So I use them all the time. One of the things you can do is, let's say I'm trading an earnings release in NVIDIA. And let's say NVIDIA has bad earnings. I can see it going down after hours. What does that tell me that the NASDAQ is probably going to do the next day? Probably going to go down. What can I do? I can hedge that NVIDIA trade with a NASDAQ short and play it to the downside. So futures fit into the broader portfolio really well in that way.
Are you talking about options on futures or straight up futures?
Both. Typically, futures outright. Options on futures, they sound cooler than they are. To be honest, they're generally not that liquid. So for instances than not, I'm just going to go into the indices for that kind of positioning versus the options on futures. But the other thing that futures give you access to are like spot commodity movements. And you just can't get that with options. So futures give you access to some markets that you really can't get the same pure exposure through options.
Yeah, I'm also dabbling in futures as well. Well, I'm just starting. I'm pretty sure you've done it for a while, but I find it much more simple. It's simpler than I mean, it's like almost like trading like equities, except
it's Delta
not,
One.
Yeah, it's less complex, and I really like it a lot. But I love options for like the beauty of it, like you mentioned. There's just, if you just want stimulation and you want to like really have different ways to construct a strategy and things like that and have the time to do it, I think it's great. But with futures, I really like to, because of the simplicity. And also I want to ask you about, have you traded any prop firms on any of these? Oh, okay. Because there's a lot of them now, no, I don't mean like the regular prop firms, but like the funded type of prop firms that make you, do an evaluation, and if you pass, then you get access to their capital to trade. So that's one of the reasons why I was interested in futures, is because of this new prop firm space where you can have access to capital to trade futures and not risk any of your money. I mean, just a very small, fee for the evaluation. So I was just curious if you're aware of any of that.
Yeah, no, I definitely have heard of them before. For me, it starts to erase really the beauty of being like self-directed trader. It's like one of the primary reasons why I got into trading is because, I mean, I still am involved in like commercial real estate and stuff like that, but there's a lot of stakeholders involved in that, right? Like, for example, there's a ski resort that I own with a few partners. And with something like that, you have to operate the ski resort, right? So there's a ton of things that has to go into that. Whereas with markets, it's literally you, the market, and whatever's going on that day. There's nobody to talk to. There's nobody to run things by if you don't want to. and it's all based on whatever you want it to be. So I think that it could be a really good resource for people also that are trying to develop like better discipline in what you're doing, because there's a forcing function. I think that's a big shortfall for a lot of traders, that they're not good at being their own forcing function. They'll kind of, take the easy way when they are able to. And at something like that, you kind of can't, right? Because you could lose your ability to continue trading with the capital. So yeah, it's nothing that I ever considered for me, but I can definitely see the value in something like that. I personally would be, well, two things. I would be way too concerned about the siphoning of the information. And I wouldn't necessarily want, because a lot of the things that I trade, especially in the options world, I'm at a really cool spot where I have a big enough portfolio that I'm comfortable, but I'm still not a 100 million lot premium trader, right? So my trade sizes are still small enough that I can still play in some of the smaller markets that are less exposed, but those can get overrun pretty fast if other people start finding their way in. But it sounds like an interesting resource, but it's nothing I've ever tinkered with myself.
Yeah. Well, to wrap things up, I know we're past the hour. What are the new things you're obsessed about lately, or, anything you're working on that you're excited about?
Great question. I think the main stuff that excites me lately is actually refining a lot of the models that I'm trading. A great example is zero DTEs. So zero DTEs have evolved so much from their launch a few years ago. And it is like, again, you could just tell why this is the right thing for me, because this is fun to me. Like, it literally is like a puzzle that I get to solve. And it's genuinely like, I cannot tell you how much data I process with respect to that. So that's one thing. And I think the other is actually the integration of AI into literally everything. I think AI is probably as big, if not bigger, potential than the advent of the internet. And I think the ability to use AI is a defining feature for the future of traders and, industries writ large. So that's another massive thing that I spend a lot of time on. I use pretty much every model that exists that I can find. I have subscriptions to all of them. And I like to, just like the paper trading thing, I like to give one a prompt and then give 4 other ones the same prompt. And I want to see the differences in what they respond with. So it helps me understand the strengths and weaknesses of these different models, what they're good at, what they're not good at, how good they are at lying to you, because a lot of them are. And I think that's super fun. So if people aren't doing that, I would highly recommend literally just download one of the apps and make it an effort to use it daily. Just anything, a thing that you normally would Google or a question that you might have. Start working on your prompt engineering, because that's going to be a massive component of your ability to be efficient with AI, which is it's literally revolutionary. So that's the other thing I'm obsessed with.
Oh, wow. So you're in the experimentation phase of the zero DTE combined with AI. Is that what you're saying?
What I use AI for there is to help me with the data analysis component. So I have a stats background, but there's still like so much more out there in terms of how to analyze things, conducting factor analysis to understand sizing filters. And that's all powered by AI now for me. So it's so cool. Like, one of my favorite things to do with it is I'll give it the output of strategy performance. And the first thing, I won't give it a lot of context. I'll tell it what it is, what it's designed to do. And I'll literally just tell it, like, conduct a comprehensive statistical analysis and identify anything that is interesting, like super broad. And then I just slowly double click into all the different things that it might think could be correlated, could not be correlated. And that is such an accelerator. Zero DTEs themselves, there's just a lot of evolution with how they're behaving. So thus the way that I trade them, it changes a lot literally in the last couple of years.
Do you have any plans to like automate that zero DTE, or make it more systematic?
Such an interesting question, because the only thing that I've ever really wanted to automate, honestly, is because I used to have like a completely automated trade log. I built it from scratch and it worked well, but then I started realizing that I had a lot of questions about things that I normally didn't. And I was like, I don't really love that. And my portfolio is never that big, right? Like I'm never trading 500 positions. So it's never anything that like I can't digest by looking at it. So the main stuff that I like to automate are a little bit more of the grunt work side of things, but I don't like automating the execution of stuff because there's still a lot of human element that I haven't fully sorted how to automate out. Like one of the things, for example, the last 4 days in SPX, the last 15 to 20 minutes, the market has made a big move one direction. I ran over it by it once with the zero DTE strategy. So then the next time I was just like, this violates the strategy itself. This should be left on. However, I'm going to take part of it off. And then the second day took part of it off and it worked. So then the third day I took the whole thing off and it worked. And today I was just like, I'm going to leave it on. Guess what happened? Got ran over. So it's like the model doesn't account for that. Now that's give and take, because if you do too much of that, then there's too much variance in what you're doing that you can't really analyze it, right? It becomes like, did you intervene in this one? What's the average P&L? But of those, what did you intervene with versus what you didn't? So you have to be really careful about too much, but I trust myself well enough at this point that I know in general when I intervene, it's value add. So that's a long way to say I'm not looking to automate that stuff. I mostly use it to automate the research phase of things so that I can screen, which is really time consuming typically.
I'm actually very happy to hear that like you wouldn't want to automate like the execution part and things like that, because that just tells me AI is not completely taking over.
And the thing that I remind retail traders of specifically is like, AI is not new, dog. It's been around for a while. Like all these high frequency trading firms, they're all running really sophisticated algorithms. That's all fully automated. So it's not like this new thing that's about to change everything. It's been around forever. But I would always offer that the way that institutions use it it's very different than the way a retail trader might use it. And it's because of their built-in advantages. Institutions are competing in a latency world that like a retail trader can't even freaking see. So you're not going to compete with them on that. So the only reason to automate from a retail trader lens is more for your convenience, but very rarely will your convenience lead to better performance, right? How many things follow that model? Not saying it's never the case, and there could be instances where it might, but automation is already here. It's been there for a long time. Institutions have been crushing it with automation, and you can see some of the negative artifacts of that in terms of intraday vol based on essentially nothing. So there's some downsides to it, but I think in terms of automating execution, there's nothing wrong with it if somebody prefers that path. But yeah, I still much prefer to be the button clicker. Again, I'm not trading at thousands of trades a day that like I can't sit there and click the button, and being closer to the information has always helped me. It's never hurt me. I've never said like, oh, I don't need to know this about this. It would make me better. Always the inverse.
You also mentioned something you were a project you're working on with an options backtesting trading or backtesting tool.
Yeah. Mm-hmm.
Is this something you want to share a little bit? Or
it's still all in kind of development, so it's nothing really worth directing people to. The main thing I'm trying to do with that, the scope creep is happening big time. So I have a buddy that he's like my resident nerd, but I played rugby with him. So he's the dude that I normally work with on this stuff. And he's just like, okay, so, this is what we talked about doing. And I was just like, but what if we add this? And there's been a lot of, but what if we add this to the scenario? So I don't know if it's ever going to be done. I like it, but it is just so funny to me because I've never like built a product before like that. And I fully understand the scope creep, because every time we're talking about it, I was like, yo, it would be so sick to include this and then this and then this. And then all of a sudden the project is huge because it's so far beyond just a backtesting tool now. It's not funny. It like analyzes trade logs and it gives you summary statistics on it. It gives you predictive analysis based on timing of entries and stuff. It's cool, but it's a giant mess. So yeah, it's a fun project, but really nothing to point people towards because it's probably not going to be ready until I'm dead, I assume. So yeah.
Well, keep us posted if you ever need a tester.
Yeah, I will. Right now, it's a giant mess. It reminds me of my trade logs. My trade logs, like for a normal person, I've had like my friends look at it before, and they're always just like, "Dude, what is this?" I have no aesthetic design part of my body. So everything is condensed into the smallest amount of space so I can see the maximum amount of information per space. So yeah, it's a bit of a headache. But yeah, actually, it would be kind of cool to get somebody to take a look at it at some point, even just to see like what the reaction is. Because for me, I look at it, I'm always stoked. But I imagine somebody else would be looking at it and be like, dude, what is this?
Well, Eric, it's been fun. Thank you so much for letting me pick your brain today and for you to share your wisdom and knowledge. Thanks for coming back on Chat with Traders. And for listeners that want to connect with you, what's the best way to reach you?
They could go to my website, outliertrading.io, or YouTube at Outlier Trading. Either of those are great. I'm actually like really stoked to hear the things that you're working on. There's a bunch of things that we didn't get a chance to talk about today. So I definitely want to touch base with you again, either on one of these or offline, because I think one of the coolest things you have access to as an options trader is a lot of different kinds of profit mechanisms, right? Like a good toolbox. Mm-hmm. And you're starting with some really great tools in the toolbox, but I want to see what else is in there and how it's working. So definitely have to chat with you again.
And I enjoy your content as well. You have so much out there, so much information. It's you guys listening, you need to check it out. Well, thank you, Eric.
Thanks for being here.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
The learning curve of going through how a quantitative strategy works will set you up for the rest of your trading career. Number one, both in hard skills and understanding what it takes to be consistently profitable over time. Because these strategies, even though they are robust and sophisticated, they may work today, they may not work tomorrow. And what do you do when you get to a point where you put so much time and energy into a strategy, but you wake up on Friday morning or Monday morning and it no longer works? The answer is you need to figure it out, right? So getting into a position where you've had that experience to not only build a strategy, understand the variables and the testing measures that go into it and really creating alpha, but also being able to create strategy logic. What is the strategy built for? How can I ensure that the logic is sound for each variable that I've put into this so that it makes sense and it's not just a black box of noise, really? Once you've got that element down and you understand how the logic of different trading systems and strategies work, be it binary variables, again, be it the risk management side or trade management side, you're then set up to create strategies, be it discretionary, systematic, or quantitative, for the rest of your life for the most part.
Markets, speculation, and risk. This is the Chat with Traders podcast.
You're tuning in to Chat with Traders, episode 302, and I'm Tessa. And before we introduce our next awesome guest, I just really want to welcome you and to let you know that it's really been an honor and great privilege to be the producer and your co-host on this podcast. And I think I can speak on behalf of my co-host Ian Cox as well, that we really appreciate you. And although we don't personally know most of you, but wish we could, we really hope you are doing well in every way. Now, I know I mentioned I am a producer and co-host, but I would call myself a trader first. A trader who happens to co-host and produce the podcast on the side. In a way, this is like a public declaration for myself, because when this wonderful podcasting opportunity was introduced into my life 3 years ago, when Aaron, the original founder of the podcast, stepped down and I took over, for a while, my trading had to take a back seat. Although it has been truly fulfilling to run a podcast, and it still is, believe me, but I had to face the question on what's priority? What do I really want? Because it was really a struggle to juggle. And I regained my clarity a year ago when I decided that trading needs to come first in terms of my career and what I want. So that clarity really helped me to bring things into order and focus. And I'm sharing this because I know some of you might be going through something similar right now, struggling with what you really want to do and what your priority should be. And since we're at the half-year mark of 2025, this might be a great reminder to reassess your goals and gain the clarity that you need. Well, our next guest, Dylan Maltman, an intraday futures and forex trader and founder of Apex Capital Management, must have had exceptional clarity starting at a young age. Introduced to the markets in a high school presentation by a prop firm, Dylan caught the passion for the potential of the markets and persuaded his way into a position at the firm. Learning about backtesting, he became obsessed with dissecting every nuance of past data so as to create a system with high returns and with minimal drawdowns by understanding where edge can be found, as evidence in the performance of his algorithmic strategies. Oh, and this episode also includes my one-on-one with Dylan at the end. Ladies and gentlemen, we are so pleased to present Dylan Maltman from South Africa.
Dylan, I would like to welcome you to Chat with Traders.
Ian, absolutely fantastic to be here. Thanks for having me on.
Well, you sound like you have an accent. Tell us where you are and where did you grow up?
Yeah, 100%. So the accent you're hearing is first and foremost South African. So I was brought up here in Cape Town. Growing up in South Africa, it's an amazing place. If you ever get the opportunity, definitely come through. Beautiful sunsets, warm weather, very much salt of the earth type people, hard workers. Obviously, finished my schooling here, and then I studied in Italy, spent some time offshore. My first introduction to financial markets was really, I think, from my mother. So she was or is an actuary, so very much risk orientated mentality from day one. And we actually had a hedge fund manager come to my school when I was in grade 11 in my final year. Um, and at the time, that whole world was only just opening up to me. You only really begin to understand these things once you get into high school, and it just sounded extremely fascinating. So I had the opportunity to spend some time with them, learn how hedge fund and more prop style trading worked at the time, and that was my real first introduction to the space.
This was in high school, so was this hedge fund presenting to the other students in the class?
Yeah, exactly what it was. So typically what would happen in the high school assembly is, maybe once a month or once a quarter, they'd have either one of the parents or one of the colleagues of or the alumni of the school come through, and they would just give a presentation on what kind of career paths and options are available. As would happen with a high school. That's a very normal thing kind of down here. I don't know about the US, but that's pretty commonplace here.
So what kind of types of investment ideas did this hedge fund introduce to you and the other students? And was there a particular type of investment that initially attracted you?
I think for all intents and purposes, they had a hedge fund on, but they were really more of a prop fund, to be honest with you. So it was very much a proprietary stock trading firm, but they had a hedge fund wing. And the way that they sold it was very much that financial markets are a place where billions, if not trillions of dollars are made and lost every day. And it attracts the best and brightest people to the field. And part of that is every day you arrive at the desk solving challenges. That's really the crux of the job. And you're up against the smartest people in the world. That was what really fascinated me. That was the original pull towards trading in general. Obviously, they spoke a bit about, they traded a lot of crypto and they spoke about crypto and kind of what that was about at the time. It wasn't as well known obviously as it is now, but that was the majority of the conversation and the original pull.
What was the first asset class that attracted you, and when did you open up your first account?
Yeah. So funnily enough, I traded for them. So after the assembly, I went up to the manager and said, look, I want to work for you. And then she said, listen, no, go and get your degree first. And maybe once you've got your master's and you've spent a bit of time at, an investment bank, we can chat then. And I think, naturally being a bullish teenager, the first thing I said was, look, I don't think you understand. I really want to trade for you. And she said, okay, fine. If you arrive on Monday, or it was a kind of school holiday the following week. And she said, if you arrive on Monday at 5 and you make the coffee and sweep the floors, maybe I'll let you in. And I think she was joking, to be honest. I arrived, and obviously she came in much later, but she was kind of like, what are you doing here? And I said, well, get here early. I got here early. I've been making everyone coffee. I thought that was the deal. So that's what ended up happening. And I think she just, she saw a bit of herself in me, and she said, look, let's give this kid a shot. If he becomes something, great. And that's where I first started trading. So we were picking crypto names for kind of macro swing positions, which went quite well. And I learned some more of the quantity stuff through the quant desk as well. Yeah, so that was really where my first quote unquote brokerage account came from.
Describe to us kind of your early time there at the prop firm.
This was going from 2018 into 2019. So really when that volatility spike in crypto really started to come back and volume started to move into that space, I learned very much a risk-on style of trading, which is really where the experience comes in. So I think contextually, if you put yourself in that headspace where you're starting to see volume pick up, you're starting to see these names start to move again, or at least substantially, contextually speaking, it was the perfect storm, really, because, they had the data and the quantitative side to say, look, this is when you want to start buying. This is when you want to start looking for volume, standard deviation breaks and ATR breaks and all that kind of thing. But at the time, that was my introduction to trading, which was inherently aggressive just because the timeline of when I learned was just an aggressive market cycle, if that makes any sense. So I learned a lot of the basics, market structure, volume profiles at the time, where they were relevant, learning about narrative, things like that. that was really the fundamentals of where I started there.
And then how long were you in training, so to speak, or in this initial learning phase before you were able to click the first button to buy or short?
By myself, for full transparency, I don't think at the time by myself I was able to make any important decisions. It was very much a team effort, which I think was a really important start towards my trading career. I really started clicking the actual button with the team from day 2, day 3, learning alongside the traders next to me and the quantitative and fundamental guys. But like I said, it was very much a team effort. I wasn't making any of those decisions myself, as I think is appropriate. You trade for a prop fund, you've got to go through your school fees phase, so to speak.
So it sounds like you hit the market right at the right time with the volume and activity really picking up. How did this time period go for you and the hedge fund as far as profitability? Did your strategies work out, at least initially?
They did. Again, I think it's important to remember that this was really the start of when everything started to go up. So it was really the bottom, so to speak, in a lot of ways, especially for your alternatives like your altcoin and the I'm not going to say the word, but the small coins at the time. It was really where the bottom was starting to kick in. No, we did very well. We did very well. I think for that period, I worked on a more aggressive style fund where we were able to take on a bit more risk. I think we 3x the portfolio within the 6 to 8 month period. So we did well. We did well.
Mm-hmm. Well, and now are you trading your own personal account at the same time or just dedicated to the prop firm?
Just the prop firm. I think at the time I was fully cognizant that, there were much more advanced, more sophisticated members on the trading team that were trading their own accounts, obviously linked to the prop firm, and that's kind of commonplace. And I knew well enough that if I had to start on my own account, I wouldn't go anywhere very quickly. I think I'd be setting myself back, creating bad habits and whatnot. So primarily prop stuff.
So this is going well, and you guys are making bank. How long did you stay there at the prop firm?
The firm did well. Obviously, I was just an intern, like the rest of the gents, but I made a little bit of money there. The thinking was, look, he's done okay. Let's give him a bit of profitability, and we'll send him on to when he's ready, and that's what happened. So that was that, and then following that, I obviously went to go study in Italy. During COVID, there was a small gap between when I started and when I finished, and then as soon as I got to Italy, obviously COVID happened, and that was a spanner that was thrown in the works. So I moved over to Italy. In Bologna, they had a phenomenal economics and finance degree, and then 10 days in, I got a call from one of the government representatives there, and they said, "Yeah, I can see on our system that you're here and you're studying, and it's phenomenal." And I said, "Yeah, having a great time. Why are you calling me?" And they said, "Well, there's one flight out of Bologna, and you need to be on it. It's in 4 hours. So I hate to burst your bubble, but if you want to go back home throughout this COVID thing, you need to leave." So that was a major spanner in the works for my family. And so then I had to come back after 10 days and then obviously finish my studies remotely. But I mean, there's stories about tons of people going through that experience. So it's not just me. So.
Yeah, just for our listeners, what is the difference between a regular prop firm and what they call the funding when you quote get funded? Are they the same thing?
Such a good point, Ian. No, they are explicitly not. So there's 2 primary distinctions that you never need to make here, right? So the first one is instrumentation. A brick and mortar proprietary trading firm is defined by a group of individuals that are trading their own capital or a firm's capital. So there's no clients whatsoever. And it is solely for the profit of those individuals and the firm. Okay? Very simple. Okay? There has been a rise in what's called CFD and futures profit. So CFD is contract for difference. Anywhere outside of the US, you can practically trade them. And that is a model where a brokerage is signing a contract with you with every position that says whatever the difference in the position is from when you enter to exit, I'll settle with you. I'll assume that exposure on my book. The other alternative is futures, and we'll get into that shortly. But for all intents and purposes, a prop firm, in the sense of getting funded, is a company that agrees, if you can trade by our rules, and you go through a kind of evaluation process to ensure that you do that for a fee, I might add, we will then give you a quote unquote trading account, which is 99% of the time not live. It is a demo account, and will give you a split of whatever you would hypothetically make on that account. There are exceptions. I know that there are firms that take the same route and they do fund some of their traders live. I'm sure that is, wouldn't say commonplace, but it happens. The majority of these funded accounts are not live. It is a business model like a casino, right? You pay your fee. 90% of people can't pass this challenge, and as a result, the business makes money. And whatever the difference is between what they make in from these evaluation fees and what their profit split is that the profitable traders get, they then just pay that out. So there is a substantial difference, and I think it's important to make that distinction.
Great. So you go back to South Africa and during COVID, and during that time you're still trading with the firm remotely, or you were trading just by yourself, or what?
At the time, I actually wasn't. I was still following markets substantially. It was my passion, and that was what I was focusing on. But I think just given the amount of turbulence that was going on in the world, it wasn't something that I wanted to commit to at the time. And that was obviously the time during COVID where Bitcoin really started to take off. I mean, that's when we were breaking all-time highs and we were absolutely flying. So I didn't fall apart at that run, put it that way.
Okay, so then during this time, what are you trading? What are you looking at, and anything stand out for you?
Yeah, at the time I was doing a lot of demo trading. I think the important part for me when I arrived back was I'm not in a position where I should be trading live capital. I think obviously financially it hit a lot of people hard. I mean, when I went to Italy, that was my kind of life play at the time, and having to come back and having to start over was a big challenge for me. So the immediate discussion was, I know what good looks like, contextually speaking. I'm nowhere near that, but I need to get there as quickly as I can. So it was very much coming back, learning about an algorithmic style of trading, binary variables, how to create strategies that work in the real world and not just on backtest. And then eventually putting that together into my own strategy. That was a 6-year period of learning how to do that. And then when I got back, while I was finishing my studies, I actually worked for a CFD firm, a sell-side derivatives firm. And that took up the majority of my time.
So you're learning how to create these quant models, doing a bunch of back testing on, give us an example of some markets that you're doing back testing on, and what you found.
Yeah, absolutely. So my immediate exposure was to FX. I knew that FX was, for all intents and purposes, the most widely available instruments that one can trade as a retail individual. And likewise, a lot of the platforms, or the most popular platform for CFDs at the time, had a somewhat quantitative trading platform where you could optimize strategies and backtest on historical data and things like that. That was my real introduction. My initial success in that space was very much in your exotic FX pairs. So things like dollar rand, your crosses like Euro GDP, that worked very well for substantial amounts of time. And then also a couple of the majors, Euro USD obviously is something that you want to look at if you're trading FX. That was where I started.
What attracted you to these more obscure trades? Is it because there's less competition, or is there a particular advantage due to presumably less liquidity, right?
Yeah, definitely less liquidity. When you're trading derivatives, liquidity isn't as much of a challenge because you've got a market maker or liquidity provider on the other side. The real element retrospectively that drove me towards that side was because of the volatility associated with these pairs, they tended to be more directional, and you were able to catch directional edge a lot easier with the quantitative model, especially on such a surface level. That was just where the alpha was at the time, right? Like if you look at something that's maybe a bit more range bound, especially at the time like Euro USD, the level of variables and understanding of how these models work was a lot more sophisticated to create genuine alpha. Whereas on your exotics, when liquidity wasn't an issue because you've got those market makers and liquidity providers, it was a lot easier to just go, look, we've been long for 3 months and we're probably going to be long for another 3 months. So your directional bias is going to be long, and now you just need to create an entry model, risk management plan, and trade management plan, and you're good to go. That's just where the strategy drove into. It was very much a circumstance of, I'm going to let the alpha decide what's working, and I'm not going to dictate what needs to work, if that makes any sense to you.
Mm-hmm. So did you have much of any experience with discretionary trading? And if so, how did it go?
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including zero commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
I did have experience with discretionary trading, again, with the team. So they had some guys that were very good at discretionary trading, but that said, they were experienced. I think one of the first big lessons I learned was that discretion you learn to do either with a mentor or you're going to pay your school fees in the market. Hence why I went the more systematic and quantitative routes, because you're dealing with binary variables and those aren't subject to change, at least in the beginning phases.
So how do you go about doing back testing? Because I've heard people say, oh, you should only back test for the last 5 years, or you shouldn't include exogenous events like 2008 and the COVID crisis, because then it distorts everything. So what's the process that you implement in this?
And it's a great question, and I think the most simple answer and indirect one is it depends, right? There's more than one thing that works in the market. There's more than one. But we have our own internal IP of how exactly that works, right? So firstly, let's start with time frame and let's start with the amount of data that one needs to consume. So obviously, depending on the time frame that you choose, if you're trading the 1 minute, the tick chart versus say the 15 minutes, you're going to have a very different level of data and time frame. I think the important part firstly is to acknowledge it's about data points and not necessarily a certain amount of time. Right? Because again, we could say 5 years, but 5 years on a 1 minute versus 5 years on a daily or weekly chart are very different sets of data. So you want to ensure that you've got a substantial amount of data points to deal with. For us, that typically is anywhere between 5,000 and 10,000 data points. But again, currently we trade a lot of tick and 1 minute and kind of second related charts. So for us, it's really important to consume a lot of data. The other challenge when it comes to backtesting is the curse of over-optimization or code fitting, right? So for those who don't know what that means, it basically means if we had a bag of Skittles, you've got Skittles where you're in the US, obviously, and you must have them. So if I've got a bag of Skittles and let's say that I pull one red Skittle out of the bag, and then I go in and I happen to pull up another red Skittle, it's fairly logical to make the assumption at this point that if you haven't seen the rest of the bag and you don't know what Skittles are, the color of those sweets are just red, right? So if I then say, okay, I'm going to start taking bets with people who don't know what's in this bag, and I still don't know what's in this bag, but I can make an assumption that every Skittle is red, you're very quickly going to understand that you're going to lose money that way. That's called code fitting, creating a strategy that is very and extremely optimized for a subset of sample data, but not necessarily all of the outcomes in the data that's within the market, so to speak. Right? That's how that happens. So how do you avoid this as a trader? Well, the first thing that you do is you need to test for what's called robustness. There's a few ways to do this. The way that we do it is we do something called non-consecutive sample testing, walk forward optimization, and out of sample testing. For all the quants and systematic guys in the audience, this is going to make a lot of sense. This isn't brand new information, but it's really about going, let's test and create a strategy on, say, 10 data points. Okay, we're happy with how this is working. We're happy with how the strategy is performing. What we now need to do is take that strategy and test it on a separate set of data points. Call it the next 20 or 30 data points, right? Based upon those results, you're going to get a very quick understanding that creating strategies is difficult, because the majority of the time that's something that works. When you find something that does work, okay, so test it on your first 10, and then you test it on your second and third set of 10, and it still works. You've then got something that has legs, okay? So then what you want to do is do a round of optimization. You want to make sure that if we, say, test this data on another 50 data points, that not only is it sound, but we can optimize each of those variables in the trading strategy to that set of data, and it's still going to work, right? So we really want to get into the weeds of how we can refine these things over time. If we're able to clear that robustness test, the last step for us is called non-consecutive sample testing, okay? So by this stage, we've maybe tested, just based off this conversation, we're looking at 60 or 70 data points, right? We now want to look at the last 30 to 200, right? So 30 to 200 total data points, so 30 or 130. If the strategy still performs over that period, that's how you create a strategy that's going to work in the long term. Because not only have you tested over a specific sample, you've tested it with out of sample data, and you've done something called walk forward optimization. You've optimized the strategy for periodic sets of data and check if it still works, and it does. That's how we created strategies.
Okay, so given that quant trading's been around a long time, and you have a lot of different groups doing all these kind of back testing, and I've even seen some programs for sale. People have created these algorithms and stuff. I imagine what you're doing is probably pretty time consuming. Wouldn't it make more sense for your typical trader just simply buy an off the shelf program, since other people have done it before, and save ourselves a bunch of time?
It's a good question, and I understand the logic. Personally, I would say no. And again, there's going to be exceptions to it, but here's why. Typically, when you create a strategy that makes alpha and does so in a sustainable and consistent way, there's more capital to be made from trading that strategy, either through a hedge fund, a prop firm, etc., or selling it to an institution, if that's the route you want to take, and selling it to the public. I have yet to see a consistently profitable strategy that's sold to the public, especially when you look at a price point of a couple $100 to maybe a couple $1,000. These strategies typically have extremely high valuations when they are sophisticated. And generally with those risk return profiles and return consistency, they are generally very sophisticated. It's not an off-the-shelf product you want to buy. But what I would recommend, and again, just because I've gone down this route personally, is I would recommend putting the work in, even if you are a manual, discretionary, or systematic trader. And I'll tell you why. The learning curve of going through how a quantitative strategy works will set you up for the rest of your trading career. Number one, both in hard skills and understanding what it takes to be consistently profitable over time. Because these strategies, even though they are robust and sophisticated, they may work today, they may not work tomorrow. And what do you do when you get to a point where you put so much time and energy into a strategy, but you wake up on Friday morning or Monday morning and it no longer works? The answer is you need to figure it out, right? So getting into a position where you've had that experience to not only build a strategy, understand the variables and the testing measures that go into it and really creating alpha, but also being able to create strategy logic. What is the strategy built for? how can I ensure that the logic is sound for each variable that I've put into this so that it makes sense and it's not just a black box of noise, really. I think that's really important. Once you've got that element down and you understand how the logic of different trading systems and strategies work, be it binary variables, again, be it the risk management side or trade management side, you're then set up to create strategies, be it discretionary, systematic, or quantitative, for the rest of your life for the most part. Alternatively, you're going to go to someone who's maybe made a strategy. You don't really know how it works because you didn't put the work in. They'll release an update, but ultimately, because you purchased the strategy and it's your own capital, they aren't liable if anything goes wrong. There's also an accountability shift that happens there. So succinctly put, do the work early, get it out the way. It will do you good in the long run.
And how do we define what doesn't work? Because there's a certain time period, right, that everyone expects a drawdown. And during the drawdown period, I'm sure many traders say, oh, well, I just need to wait a little bit longer. My system will work. It's worked in the past. It'll come back. At what point or how long should one wait before you throw in the towel and realize, oh, my strategy really doesn't work?
And this is the black box thing, right? Mm-hmm. And this is why logic is so important. If you understand when and why a strategy works, you'll know when it's not working because you'll be able to point towards the variable that is supposed to dictate that you're working. I'll give you an example. Like, let's look at like an intraday breakout strategy. Okay. Mm-hmm. So let's say we're trading NASDAQ. We've just gotten to the New York session. It's the first 15 minutes of the open, the most volatile time. But we can see that the average daily volume, so over the past 100-day period, for example, how much volume have we done to that point relative to the past 100 days of average volume? Mm-hmm. If you've only done, say, 14% of volume, okay, by the close of the first 15-minute candle of the US session, logically speaking, and you understand how markets move, breakout strategies are not typically going to work in that environment. Be a breakout strategy. For this to work, I need to see this amount of volume happen within the first 15 minutes and within the first, call it 12 hours of the day. You then are able to pinpoint, look, it's between June and August. The majority of the intraday traders and the big banks are going on holiday. There just isn't that much volume surging through the market right now. And again, I see that we've only done, say, 14% of the average daily volume within this 15-minute period. The likeliness of this working is not high because the core variable we need is volume. If the volume is not there, the breakout's not probably going to work. So maybe we look at something else, mean reversion, arbitrage, things like that. So that's why it's so important to really understand, why do these things work? Not does it work? That's a very good question, but why? And when you understand why, you then know when it doesn't work and when it breaks. Does that make sense?
Yes. So you mentioned the breakout volume. Are you only looking at the individual security and their volume, or are you also looking at the market volume to see how sustainable that might be?
You can look at both. You can absolutely look at both. This is where there's lots of things that work. There's many ways to skin cats in markets. You can look at both. And again, this is also about logic. If you're going to build a strategy that maybe looks at the index as opposed to the individual stock, let's refine that a bit more. That was a good example. If you're going to look at the futures versus, say, the underlying index, those are two separate strategies with different financial engineering and different options. And you need to cater for one of those, right? You can't necessarily pick one and it's going to work on both. So this is why getting into that logic is so important.
So do you focus just on FX, or are you looking at, do you also trade other markets?
Maybe I need to catch up from where we were to kind of prop firms during this stuff until now. So after about 2 years of working for CFD and derivatives firms, I had some exposure to a few hedge funds in South Africa. And there was a consistent point where I realized that there's a substantial difference between the asymmetry of a proprietary trading firm. You can lose a lot less and make a lot more versus most hedge funds. Most hedge funds don't have a very good risk return profile. I mean, if you look at the sharps of, your very big boys like your Citadels, for example, and they have a different set of variables. Trading that kind of size, I think it's unfair to expect super high sharp ratios and asymmetry, but you get the point. Most hedge funds just don't have that amount of asymmetry. When I saw that, it baffled me a bit because I thought to myself, I thought trading is supposed to be asymmetric. Why do I have to risk 1 to make 1 or risk 1 to make 0.7? That doesn't make any sense. Why would anyone do that? And that's when I began to realize, well, there's this special thing called prop trading that most people don't actually get access to. There's demand for this product. If you had to go to a lot of other multi-strats or family offices and say, look, I've got this product that outperforms your traditional long-short equity or macro hedge fund. Here's the data. Let me show you how it works. That's a product that would be in high demand. So as a result of that, I ended up saying 2 years later, I'm in my 20s. If there's ever a time to go risk on and build a business, and a good one, it's now. It's not going to be when I'm 50, right? This is the leap of faith. So what I ended up doing is I built a team. We created a company called Apex Capital. We raised some equity capital for that, and we have some phenomenal investors who've been very helpful throughout this period. And we incorporated our own proprietary trading firm. Again, all guys in our 20s. We've got a phenomenal team with some substantially experienced traders, far better than I am. I'm very lucky. And we trade futures intraday. So we created a strategy that was first and foremost meant to be liquid. So this is something that you can withdraw from and play with in terms of liquidity. Secondly, extremely asymmetric. So again, we're not risking 1 to make 1. We're risking 1 to make 5, 6, 7 and above, for example. And we need to have a defined logic and a defined edge. We need to know our niche of what we're good at and stick to it, not kind of drift too much from side to side. And that took the shape of a core trading team of 4. Was spread across most CME liquid futures sectors, so things like NASDAQ, S&P, natural gas, gold, crude oil, and then we have got some FX exposure as well when it moves and it's got the volume.
So it looks like you look at a wide variety of markets then. Do your algos, do they look at, once you got it down for one market, does it apply to all the markets, or do you have to go back and test it for every single market again and again?
So the logic works. The logic of how does it break out versus mean reversion strategy or arbitrage strategy, that works pretty much consistently across all centralized futures markets. Again, this isn't something that will necessarily work on crypto, which has its own advantages in different spaces, but the logic works. Obviously, when you trade these instruments, particularly on an intraday basis, you begin to realize very quickly that you're dealing with different participants who are all optimizing for different outcomes, right? So they've all got, quote unquote, their own personality, if that makes sense, right? NASDAQ behaves differently to natural gas or crude oil. So it is important to have, say, a set of foundational philosophies that are important. But on top of that, you need to cater for each individual personality, right? It's like inviting your friends to a party at your house, drinks at your place. You're going to invite everyone through, but not everyone likes to drink champagne. Some guys are going to want water, some guys are going to want beer, but they're all at the party, right? They're all at the same place. Does that make sense?
Yes.
Yeah.
You mentioned earlier about using order flow to confirm directional volatility in your strategy. Can you break that down a little bit more?
Yeah, absolutely. So I'm going to give an overarching view here. So we base all of our alpha on 3 core principles, right? So the first one is order flow. Order flow, in essence, is a skill where you are dissecting the volume of a particular asset over a given period to get a better sense of what the underlying participants are doing. It's basically how you're able to read the heartbeat of the market just before it's about to snap, right? That's what order flow does for you. Admittedly, it does have a bias towards shorter timeframes in our experience. But again, if you have got that shorter time frame bias, just naturally as a trader, you want to have a look at order flow on your centralized markets. So that's the first thing. The second thing is asymmetry. It's important for us to, again, find our niche. And our niche is we're good at high expected value strategies, particularly ones that you can risk 1 to make 3, 5, 7, etc. Right? You can get high expected value strategies risking 1 to 1, for example, but that is a completely different set of skills, in our opinion. The final element that we focus on is risk management, right? Risk management in itself is also an edge, and I think there aren't enough traders that pay enough attention to it, right? So again, understanding maybe the biases of your strategy from a risk perspective and catering a model that can trade on top of that risk management strategy, whilst not necessarily optimizing for return only, but also optimizing for a smooth equity curve, things like Sharpe ratios, things like that. But let's get back to your question, order flow specifically. Order flow tells you who's buying, how aggressively they're buying, who's selling, how aggressively they're selling, and who's winning. And again, because we're trading markets that are developing on an ongoing basis, right? The guys who were buying or selling 30 seconds ago are not the same guys that are buying or selling now, right, in the present, and won't be the same as the guys buying in the next 5, 10, 15, 30 seconds. Like I said, it tends to have a bias for the short term. But if you're able to use that as a confirmation signal, perhaps for an entry, even if it's on a swing position, there's a lot of edge to be had there. Hence order flow. I mean, it's phenomenal.
Isn't it common, though, for both buyers and sellers to break up their orders into a whole bunch of small lots, 100-share lots or whatever, and disguise this? And how does one detect this kind of hidden way of accumulation or distribution?
Yeah, you're getting into the real alpha questions now. That's a great question. All right, so let's use that example specifically. All right, let me ask you again: who are going to be the entities that are going to be doing that, breaking up orders?
The market maker, I would assume, right? Or whoever. Yeah. Mm-hmm.
Yeah. So they'd be acting as an agent for somebody else. So there's a fund. Let's call it Ian's fund capital, right? So Ian, you call up your investment bank and you say, buy, I don't know, 200,000 shares of the stock. The guy on the other side of the phone says, yeah, Ian, sounds great. I'll have that done for you at VWAP today. What that individual is incentivized to do is to execute your order without increasing the cost of the order or the slippage of the order, right? Because if you just buy market at one single time, 200,000 shares, depending on the liquidity of the asset, you're going to eat up that order book, you're going to get slipped, you're going to get a terrible price. The investment banker or the sell-side trader, he's going to break that order up, okay, into smaller pieces. I know this is very simple, but you'll understand why we're walking through it step by step. So he gets on his trading platform. He's starting to execute your orders. If you were an investment banker and you're incentivized to get the best price possible, what kind of order type are you going to use ideally?
Presumably limit orders, right? A whole bunch of limit orders. Yeah. Mm-hmm.
You are spot on. Absolutely, right? So now we've just brought up this thing of passive versus buying. It's like passive versus active participation. Again, in layman's terms, your passive participation is a limit order who's adding liquidity, stock to the market, and you've got active who is removing liquidity or stock from the market. So yeah, let's look at this example. Now that we have this information in mind, let's look at a breakout trade. Okay, we've got a breakout trade. We have price reaching our level, let's say on the 1 minute, and we can see in the order flow that there is an influx of buying. Okay, an influx of buying is demonstrated by what we call positive delta. Delta is just a fancy term for what is the difference in buying or selling from active participation. Okay, so the volume. If you took the volume bar, you split that between buyers and sellers. Are there more buyers in that candle or are there more sellers in that candle? Right, in terms of market movements. Now, if we had a circumstance where we have price breaking out of a certain level to the upside, tons of positive delta, tons, okay, abnormal positive delta. But price moved up above that level, we're looking at a long example, and then declined again below the level. Something intuitively doesn't make sense there. You've got all of these buyers pushing price beyond this point, but for some reason we can't close the candle beyond that point. How does that make any sense? The answer is limitless. There are resting limit orders that are absorbing all of that buying pressure to the point where there is now an unfair fight between the guys who are buying and the guys who are selling. It takes so much more buying power to breach that resting sell order than it is for maybe aggressive sellers to go, look, this is very normal selling pressure that we can put into the market here. Buyers clearly can't raise price any further. Let's just keep selling and it's likely going to tank the market. There's a level of asymmetry there, right? That is the kind of information you can obtain via order flow. And yes, you may have, your institutions that are breaking up orders into multiple orders, an iceberg order. That's completely common. But these are still things you can see and read either via the tape, via a footprint chart, via a cumulative volume delta chart, things like that. And this is why order flow is so asymmetric, right? It lets you see behind price and see what the actual participants are doing and what that level of participation looks like.
So are you looking for a setup where the limit orders on the top end, the potential sellers have exhausted their stock, and then at that point, then you say, oh, look, the sellers have exhausted their stock. Now's the time to go in because it looks like this breakout is going to be more sustainable?
That absolutely is something that we look for, right? And that's a common breakout. There isn't enough liquidity to hold buyers back. Buyers are eating up all of that liquidity, and we can break through that level and keep breaking out, right? Absolutely. We also look at the previous example, which we call absorption. Well, not we, but that's just what the sector called absorption, where there is so much stock available that there isn't enough buying to get through that massive order. And now there's asymmetry between buyers and sellers. Sellers are going to take this down. That's also a setup that we look at. And there's tons of these things. I mean, there's a whole world we can get into in terms of what's possible on order flow and all of these setups and confirmations. But yeah, absolutely.
For your fund, for you and for your fund, are you just a super short-term scalper where you take positions for longer periods?
Look, we can take positions for longer periods theoretically. There is edge there. For us, because we wanted to turn this into a hedge fund product, for all intents and purposes now, we are not a hedge fund. We have a waiting list of clients who want to purchase into this hedge fund. And I think once we get to a critical mass point, we'll get there. But for right now, we're just a proprietary trading firm. We're trading our own capital, shareholder capital. Because the end goal has always been this hedge fund product, we're putting all of our emphasis and resources into refining what the intraday systems look like. Again, only trading within that US session, like you say, scalping. I mean, our average trade time is about 6 minutes, although we do have kind of the longest trades we've taken off, say, mid-London sessions at the close of the US, but all within that 1 day time frame. But again, I think with order flow and all of these tools, there's edge on this on all time frames. Obviously, there just is a bias for that kind of shorter term element.
Mm-hmm. And then, so over the years, as you've learned and implemented, developed out your strategies, how have your kind of returns, drawdowns, different metrics, Sharpe ratios evolved over time?
Also a phenomenal question. So, look, naturally, when you start trading, you're going to be shocking. There's just no way around that, right? So I think right in the beginning, when I started trading by myself, naturally, the returns were negative. They weren't good at all. And it was a major learning curve and a humbling experience. Since then, we've primarily through our risk model and through the order flow elements of those three philosophies that we have, we were able to optimize for better investment metrics, things like your Sharpe ratio, your Sortino ratio, Kalmar, etc. Currently, our Sharpe ratio is doing very well. It's in excess of, I know it's in excess of 3. Last time I checked it, I think it's in excess of 6.
Wow.
Yeah, it's doing phenomenally well. Our Sortino is in excess of 9 as well. To date, we've returned just over 30% into the fund. Well, the simulated hedge fund, the prop side, we traded a higher risk model just because obviously it's more appropriate to trade our own capital, the higher risk model. But for the hedge fund, which we report, so we've returned 30%. Mm-hmm. And our max drawdown as of today this year is negative 0.2%, negative 0.72%. So our Kalmar ratio is phenomenal. Yeah, it's going very well. The guys are doing a phenomenal job.
Wow, great. What if some traders came to you and say, hey, look, I don't have enough money to invest in your hedge fund or whatever, but I've been a discretionary trader for the last 2 years and I'm doing quite well. Why would I want to get involved in any of this quant stuff? My discretionary trading seems to work just fine.
I would say that's phenomenal. Good for you. That's great news. I think it depends on what your goals are. ultimately. Like I said, there's so many ways to make money in markets, right? There really are. There's so many things. If you are the kind of trader that says, look, I want to get not only returns, but I want to do that in the most asymmetric form possible, right? I would then say, look at order flow and look into the quantity risk management stuff, because that's where that alpha lies. If you're optimizing for that, you can capitalize on both sides of the expected value formula, and all four sides, technically speaking. Whereas if you're just trading things like price action and regular back testing and kind of those metrics, you can get return without a doubt. But it's not going to get you to that ultimate form of asymmetry that you're looking.
So what do you think are some of the biggest risks to discretionary traders, especially ones who have some early success and say, I've got this down. I'm doing well, and I'll just keep repeating what I'm doing. And what are some of the hidden traps that discretionary traders frequently don't look at?
Mm-hmm. Before I answer, there's discretionary and discretionary, right? I mean, there are firms out there. I know a couple of the guys at S&P Capital, there's Trillium, Kirshner. Like, there's some phenomenal firms out there that have just got a ton of IP towards discretionary trading, and they do so in such a way where they can trade discretionary in a very consistent way. I'd even argue that it's not discretionary once you get to that level of sophistication. It is systematic. You're just using your heuristics a lot more, which is phenomenal, right? Like, hats off to those guys. I think they're great. And again, just coming back to the original points, if we're defining discretionary as just not having a set of binary variables that you're ticking off before every trade. So if that's what we're talking about, I would say that the most face value elements is obviously just tilt, right? What happens when your calls just aren't there today, and you're trying to maybe force your own views on the market, and you just keep adding risk on the table into something that's not working? That's the first risk, right? The other elements of discretionary trading that I feel has elements of risk that maybe your quantity and systematic style guys don't have is the risk management side. There is so much more to risk management than just risk per trade and max drawdown capability. I'd go so far as to say the one thing that has made us immediately profitable is having a sound understanding of risk management and really diving into what that means. There are hundreds and hundreds of different ways that you can look at risk that really open your eyes, right? I'd say that those are the two primary challenges I think most discretionary guys make. Again, there are exceptions. I'm not talking about the super sophisticated, wonder kids out there. Yeah.
What about the issue of, say, position sizing? Have you found an optimum level of position sizing in your back testing?
Yeah, and this is just, you ask good questions again. I'm having a great time. Yes, so it all depends on tolerance, right? My level of risk tolerance is not going to suit yours or Tessa's or someone else, for example. I think first and foremost, you need to have an understanding of what your personal risk tolerance is and have a target, value at risk or max drawdown that you can incur in the worst possible scenario. So that's step one. Let's say that's 10% per billion. Okay, let's use 10 as an easy number. What's then really important to do is understand what does the drawdown capability of a strategy look like based on its inherent variables and expected value. And there's ways to test for this, right? So what we do personally, just to maybe get some game out, is we use Monte Carlo simulation. This is not new. But what we also do is we add a realism factor, because ultimately they're just simulations. They won't necessarily show you the absolute worst case scenario. You then multiply that by, say, an additional 20 to 30%. So you're exaggerating the max drawdown you can incur. What you then want to do is match that to be, based off the expected value, the maximum amount of trades you can, or negative trades you can incur within a kind of straight line, right? So how many consecutive losses can I make? Okay, so let's say that I want to target a negative 10% drawdown. That's what my exaggeration multiple gives me. That's my kind of target drawdown. I then see that based off my exaggeration multiple that I can incur a maximum of let's just keep it under easy 10 trades in a row of losses. What I'm then going to do is match those two together to get a risk per trade, right? At least as a baseline. So again, 10 divided by 10 is 1. So I'm going to be risking 1% per trade, for example. What's then really important too, when it comes to understanding risk per trade, is not all trades are made equal, right? There are going to be some A+ trades where, if you look at blackjack, when the true count becomes extremely positive, you want to start, doubling, tripling, or quadrupling your bet size. If you're playing blackjack, you don't want to be doing those kind of multiples per se if you're trading for a fund. But there are going to be times where your strategy is more potent, and there's going to be times where your strategy is more dilutive. In those environments, you want to have the flexibility to either increase size above your baseline or decrease size substantially below your baseline, right? And again, another piece of game here, maybe that would be valuable, is one of the elements that really worked for us in the beginning phases, once, before we even got into order flow, was anticipating, based on the variables that make our strategy successful, when we're going to see a reduction in performance, or performance dilution, as we call it, and substantially decreasing our risk. Substantially. I'm talking minimum to a third of the exposure to a tenth or even less. And why does this work, right? Why is that so important to do? Well, ultimately, trading is what you make versus or minus what you lose is what you keep. So if you can make as much as possible during the times that your strategy is most potent, and then retain as much of that when your strategy is more diluted, you're going to be making more in the long term. So number one, when it comes to where the edge lies, get a sound understanding of what's possible in terms of drawdown with your strategy. That's the first one. Have a firm understanding of where your personal drawdown limit is. That is extremely important, especially if you're trading on a discretionary basis. Your head is very important, your headspace and psychology. Matching those two together on an exaggerated basis. So give that a bit of leeway in case things go wrong. Things go wrong in the real world. That's just the way that things are. And then get so nuanced with your strategy in terms of variables that you can go, okay, if the volume is greater than X% by a certain time period in the day, or R vol is, 2 or 3 or 5 times its normal range if you're trading stocks, that is when my strategy logically and from a backtesting perspective is most potent. So when that happens, I'm going to add some. Conversely, that the volume is really not there today. It's a UK and US banking holiday. Okay, that the volume is maybe 10% of what it usually is. I'm not going to trade at all. If I'm going to do that at a third or a tenth of the size, so that if I lose, I'm not losing much. But when I win in my most asymmetric parts of the day, I'm making the most amount of alpha possible.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
So for our listeners who obviously hear that of the enormous amount of work you've put into this over the years, is there a way for traders to either plug in to your system or to your group and or to invest passively?
Not yet. So put it this way. This is a brand new venture for us, and we've got investors that are as priority. We've got a fund on the way that we're looking to get up and running, and neither of those two things are small tasks. I think, especially for a young team like us. I think what we do have on our side, obviously, like I said, is an amazing group of investors that have taught us a lot and have been patient with us. But also, we have the work ethic, and we have the ability to forecast where maybe what we call, it's not brilliance, but we call it brilliance. That's kind of the what the youth call it, right? Like you're young and hungry, and you want to make it work, but that only takes you so far. There is an element of experience that you maybe haven't gotten to that's going to limit you inherently. So right now, no, we don't have any form of plug-in or any form of passive investing that clients can get into directly. with us right now. He's publicly speaking. I can't say it's publicly. But there will come a time where we will have that hedge fund open. Like I said, we're raising on a wait list at the moment. So if there is interest, there's that. But we're in no rush, put it that way. We want to ensure that by the time that fund is ready, we have got all our checks and balances complete, crossed our I's, dotted our T's, and we're ready to rock without any hesitation. Well, not hesitation, but we're ready to rock without any box left unchecked, if that makes any sense.
So looking forward, tell us, what are you looking forward to? Getting everything, all the boxes checked? Yeah,
absolutely. I think something that we're focusing on heavily right now from a business perspective is institutionalizing. A large part of trading client capital when the time is right is trust. And there's nothing that says trust like secure and robust processes. Things like having the right kind of documentation involved so that when you have an institutional client knocking at your door asking difficult questions, you can already show them the documentation that anticipates and answers those questions. So that's the first thing. Institutionalizing is the big one for us. We've also created a substantial amount of new IP over the past 3 months. This IP has been amazing for the team to digest, but obviously when you find new avenues, there's going to be new avenues for you to digest from them, right? Like sub-avenues. So the team and I are not only working on the existing strategies, but strategies that could become valuable in time to come once we have additional resources. And other than that, I think just being in a position where we can disseminate additional value to other traders. It wasn't very long ago when we were struggling and we were trying to figure out how trading works in general. It's a challenging field to be in, especially when you do it alone. So being in a position where I wouldn't say we've got the secret sauce, but we're doing well and we can just provide some kind of direction at the very least to other traders who maybe in our shoes, call it 6 years ago, that's something that's been phenomenal for us to do. And we feel very blessed to do that.
Fantastic. Dylan, thanks for coming on Chat with Traders.
Thank you for having me, Ian. It's been amazing. Looking forward to chatting soon.
Yeah, great. And how can our listeners get in touch with you?
I think the best place would be through our website. So that's www.apexcptl.com. We've got forms for traders, investors, and interested parties to fill out there. That'd be the best place.
Fantastic. Thanks for coming on the show.
Thanks, Ian.
There were a lot of golden nuggets, and I admit I'm not a very good listener, and I would have to listen to this interview over maybe at least 2 more times to really not miss anything. But I remember you mentioned something about make your strategy systematic earlier as soon as you can. Is that what you meant? And so what stuck out to me is like if I'm not a programmer, if not a I don't know how to program or anything. And if I hire somebody or if anyone's interested in hiring someone to do the programming to make it more systematic, I mean, wouldn't we worry about that programmer who might steal our strategy or something like that? That's one of the things that I just always had in my mind.
Yeah, it's a great question, Tessa. So there's 2 answers to this, 2 avenues that I want to take. So the first one is that you don't actually have to code. I can't code for what it's worth, right? Mm-hmm. There are platforms out there that are no-code platforms that allow you to basically put in a preset of common variables that are very sophisticated. If it's market structure, volume, or even indicators, right? You can just plot in when RSI does this, and MACD does this, for example, do this at this size for this amount of time. You can put all that stuff in, copy the code, paste it into the platform, and it'll test it for you without even having to code anything. So that's the first avenue. There are ways to do it without having to create that kind of trust. Not to mention manual backtesting. I think manual backtesting, literally just with a piece of paper and a checklist, is incredibly underrated. Highly recommend if you can do that, if you're going down that avenue. In terms of the trust element between you and the developer, something that we've begun to realize, especially when we talk about our IP, because originally we didn't want to say anything about what our 3 philosophies were, how we do what we do, and trade types and stuff. Yeah. But one of our investors told us, no one's going to steal your idea unless you're driving several Ferraris, right? like if you think about people stealing your idea, there's so much sophistication that goes into creating a strategy that someone would objectively want to steal and incur that risk, that the likeliness of that happening during that period is so slim, like don't even worry about it. And if you are at a place where that is so sophisticated, you would have likely have built a team at that stage, or at least a contact that you can trust, right?
Mm-hmm.
That would be my kind of two avenues to think about it.
Yeah. That's helpful. Okay, another question I had, you mentioned a lot about risk management, and we know all that is super important. But what comes first, risk management or edge?
Oh, that's a good question. Risk management or edge? I would say edge comes first. And I'll tell you why. Risk management is pointless if you don't have something that works. Risk management is the thing that it takes you from good to great on something that is already working, if that makes sense, right?
Yeah.
Like picture a strategy that's for all intents and purposes, just excuse my French, crappy, right? It doesn't work, and you add superior risk management to it. It just means you're going to lose this. That's all it means. Whereas if you've got something that's sound and you add the risk management elements on top of it, your returns may be good, but with the right risk management, you've gone from good to great. Does that make sense?
Yes, absolutely. Yeah. I just wanted to hear you confirm that. Okay, one last question. You're so young. Remind us how old you are?
I'm 25.
Oh, so young. And you accomplished so much already. But I'm still going to ask this question. If you had to start over, would you do anything different?
If I had to start over, would I do anything different? Yes, I would. Mm-hmm. This is kind of a question where it's also like if you had to give yourself advice now looking back. Right?
Yes.
Yeah, definitely. For the guys that are just getting into trading, and it is a passion of yours, and maybe even to a degree, if you've got something to prove, it's going to be a self-value thing, right? A lot of traders attach their value to what they do, and I think to a large degree we all do, right? If you're getting started, it's not going to work immediately. End of discussion, right? Especially if you don't have a mentor, and particularly if you're doing it alone. There is no need to hinder an already difficult process by beating yourself up for not being the successful trader immediately. Mm-hmm. And I'll tell you why. That negative buildup that you create in your head while you're trying to put the work in to just get ahead is going to hinder you. It's not going to benefit your work process or your workload. It's not going to get you to a point where you can operate more effectively or more efficiently. It's going to dial back your progress. It's going to dial back your enjoyment and dial back your efficiency. I think the most important thing is having faith in the fact that it takes time. It takes people years to just get profitable. I've seen guys do it in far less time, and you can definitely do it. The one thing that will get you there the fastest, aside from the work ethic, aside from the hard skills, is making sure that you don't beat yourself up for not being where you want to be. Focus as intensely as you can on enjoying the process, learning every day, and being thankful that you just get to take that extra step towards profitability. Does that make sense?
Yeah, that's so important. We don't hear that. We don't hear that enough, actually. People, giving guidance to not beat yourself up, because we do it all the time.
Yeah, and it's such a tricky balance, isn't it, Tessa? Because on the one hand, to be excellent, which we all want to be, we all want to be the top trader dog, like we want to be the big boy, or big girl, or whatever. We all want to be that person, and we all think like, look, I need to be hard on myself. I need to be hard on my performance. And yes, you do, right? But you don't need to disrespect your headspace. That's going to take you nowhere. It really is going to set you back. Mm-hmm. You can be hard on yourself, right? And be hard on results, but don't do it to the point where it hinders you. It needs to be an enjoyable process, because that's where that genuine inspiration and that work ethic and efficiency comes from. If you can keep that in a good space and just muscle yourself through that period and enjoy it, you're going to be unstoppable. Without it, it's just the way these things work.
Yes. Oh my gosh. Thank you so much. That is so good. We're absolutely going to include that in the bonus section. Thank you again, Dylan, and have a wonderful weekend.
You too. Tessa, Ian, thanks so much, guys. Really enjoyed the conversation. Take care.
Thank you. Bye-bye.
Bye, guys. Bye.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
Active traders, as you know, probably, the more you trade, the more likely you are to lose money. Trading is not easy. Unfortunately, active traders tend to have, in general, they're very emotional. They tend to lose and struggle. They can't follow strategies because the news scares them out and they've skipped trades or don't want to get out of a loser because they don't want to be proven wrong. They won't get out of a winner because it's working. I built up enough wealth that I'm like, you know what? I just want to manage my large amount of capital in the easiest way possible, where I have the fewest trades per year. I can make the highest possible return with the lowest risk. Really, I only have 5 to 12 trades a year. It allows us to all just live our life, do the things we want, and pull money out of the market without all the emotions and without the news and the stress. We could care less what the president does and tariffs and the Fed does and all that stuff. It doesn't matter because we just follow the price action. Our strategy says, hey, things are getting weak, move out of this asset. Things are getting strong, move into this asset. Here are the targets. Here's how we manage portfolio allocation. 1 ETF or 2 ETFs, I can manage my entire portfolio. I like those big moving beasts because they're liquid. There's more to life than just glued to a screen and working, trying to make day trades.
Markets, speculation, and risk. This is the Chat with Traders podcast.
And we're back on Chat with Traders. I'm Tessa, your co-host, and we're in episode 303. I hope you're having a great summer so far for those in the Northern Hemisphere. And thank you for tuning into our show from all over the world. We really appreciate you. In today's episode, my co-host Ian chats with a position trader, entrepreneur, and author. What happens when a teenager growing up without TV in rural Canada stumbles across CNBC in a college dorm and sees people making up to $100,000 in a day? For Chris Vermeulen, that moment changed everything and kicked off a 25-year-long journey of trading triumphs, painful losses, and profound strategy shifts. Chris has been through the tech bubble, the 2008 financial crisis, and everything in between. But he doesn't chase headlines or hype. He follows price, momentum, and something most traders overlook entirely, market vibration and cycles. From blowing up accounts to walking away from day trading altogether, Chris now rides the market's waves with a calm, calculated edge, making just 5 to 12 meaningful trades a year, knowing when to sit still and wait for the right wave. His approach might challenge what you believe about risk, emotion, and diversification. Ladies and gentlemen, we're so pleased to introduce Chris Vermeulen from Canada.
Well, Chris, I'd like to welcome you to Chat with Traders.
Thank you very much. I appreciate being here. And I'm excited to talk the markets and trading.
Fantastic. So where are you now, and where did you grow up?
I am just north of Toronto. So I'm in Canada, about an hour and a half north up on the Great Lakes, and beautiful, beautiful country. Lots of fresh water and mountains and hiking trails, fishing.
Oh, good. And what initially attracted you to the markets?
It's an interesting story because I grew up in the country and we never had TV. My parents had a satellite dish, but they never subscribed to it. So I grew up playing in the woods, hunting, fishing. I lived out in the country. We had ponds, and I played a lot of paintball and other sports, but never really had TV growing up. And so when I graduated from high school, I went to Toronto to college for business administration, and I got hooked in my dorm room on TV. There was Speed Vision and there was CNBC, and both of them were awesome. I used to build and make stuff growing up, so I love to invent stuff. But I got hooked on this, and this was watching people on CNBC and day traders making 5, 10, 100K a day in some cases. I was like, this is what I want to do. So that's kind of like a high level how I kind of somewhat got hooked on it. But how I actually really got hooked on it was when I was 16 in high school. This was the initial hook that got me into it, actually, which was my dad had got this package from Larry Williams, which is it was a marketing booklet on how to trade futures, pork bellies and all that stuff. I had no idea what futures were, but I read this, and I grew up in an entrepreneur family, so I look at everything. I'm like, how can we make money? I used to have my own little landscaping job in the summer as a kid. And so I read this thing on futures like 10 times, if not more. And I told my dad, I said, Dad, we have to get into trading futures. We can make like 50 grand a week. It's super easy. It's super fast. And of course, he kind of laughed, and he's like, no, we're not going to get into futures. He's like, I'm going to continue to do what I do. But he's like, keep learning. And so I kept learning about the markets. And then it wasn't long after that, in high school, we had a finance class where we had a stock market challenge. And back then, all the tickers were printed off in the newspaper. And so you go through the thousands of tickers, and we'd randomly pick one as a classroom. And we made like $180,000 in a semester with play money. And that opened my eyes. I'm like, okay, well, you don't need to do futures. We can just do stocks, and we can make a ton of money, like $100,000 account. We made a ton. So that got my teeth wet. And then that led to when I graduated from high school from that finance, one of those classes, when I got to college, I got stuck on CNBC and I just couldn't shut it off. It's like, that was my TV show. That was like my game, my sport, my hobby, my passion. And so I've been doing this since I was 16 years old. And I've just come full circle of trying almost every style of trading there is, and kind of learned to where I am today. So,
Did you have any other friends that were doing this at the time, or were you kind of the lone wolf? And what did your dad think of your enthusiasm, and was he investing in the markets?
Yeah, my dad's never invested in stocks. He's never been into the stock market at all. Still doesn't to this day. He runs his own businesses. He's big into real estate. He had about 1,600 doors at one point. Had dental clinics, had hearing clinics. Him and my mom had a bunch of good stuff going on. So they never got into the stock market. It was totally new. He didn't know anything about it really. nor did I at the time. So he thought it was interesting. I mean, he's always motivated. Both my parents have always been like, follow your heart, do what you love. And I grew up learning to work hard, and I'd always help my parents. My sister and I would help my parents run their businesses and stick flyers in the doors and go to events and work the booths with them and all that stuff for their various businesses. So my dad just was like, keep learning. He's always like, just keep learning. And so I grew up. My dad always had cases of cassettes in his car back in the day. And of course, they're all the motivational speakers and all how to make money on real estate. So I was kind of like drowned in motivation. My parents used to drag my sister and I to Zig Ziglar in Toronto. I got up on stage once with Zig Ziglar when I was like 12 years old. So I grew up in, I would say, almost like a perfect bubble in terms of surrounded with entrepreneurs, starting businesses, helping them, seeing how much work and effort goes into it. And then also understanding you need mentors and you need motivation, you need all of that stuff. And it just creates that a perfect breeding ground for an entrepreneur.
So when did you first open up your very first trading account?
I was 18. So I was my first year of college. I turned 18. It was with E-Trade, and I had to get my dad to co-sign because I was underage. I'd saved up $2,000, and we go to Florida. We have a place in Florida every year for Christmas and New Year's. We go for usually 3 to 4 weeks, and I bought Palm Pilot. This was like back in the tech bubble, and I put all my money into it. I'm like, this is it. The charts are like. And I came home on holidays, never even looking at it because I was just like, I'm just going to buy it and go on holidays. I came back and I had like $8,000. I was like, this is amazing. I sold it. I cashed out. I was like, that's almost the worst thing you could do as a trader is have a grand slam on your first trade, because now it's like sets the wrong expectations. But anyways, I took that money and I took courses in Toronto. I went to weekend seminars on trading. I met some people I'm still working with today in trading and stuff that I learned at these seminars on how to invest and how to read charts and all that stuff. So it was really good.
So after that first victory, what did you move on to then as far as trading? Did you jump into a bunch of other tech stocks? And what time frame, what year was this exactly?
What year was it? I think it was 1999 or 2000. I can't remember what year it was I jumped in and traded it. So that was a random trade. I just remember seeing Palm Pilot on CNBC. They're like, it has a pen on it. You can write on your phone. And, I mean, it was earth shattering back in the day, right? So I just bought it because their ads were like, I'm like, this is going to change the world. So I bought it because it was pure emotional. I just liked the product and I wanted one. But really, I had no real core strategy at that point. So I took that money and I put it into taking a course. I spent like $2,000 on a course from another company in Toronto, and it was based around a lot of like technical indicators, how to use specific indicators, moving averages, how to identify like finding the best stock to buy that's in an uptrend, and then selling covered calls on it. And so I did that for quite a while the stock market was still ripping higher. You could make back then with a covered call. I mean, geez, you could make 8 to 15% every month. You lose your shares, but you make it on your option trade, right? It was amazing. So I kind of got into that strategy because that's what I learned. That was the first thing I learned from like educated, professionals. It ended up backfiring and the tech bubble unfolded. I blew up my account. I had no idea how to trade a falling market. Everything looked like it was a steal, and you buy it and it keeps falling until you lose everything. And so I was buying, and part of this course I bought, this program I took, was to buy really solid companies on fundamentals. So you do a fundamental search first. Their software was really good. You find a company that's growing quarter after quarter, sort it out, figure out which one you like, and then you go to the technicals, you look at the indicators. Is it in an uptrend more or less, is the basic thesis. If so, then put it through, the software, look at the covered calls, which one can provide you the best return each month with the covered call based on the current volatility. And then we put those trades on. So it was deep down, it was still fundamental based with a little bit of technical analysis. And then we're trading options. So when the markets rolled over and everything went down, a long only strategy doesn't really work. You end up selling covered calls. You still have your shares, which have dropped dramatically in value, 20, 30, 40%. Some of them fell even more than that. And so it doesn't really work. So I went from believing in buying strong companies to going, I really don't care anymore what the company does or how strong the fundamentals are. I just want something that's going up in value. And so I follow price action, I follow momentum. And if something's going up, I'll take advantage of it. If something's going down, I'll find a way to take advantage of it as well, or I just don't hold it. So, I mean, all this was a big learning curve. I blew up my whole first account. Thank God I spent a lot of it on education. I bought a lot of CDs and DVDs on trading courses. I took day trading courses and you name it. I just spent all the money on education because I've always been taught, like, learn. The more you learn, the better you are, the more rounded you are. It will never hurt you knowing too much information. So I always, put money into trading courses. And I did, believe it or not, the first course that I bought, I had met a group of people at this weekend presentation in Toronto about how to trade. I became really good friends with these. They were much older than I was. I was only 18 and they were like in their 40s, 50s. But I would find all these amazing courses. I'm like, guys, this looks amazing. This goes with what we already know. And so I'd be like, hey, let's split on it. So we'd buy these like $1,000 courses, but there'd be 4 of us that split on it. And then we all take it together, right? Because we were all local. So it worked out really well. We got so much education and we'd support each other. We still chat to this day. Here we are like 25 years later. And so, yeah, we just kind of help each other and spread out the educational curve, and we'd all learn from each other's mistakes.
And so while the bear market was unfolding over a good year and a half, 2 years almost, I believe, during that time, what did you get introduced to short selling during that time, or was it too scary to get into? Like many traders like to avoid that. What was your take on
about it? But I never short sold. I was too young. It had endless risk. I don't think my account was even set up for it. I don't think I was allowed to at that point. I never started short selling until the 2008 financial crisis. Then we made a lot of money on the way down. But I was much older then. It was several years later. A decade under my belt almost of trading and following the markets made a huge difference. But no, I would more or less, during the first crash, that was my first bear market, always thinking the market's about to rally. Every dip, every further push down is like, oh, this has got to be the bottom, right? It just keeps going and going for years. So I was buying and buying and buying, and everything just kept falling. And I was doing some put options. So I'd buy a put option when the markets would fall. I had the occasional little grand slam or little hit here and there, but never enough to offset, my natural long positions, hoping the market's going to find a bottom any day.
How long were you taking these courses all the way through the bear market? And kind of like, when did you, after you blew up your account for the first time, when did you get back in?
Yeah. So I believe it or not, I still take courses. I see somebody with a course that looks like they have a little golden nugget that I might not know. And I'll spend a couple $1,000. I'll take their course. Really? If they have one little thing I don't know that improves my edge a little bit more with my current strategies, I'm all for it. I love learning stuff. So it's never ended, never will end. I think if you don't constantly evolve and improve, you're going to be left behind. So you might as well stay on the ball and keep on running. So what was your other question there? It was
so when you got back into the markets, you blew up your first account, and then kind of when did you get back in, and what did you do differently this time that you weren't doing before?
Yeah, so I still had the account. I had like $100 or something in it. So through that time, I had some other savings. I threw another $1,000 in and started to trade, and that was. Pretty much I blew up my account, and then probably like 2 months later, I put in another $1,000 after I kind of scraped it together, saved up and stuff, put that money in, and kind of just worked away at it, inching away. But back at that point, I was into trading microcap stocks, like penny stocks, and into miners and things like that. And so it was very fast, very leveraged. Worked out pretty well. I had one grand slam trade that I ended up buying some warrants on, and overnight it was like 120 something. I think it was about $127,000 I made overnight on one penny stock. Total fluke, not skill.
What was your investment in it?
I can't remember what it was, but I bought it for like 2 cents or something, and it gapped up the next day like $1.45.
Oh my God!
So it was huge,
That's
right?
a home run. Yeah.
Yeah, it was a financial newsletter doing a typical pump and dump back in the day. So it lucked out in my favor that I was like, holy crap, this guy totally just marketed it to his newsletter. And I just remember waking up, calling the broker. I'm like, how do I sell? How do I sell all this? Because I had warrants, right? I had it in a piece of paper. I'm like, how do I convert this to money? And I had called around to all kinds of different brokers. I'm like, can I open an account with you right now and sell short my shares to neutralize it? Because I'm worried it's going to collapse. It's a pump and dump, right? That was my thinking, which it ended up being. And so I couldn't do it. I ended up having to wait like 5 days. I had to put the paper in, get CompuShares to like convert to shares. I ended up selling at a $1.35 or $1.36. A couple different tranches, a couple blocks I sold out, but yeah, it was that was what really finally I had a big trading account, and I was young, right? And I was like, okay, I need to like really focus, and I need to know what's going on, follow some rules. So that was my kickstart. And I think if you trade long enough, eventually you do have a couple good, grand slam trades that just work out really well. But again, sometimes those are just fluke and they're just luck. You put in the time, usually luck will kind of will fall into place here and there.
Yeah. So after that incredible experience, were you totally sold on these microcap stocks? And I mean, you'd think you'd want to just jump in, go all in then, right? Because you found the lucky solution to making money.
100%. I would say I've lost more money in micro stocks than I ever made. So
Really?
As you know, they are super volatile. Most of them are just like a dead company with a piece of ground and they're marketing it or whatever it is, right? So I would say over like the next 15 years, whenever I get into these little companies, they kind of implode or they don't go anywhere or they get bought out or they roll from a mining company to something else. Like they're just, it's not my thing. I definitely learned you can make a lot of money, but it's almost like you're a venture capital in those things because you have to have 20 of them and one of them has to nail it because all the others are going to go broke or never really pan out. So I'm not a huge fan of those, but I went through a phase where I thought that was it. Like I was loaded up. I had warrants on many companies. I owned tons of penny stocks. That was one of the phases. So when I eventually learned, I'm like, you know what? I don't like this. It's not consistent. You can waste years holding on to these companies and then they just kind of disappear, get delisted and things like that. So that was one of my next phases. So the first one was fundamentals. You can own companies that are growing quarter after quarter, yet their share price still gets cut in half. And then a year later, it's cut in half again. So, fundamentals, I don't believe in really in terms of trading. I'd rather follow something going up. The next lesson was super volatile and risky, cheap stocks are really dangerous. Yes, they can pan out, but most of the time they don't. And so I went from trading big tech companies and growing quarter after quarter and blowing up everything, then going to little companies that have no earnings and they're super cheap and then losing everything again. So I kind of had to be like, okay, I'm playing both ends of the spectrum. I got to figure out there's got to be something in between this. And so that's kind of when I got away from penny stocks and I moved into ETFs were just starting to really become popular. In 2001, 2002, we were starting to see them pop up, and I really liked them. I like the index ETFs. They just move stable, and they kind of move like the ocean. They're not all over the place like these little penny stocks, up 20%, down 20% in one day or something like that. I wanted something more stable that I could be consistent. And I took a course that started to teach us about cycles. And waves like noise in the market. So my mom was in the hearing aid business. So I learned a lot about hearing and wavelengths and sounds and all that stuff. Well, this guy brought in his skills, which was in noise and cycles into the stock market. And I'm like, he's like, the stock market is just a vibration of the masses who are following it and watching it. And he explained it and taught it. I'm like, I totally get it. It's like, it's like a tuning fork. You take one tuning fork beside another one, you whack one, it'll start to move the other. Well, that's kind of the vibration of what investors are thinking and feeling and what they're doing. gets transferred like into stocks. And so stocks move up and down with more or less investor sentiment and the energies that are moving around, the money. And so that got me really, this was in 2001. This is where I started to implement cycles. I started to implement things around position management and trends, longer term cycles going up while there's other shorter term cycles coming down. I started to decipher what are buying opportunities, smaller cycle dips within a larger upward cycle. And so that's a strategy that has evolved for the last more or less 24, 25 years. It's what I use now specifically. And it's very, very powerful. So I've learned to figure out the vibration of the masses, of the market participants. There's many, many ways to do it. And you need to calibrate, a lot of different parts to come out with it. But it tells us what's going on in the markets and how to navigate it. And so I'm a huge fan of cycles. I'm a huge fan of Fibonacci theory, which Fibonacci values are pretty much in everything in the universe, and clouds and the stars and flowers, you name it. Like Fibonacci is a very powerful sequence. And there's the golden sequence, which is the 618 retracement or extension. And I use it all the time for price targets and support levels. So I started to become very much more technical driven. There's underlying forces at play that we need to make sure is in line with our analysis and our targets and trends.
Mm-hmm. So you seem to indicate there that you were looking at different kinds of cycles of different asset classes. I mean, the market, are you looking at, say, just the S&P 500 or within sectors within the market? Are you looking at commodities or anything else? Share with us.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Yeah, so I mean, there's a lot of angles to look at. So I one of the cycles is time cycles. Just, what I like about the stock market, and I learned this from the very first course I ever took when I was like 18 in Toronto, was the stock market, the stock indices have wave-like patterns. There's reoccurring news that comes out weekly or biweekly or monthly or every quarter or every 6 months, every year. There's people who get paychecks of all those same frequencies that naturally put money in every paycheck into the stock market. The economic data rolls out on specific times all the time. And so there's natural flows, ebbs and flows that go in the stock market. So once I kind of learned, okay, the stock market has these natural tendencies, then I start to apply what you just mentioned there, Ian, which is I start to bring in other cycles, which are what are the stock market price actions doing? What are various assets doing? So, for example, the gold is a very strong barometer of global fear or global, lack of fear. Sometimes gold goes sideways for years and the stock market rips higher. Other times, like where we are kind of now, which is gold has been rocketing higher in 2025, early 2025, and the stock market has been struggling. And so gold is one of those cycles I like to look at. Is it outperforming the stock market? If it is, be aware there's probably something big looming, not just a little correction, but a global massive potential correction or reset of some sort. I like to look at utility stocks. I like to look at the US dollar. I like to look at bonds. There's a whole bunch of different things. And as you know, Ian, the financial markets are all connected in some way. If money is flowing out of one asset class, it's probably flowing into something else. And depending what it's coming out of and going into also tells us the mindset. So if people are moving out of gold, for example, and into small cap stocks, we're like, okay, well, they're not afraid anymore. So they're bringing it out of boring old, pet rock gold, and they're moving it into highly leveraged, fast moving stocks for growth. So depending where it's coming from, where it's going, it tells us what the market participants are thinking and feeling, and even more importantly, what they're doing with their money. And so I have about 11 different asset classes and sectors and things and commodities that I follow that lets me, it's almost like playing poker. I get to look at the market participants' hands. I go, okay, I know what they're thinking and I know why they're doing it. I know where they're putting their money. And so when you can see somebody's hand and see what they're doing and how they're betting, you can start to get some very good insight of how to counter that or take advantage of it. So that's what I do. And there's cycles in all of these. Everything has its own cycle. You have to figure out what it is and how it moves and its relationship to various assets. And then you can label it. Is it a risk on or risk off asset? Things like that.
Is there, you mentioned money flowing out of one asset into another. Is there a way to look at the charts and the data to see, okay, this is actually really money coming out of this asset rather than the buyers have kind of exhausted themselves and there's not many new buyers, but the sellers are also kind of light. In other words, declining prices on kind of like in a vacuum where there's not much interest. And do you look at the quality of the gain or the decline to determine how much assets are flowing in or out?
I don't so much. I think you're kind of referring to if money's coming out of something and it's heavy volume, then you definitely know there's a lot of people dumping and distributing. They want out of that asset. But if it's really drifting down, just a lack of buyers and there's some sellers wanting to move out, believe it or not, I don't really use volume for my analysis. Yes, it can tell you if people are piling in or out of something. But instead of using volume for that, instead of looking at just one asset class saying somebody's dumping gold, a whole bunch of people are dumping gold, I'm like, okay, I just know gold's going down. And I look at all the other asset classes and I look at the majority of them. So are the majority of them moving down, telling us, say, for example, people are moving into risk on assets. So all the risk off assets are going down. If the majority of them are, that's my volume indicator. The majority of people tucked away in these safer assets are moving out of them because they want more. And so that to me is the volume indicator saying it doesn't matter where they're hiding their money, where they felt safe, they're moving out of it because they want to make more. So that is my kind of indication of this is a strong wave because it's not just money coming out of gold. It's money coming out of 4 other asset classes and it's all piling into one specific asset or risky stocks type of thing.
You mentioned Fibonacci before, and many traders have heard that term. And the numbers that pop out as a result of that. Could you go into more detail, why how are these numbers created and why is it important? Some people think, oh, this is just made up nonsense. Who is this? What is this Fibonacci anyway? It seems like mumbo jumbo. What could you describe? What's its importance in our kind of daily life, and how was it found?
It's a little beyond me. The best thing to do is for people to go and just watch a quick YouTube video of Fibonacci and how it's in things. But more or less, it's a sequence of of price, of expansion and contraction that repeats in the universe. So, for example, if you have something that moves, has a specific move, the next move that it should make is 61.8% of the first move. And so it creates this sequence. And a lot of people, if you Google Fibonacci theory or Fibonacci, you'll see like a shell shape, kind of where it coils in. And it just happens to be like the universes and cloud structures and flower structures and waves and everything like that kind of flow through the sequence. I'm not really sure. A lot of people see it as voodoo, and I don't get into the planetary alignments like Venus is in retrograde, sell short. But Fibonacci has been proven. It's in so many things, and I've seen it, and I use it all the time, and it works exceptionally well. So it's worth looking in and just getting a little of insight. And then to me, the two key numbers for Fibonacci is the 618 and the 100%. So whatever the first move is, when the next move starts, it should equal the same one. Those are the two levels. I take first profit target, second profit target, and rinse and repeat. But yeah, there's something in the universe. I don't know if people can actually put a thumb on it, right? It's just something that happens. It's kind of out there, but it's there.
Right. From my understanding, it was just a natural occurring phenomenon that we observe in nature, mathematical relationships that we apply to the market. And for many, it seems to work quite well. Could you go back to just 2008 and how that unfolded for you, and kind of what did you see back then that made you either get out of your positions and or go short, and how you applied technical indicators during that time period?
Yeah, sure. So kind of leading up to there, there's a couple of interesting stories, because if you understand the stock market and the economic cycles at play, you can benefit a lot more than just trading stocks. So for example, in 2005, I had started my own line of healthcare products. I built a dealer network across Canada, United States, and I built up this business. It was booming, doing very well. My dad and I had started it together, and I was also running a trading newsletter back then. I've been running a trading newsletter since 2001. At first, it was just a community of all of us trying to learn what to do. Eventually, I figured stuff out, and I started charging a subscription fee. So I've been doing newsletters for a long time, but long story short is I built the healthcare business, our brand name, and I was also trading the stock market. And business was just starting to slow down for our healthcare business. I'm like, I told my dad, I said, I'm not really loving this. I'm getting tired of it. It's like 3 years. We've had a really good run, and we've had it as seen on TV, one of our products and all that stuff. I said, I make more in like a month than trading with my newsletter than we do with this business. And I'm like, I'm kind of ready to just move on and sell it. And I said, we should, it looks like the economy, all my analysis was saying the economy is coming to an end. Like it looked like there was a financial crash. This was in 2007. I said, we should just move on. I'm like, I don't like it. And I want to focus on my newsletter. There's some crazy times coming. And I started to pick up, I was following, I still do. I follow economic data. I love charts and trends of housing and interest rates and everything in that space to get a feel of how the economy is doing. And it's funny because my dad's like, sure, whatever you want to do. He's like, I'm on board. And so we sold it, and everything unfolded as expected. We kind of sold it near the peak of the business and at the peak of the economy. And then the 08 crisis hit and everything collapsed. And of course, that was when I got into learning to short sell. There was also some inverse ETFs back then. So instead of going short, you just buy an ETF that goes up as the market goes down. But more or less, I was looking at a lot of different relationships. I was looking at the price of gold. I was looking at the transportation index, which you can't really use anymore, the transportation index, because everything in the world now is shipped with Amazon and all these transportation companies. Shipping is picking up, even if the economy slows down. It's a growing, booming. So typically, the transportation space is a leading indicator. If the transportation space slowed down, there's business sales are slowing down. There's less sea containers going. There's less shipping and all that stuff. But now, the shipping space is still growing by leaps and bounds, so you can't use it. But I use a lot of these things in price action to figure out, okay, this market is getting weak. Valuations are out of whack. Everybody's super bullish. everyone's bought stocks. They're buying leveraged long ETFs. They're buying, call options galore. They're buying real estate at nosebleed pricing. Like, it was just a greedy time. Like, and I could just see the end is coming. I'm like, it can't keep going like this. And the data is showing things are eroding. And so that was when I started paying attention to the stock market rolling over, and it did. It cracked to the downside and had a 20% initial drop, and then like a dead cat or a bear market rally. And then it went off a cliff and continued to sell off about 57%, the S&P 500. And, I was running a newsletter then. We were trading inverse ETFs, and every time the market would roll over and start to fall, we'd buy another one of these funds. I wouldn't necessarily short. I would short some of my own stocks in my own account, but through the newsletter, we just bought traded funds. And so that's, how I was lucky enough that I made enough money during the financial crisis that I retired when I was 27 from the financial markets and selling the health business, that I was able to just focus on managing my money, which is where I'm at today. I just manage my money and I share what I do with others. But trading a falling market, as you know, is a very different beast than a bull market phase. And people don't realize how quick and violent it is. Pretty much you get into a trade and the market falls in your favor. You want it to fall. Those trades are short-lived. They're like 5-10 days. The market drops very quickly. And you got to get out because, as you know, bounces and rallies in a bear market are the strongest rip your face off rallies you'll ever experience. And you do not want to be short for any longer than you have to. So it's like, get in, hit your target or two, get out, and just be happy and wait for a whole new setup to unfold over the next month or two. So you have to be very patient and selective in a bear market.
So your experience in the 2001 crash and then in 2008, did that create a kind of a psychology of bearishness, being more pessimistic about the markets than optimistic, or were you just simply trading what you saw on the charts? Because you mentioned that you follow the news as well, economic news and stuff. So were you swayed by the either negative or positive news that countered what you would see in the technical indicators?
Yeah, you bring up a good point. So in the 2000 tech bubble crisis, it was more so driven on fundamentals and ways to buy stocks and sell options on it, which didn't work out. Over the next several years, leading into the 2008 kind of market top, I learned a lot. I went from fundamentals to like, just teach me I want to learn technical analysis. I got into, John Murphy. He's got his big, thick book Bible, the technical analysis of the financial markets. I read that a few times. And so I had been working on technical analysis for a long time. I used stockcharts.com. I was one of the top people there, or the top shared list for many, many years, sharing my analysis. And so I use the technical analysis to figure out the big picture of what's going on. The big thing, the takeaway I learned from 2000 and the 2000 tech bubble was you have to follow price. If something is going down, get the heck out or have a strategy to profit from it falling. If it's going up, you want to own it. And so coming around second round for the next bear market in 2008 was, okay, if this market is going off a cliff, I definitely do not want to hold anything. I want to profit from falling pricing or move to a different asset that goes up while the stock market falls. And so I did have a very bearish bias, but I trade strictly the charts. That is where I really deviate. So I could be very bearish or bullish on something, but I'll actually be in the opposite trade. I'll be I could be still bullish on the stock market, but actually have an inverse ETF because I follow price. So I might think a bottom is coming, and I'm like, guys, I think a major bottom is coming, but I'll still be short because the price is going down. So people need to be able to differentiate what you think and feel is happening versus what the charts are doing and what I'm actually doing. So, a lot of times I'll be like, I'm really bearish on the market, but we're actually still long because it's still going up. And so that's where people need to deviate. And so I don't let news get in between what I do. Yes, the news might build my bearish story, for example, and the fundamental data, could be weakening on stocks, sales are slowing, the economic data could show unemployment starting to rise and delinquencies on mortgages starting to pick up and credit cards. So it builds my bearish bias, but I still have to wait for price to roll over and for all the other asset classes and sectors to also confirm that, hey, money's moving away from risk on. They're moving to defensive pockets of the financial space. And that's telling me that, okay, we need to be very aware because smart money is getting out of stocks and moving into more defensive plays. Utilities are a typical one. We usually see utilities rally very strong and outperform the stock market for a few days or potentially a couple of weeks before the stock market has a big leg down. And that's simply because people are like, if the market's going to roll over, they want to move into companies that are going to still be needed. You need running water. You need electricity. It's the same with consumer staple products. XLP is a consumer staple ETF. It usually does well or holds up or goes higher when the markets have a bit of a pullback. So it's just keeping a track of what all those things are doing. But 100% don't follow the news. Don't follow your emotions. Follow price. That is the biggest takeaway that will differentiate you from winner or loser over the long run.
So are you day trading these equities, or like how long are you holding on to them? And how do you know when to get in and when to get out?
Yeah, so I used to day trade. I mean, I used to run a full, all day futures day trading chat room. That's all I did for many years. I day traded the S&P 500. I day traded the Dow Jones. I moved away from that. I don't do any day trading anymore. If there's a perfect setup, I'll throw a little futures trade on. Opening gaps I do occasionally, or the end of day, like a little short squeeze if I see the perfect setup. But really, most of the trades I do now, they're kind of like a position trade. So trades might last a couple of weeks, all the way up to like 5 or 6 months. And the way I look at the stock market now, because I really just trade the indices and the bond market and currencies, those major core asset classes, I look for the market to move in waves. So the way that I look at the stock market is in all assets is like the ocean tide. If the tide is going up, what happens to all the boats? They all go up. So the stock market is the same. If we're in a bullish environment, the tide is going up. You can throw a dart, most stocks are going to go up. If the tide's going down, you don't want to hold stocks. And this is where people get things wrong. They're like, I own a tech ETF. I've got, an AI ETF. I've got Microsoft. I got this stock. I got that stock. They're like, I'm diversified. I'm like, just so you know, FYI, those are stocks. They're all the same trade. When we go into a bear market, they're all going down. And the smaller the individual asset, so the stock index might fall 50%. Well, a sector might fall like 70%. An individual stock might fall 80 to 95% in a bear market. And so people think they have all of these like diversification with sectors and stocks. I'm like, you have no idea what's going to happen to your portfolio if we go off a cliff. You're holding the most volatile pieces thinking they're your safe haven and your diversification, and people don't get that. The buy and hold strategy is a ticking time bomb for retirees right now. Guaranteed you'll never retire early with the buy and hold. You need 20, 30, 40 years to make real money. Diversification is very dangerous.
So you don't buy into the idea that just buy and hold the S&P 500 because it always goes up in the long run, right? That's the mantra.
Yeah. Well, I mean you never know. It will continue to do that. But for example, if you're close to retirement right now or in retirement, if we go into something where the markets go down 30, 40, 50%, and they take 5 or 8 or 10 years to come back, that's not a very fun ride for somebody who's retired, depending on growth, depending on income, watching their wealth vaporize and having like 5 or 6 years with no return. It is very dangerous. And I don't believe that's a very good strategy. And the whole buy and hold with diversification is another problem, because what happens is half your portfolio might be in something going up like stocks, and the other half could be in bonds, which aren't going up, they're going down, or vice versa. The gains you make in one are neutralized by the losses of the other. So my whole mentality is like, let's find the asset class that's the strongest and that's moving up. Let's move our money into it. When it stalls out, let's move our money out and look to where another asset class is moving up. So we move into stocks as the stock indices, like as a whole, or we move into bonds, or we move into a currency, or we just sit on the sidelines in cash and earn our 4.5% with no downside risk until something has a setup. And so that's what I focus on, is we're always holding something going up, and even cash. Cash is a position.
Yeah, clean up, You know how to do it, eh? In Nairobi, it's not what you want, it's what you get, and what you get to keep when you're chilling in Nairobi. Kupati utapati from
and it does go up. You make your daily interest and your monthly dividend payments depending on the type of cash position you're in, but you're growing and you're avoiding volatility. So I'm just not a fan of diversification. I'm not a fan of the buy and hold. It's a real gamble. The closer you are to retirement, the more risk you have, the more damage it's also going to do. That's what I'm trying to protect people from, because if we go into a financial reset, which I believe we're headed towards, there's no better time to hurt the majority of investors right now. Most people are 50 plus who are invested in the markets, and they're going to feel the pain at the worst possible time in their life to lose their money.
So you day traded for quite a few years. What incentivized you to transition to more of a position type trading, holding positions for weeks or months as opposed to day trading?
Yeah, good question. So running a newsletter, active traders, as you know, probably the more you trade, the more likely you are to lose money. Trading is not easy. Unfortunately, active traders tend to have, in general, they're very emotional. They tend to lose and struggle. They can't follow strategies because the news scares them out and they've skipped trades or don't want to get out of a loser because they don't want to be proven wrong. They won't get out of a winner because it's working. You work with enough of these people for enough years and you have a lot of nasty emails. People always seem to take it out on whoever reaches out to them at the wrong time of the day. So I kind of just I decided I built up enough wealth that I'm like, you know what? I have a whole lot of other things I want to do. I invent things. I've got multiple other businesses going. I just want to manage my large amount of capital in the easiest way possible, where I have the fewest trades per year. I can make the highest possible return